systems facilitate the attack. What's clear, though, is that risk managers now have to go beyond, do I have cyber insurance, to do I know exactly what it will pay if the attacker isn't human? And because they can go so fast, Melissa, and happen with such frequency, it means that the insurers have to be aware of what their risk and their exposure is with these intrusions.
Is there any thought, though, Contessa, that if you're a company that uses AI, so maybe you're opening yourself up more to this potential risk, that your premium goes higher? Have we crossed that bridge yet?
No. The simple answer is you're not seeing higher premiums for that. But QBE reportedly did put in a sublimit in a $5 million policy. They're calling it LLM jacking. You know, that there would be a $225,000 limit on this big $5 million premium. We'll see what happens, whether there's sublimits that get put inside that. But for everybody who's using AI, deploying agents, it definitely makes it seem like this is the opportunity to go back to your broker and your risk consultants and make sure that the language reflects the true risk.
Yeah, fascinating story. Contessa, thank you. Contessa Brewer. Time now for a CNBC News update with Seema Modi. Hey, Seema.
Melissa, the Asia-based USS George Washington aircraft carrier has arrived in the Middle East. That's according to U.S. Central Command. The vessel is relieving the long-deployed USS Abraham Lincoln that has been deployed in the region for a record 250 days straight amid the Iran war. There have been growing concerns for the crew aboard the Lincoln after reports of mental health challenges and supply shortages. The Food and Drug Administration is upgrading a recall of frozen blueberries to its highest level risk warning. Last month, Publix grocery store recalled Greenwise organic whole blueberries and whole mixed berries because of a potential E. coli contamination. The frozen berries were shipped to Publix stores in Alabama, Florida, Georgia, Kentucky, North Carolina, South Carolina, Tennessee, and Virginia. Meta CEO Mark Zuckerberg is buying a 19th century Gothic-style castle in Ireland. That's according to a spokesperson. The castle sits on a 440-acre estate and dates back to 1830. Details of the off-market transaction are not yet listed online, but the Irish Times, who first reported the purchase, estimates the property could be worth up to $35 million. How about that?
Sounds like a bargain.
Yeah, exactly.
Seema, thanks. Seema Modi. Stocks selling off today as bond yields bounce back despite the Treasury Department's best efforts. Can the AI trade, with all its borrowing and spending, continue to thrive if yields continue to rise? That is coming up next on Closing Bell Overtime.
The Middle East war enters its fourth month.
Welcome back to Closing Bell Overtime, live from the Nasdaq market site. Down day for the markets, Dow losing 700 points, S&P 500 losing nearly 1%. The Nasdaq down exactly 1%. It comes as bond yields move higher after a one-day reprieve on Treasury Department intervention. Oil up more than 2.5%, and another big day for Bitcoin, back above 70,000 for the first time in 2.5 months. And results from Ross Stores just out. We're not comparing earnings to the estimate due to the benefit from tariff refunds, but revenue and same-store sales topped estimates, and the company is raising third-quarter guidance. For now, the stock is up 6.5%. Let's dive deeper into the markets. If yields continue their march higher despite the Treasury's actions, could it throw a wrench into the bull market, or will it take more than just a few basis points to dampen investors' appetite for risk? Joining us now, Adam Farstrup from Schroders. He is head of multi-asset firm for the Americas. Adam, great to have you with us.
Great to be here.
We were chatting in the break. What do you think happens with yields? I mean, obviously, we need to sort of figure out that piece of the puzzle to figure out the rest of the markets.
So our concern is that inflation is going to pressure yields higher. That's what you've seen at the long end. That's what we think the Treasury is reacting to, especially when you had Chair Warsh coming in and people wondering, was this going to be a dovish Fed? The initial take was maybe not as dovish as we worried about. And so from here, the question is, do we get a deterioration in inflation that pushes yields higher at the long end, as we've seen this week? And how does Treasury and the Fed work together to try to manage that reaction in the market? Okay, so what do you think is
do you think that we have seen peak rates for the year, or do you think the market tests?
I think the market tests. I think it's very hard to say that we've definitively reached peak rates on a day when we just found out that government debt is 40 trillion. We know that Secretary Bessent was talking about he expects the deficit to come in, but we're still talking about record levels of debt in the government, in the economy. And so the market is now looking at this and saying, are you really committed to yield curve control? Because what we saw out of Treasury today is not true yield curve control. It was a warning shot.
Right. And he said a lot of this is about signaling. And I guess the signaling wasn't very convincing to the markets, given what the response is. So given your take that we will test that high on yields that we've seen, does that spell volatility for the markets? Does that put sort of, I don't want to say a cap, but, you know, make it more difficult to go higher?
Yeah, I think it depends what's the focus in the coming weeks, because we're through the earnings season. It's been a tremendous earnings season. And so that has really put the wind behind the equity market. We expect that to continue into the third quarter. But do you get a negative print out of some of the employment data or out of the inflation data? Do we get something interesting out of Jackson Hole next week? That will all be the things that the market is reacting to in what is typically a quiet period at the end of August.
Looking across assets, though, I mean, in terms of the signaling that the Treasury is giving the markets, I mean, is this a signal that we could see a weaker dollar? Is this a signal that you want to be in hard commodities, in emerging markets maybe? Do those trades look more attractive given what the Treasury is doing?
I think it's a real challenge for the dollar, especially if Treasury gets forced to push further down on yields, because the more that they do that, the more that that's going to challenge the dollar. And we'd come into this period with the dollar really in a new period of strength. We heard the Treasury say that they still support the strong dollar policy. So I think they're going to try to avoid that. The question is, does the market force them there? Now, in terms of what does that mean as we go into other markets, we do think things like emerging market debt really start to look very attractive here. They're high credit quality, higher credit quality than we think a lot of the market gives credit for. You've got very traditional fiscal and monetary policies in many of these markets, and so you see inflation rates falling in those markets. So that is a great diversifier to have in your portfolio at a time when there's all these questions about U.S. government debt.
Yeah, in terms of the driver of the U.S. markets, I mean, that would be the tech trade, the AI trade specifically. Do you think there's more juice there, or does it get does that really get capped because of higher rates?
I don't think it gets capped because of higher rates, but there's an interesting interaction, right? It's the issuance that you have from the hyperscalers at the long end of the curve that is now competition for capital. That's the other thing that's been happening in terms of steepening the curve. We do think that there is a lot more room to go in AI. It's very early to call this a crisis yet. Yes, there are concerns about the circularity within AI. The market is moving into the show me state, where they're saying, let me see what earnings are going to actually come off of all of this investment. What is the return on capital going to be? And so there's a real sequencing risk of, do you get an inflationary impulse, back to my earlier points, right, from all of the investment before you get the productivity boost? And then we've got the election coming up where voters are saying we're concerned about data centers and what it's doing to our local environment. We're concerned what it's going to do to our jobs. And so there's a lot of these forces we're going to have to watch as we go through this.
Are you fairly confident that that handoff between the inflation, being pushed higher by AI and the benefit, the productivity, like that will be almost seamless? Or seems like a big risk.
I think it's very complicated. So to your other question, will we get volatility? Yes, we will get volatility, especially when you've seen VIX incredibly low levels. I mean, we were 16 today, in the 16s today. That's pretty low.
Yeah.
So I think there's a lot of room to see that volatility go up as we head into the fall.
On the index level. Okay. Adam, good to see you. Thank you. Adam
Thank you.
Up next, a new entrant into the prediction market space once again has people asking, isn't this just gambling by another name? We're going to hear directly from the CEO of Novig. That's straight ahead. You're watching Closing Bell Overtime, live from the NASDAQ market site.
Military spending.
Prediction market space competing with Kalshi and Polymarket. It's called Novig, and it made quite a splash by posting $125 million in trading volume in its first week, but also getting a lot of attention for its legal strategy, filing preemptive lawsuits against 5 states to protect its sports event contract markets. Central to the suits, the claim that these contracts are not sports gambling. Joining us now to explain the difference, Novig CEO Jacob Fortinsky. Jacob, great to have you with us.
Thanks so much.
So how is it different from sports gambling?
It's a good question. I would say that gambling is a type of behavior, not a type of product. People gamble on everything. people could gamble on stocks, on meme coins, on sports. I would say is that there are two different ways of structuring this market. One is, as it has been, as a casino product where people bet against the house, where your counterparty is the sports book itself. They make money when you lose money. They lose money when you make money, which is why the house always wins. They kick off anyone that makes money. On the other hand, you have financial exchanges, prediction markets that list sports event contracts. And that is basically a more fair way to trade sports events. So what we would say is it's not really a question of is it gambling or is it not gambling. Gambling doesn't apply to the product. It really describes to the way people interact with the product. What's important is that this is a more consumer-friendly, more responsible, more trustworthy, and high-integrity way of structuring sports markets.
So the main difference is that in gambling, as it's defined traditionally, there is a house, and it is less fair. And in predictions markets, it is peer-to-peer. There is no house, and so inherently it is more fair because it's consumer to consumer. How about, so if it's behavior and sort of how you interact, I mean, there have been lots of studies that there are algorithms in these markets distorting what the odds are. I mean, how can you say that it is more fair on a predictions market as opposed to in traditional gambling?
Yeah, let me just simplify this. I think if you wanted to place an $100 trade on, let's say, the Knicks to win the championship, if you were to go to a casino or a sports book, they would give you a price, and your only option is to take it or to leave it. On a prediction market, you have thousands of participants, both retail and institutional, competing to offer you the best price on the market. So as a result, you as a consumer get better odds. You'll win bigger, whether it's against a sophisticated market maker or an everyday Joe Schmo user. What we essentially are doing is cutting out the middleman, creating a two-sided marketplace that is essentially structured the same way equities markets are or futures markets are. And as a result, it's a more level playing field. It allows people to compete on equal footing rather than giving a structural advantage to the house or to the casino.
The argument, though, that it's more fair and so therefore it shouldn't be considered sports gambling, I mean, I don't know, if you're a state, you would say, well, if we provide studies showing that it's not more fair because of the entrance of institutions who know how to game the system or algorithms, then that argument would go away, that it's not more fair. So then, therefore, does that become gambling? Is the definition because it is more fair?
Again, I would say the question of gambling is about consumer behavior. People can gamble in the stock market. They could say, I'm going to put $10,000 randomly on an equity. I would say that's gambling. That would not make the stock market itself a gambling product. Prediction markets are event contract markets. They're futures markets that list sports events, and they let users buy and sell contracts on sports events. So I would say there's not anything inherently, gambling about prediction markets. It's about consumer behavior, and the traditional way of structuring sports betting, the casino model, I'd say is more susceptible to irresponsible trading. Basically, I would say that there's responsible trading and irresponsible trading, and a responsible platform encourages and facilitates responsible trading and prevents irresponsible trading.
So at Novig, for instance, if you see somebody who's repeatedly entering contracts, would you tap them on the shoulder and say that's no longer responsible? And so you're entering the gambling territory as opposed to what you call responsible behavior on predictions markets.
Yeah, we are very proud to, I think, be a leader when it comes to responsibility, to trust, to integrity. We're the only prediction market that is 21 plus. And in many ways, we have restrictions on irresponsible types of behavior on the platform to ensure that people aren't abusing it. But I think the fundamental issue is that on casino platforms, the elephant in the room is that they make money when their users lose money. Prediction markets are agnostic to the outcomes of events. And as a result, they are structurally more fair because they're just a peer-to-peer marketplace that facilitates trading.
Okay. We got to leave it there. It's a longer conversation. It's fascinating. Jacob, thank you very much.
Yeah,
Jacob,
thank you so much for having me.
Of Novig. Up next, what's at stake for the resurgent software industry ahead of key earnings from Salesforce next week? Closing bell overtime, live from the NASDAQ market site. Be right back.
With 4 Republicans joining.
Up with tomorrow's trade today, it's just BJ's Wholesale on the earnings calendar, and on the economic front, we will get the August S&P Global Flash Manufacturing and Services PMI reports. And looking ahead to next week, the biggest report, of course, is NVIDIA, but the focus will also be on software with CrowdStrike, Salesforce, Intuit, and Workday among the names reporting. The IGV software ETF has staged a comeback that's up 26% in 6 months. But these earnings will be a big test for that rally. Let's bring in Seema Moni now with more on software. Seema.
Well, it absolutely will, Melissa. This whole rebound will be tested by what Salesforce delivers for the quarter. If its AI platform Agentforce is unable to show a meaningful pickup in enterprise customers, the street will likely ask tougher questions on the scale of future buybacks, the spending on Agentforce, and whether it's got the right executives in place to lead this turnaround. Just 2 weeks ago, CEO Mark Benioff made changes to his leadership team. Now, CrowdStrike has seen a huge run-up in its stock, meaning expectations are high. Yes, sure, it's cybersecurity, bigger risk with increased interest in managing rogue AI agents. But the question, Melissa, is whether it's translating into bigger contracts with American business. So far this earnings season, annual reoccurring revenue beat expectations have come in at the highest level in 4 years, according to RBC Capital, a sign that not all software companies are vulnerable to being displaced by AI. That will be the key metric to watch when Intuit, Workday report next week. Both stocks have been hit by SaaS apocalypse fears. For Workday, investors will want to know if it is in fact throwing in the towel and getting acquired by private equity firm Silver Lake for over $40 billion. That's according to a report, and whether that, Melissa, becomes a bigger outlet for software.
Yeah, and it is striking, Seema, if you take a look at some of these names within software since April lows, a lot of them are up. You know, it could even be 100% in the cybersecurity sector. And so, you know, you wonder how high the bar could be going into this quarter.
Absolutely. Bar is high for certain subsectors within software, to your point. Cybersecurity, very much the case for Palo Alto and CrowdStrike, even SentinelOne and Fortinet. Some of those names that live or operate in that mid-cap software security space. But the question is at hand, how much is the frontier labs and their ability to move so fast, the security risks that come with that, is that creating a bigger opportunity for them? Do they have the tools in place to defend against those attacks? I think that level of granularity is what we want from these earnings calls.
Yeah, and if they're seeing any inflection when it comes to revenue because of AI,
right.
I think that there is an expectation that they will get business. And the question is, do they actually have business because of AI hacks?
Right. And you know what? Even early on, one of the big questions was when Anthropic came out with one of its latest models, we saw all the cybersecurity names respond negatively because the concern was, well, if you have these robust models coming to market, only Anthropic and OpenAI will know how to fix those agents, not the cybersecurity companies. That narrative has certainly changed in recent months. But again, the numbers will give us the real story.
Yep. Seema, thank you. Seema Modi. That does it for Overtime. Fast Money starts right after this.
Imagine given
that'll do it for us. We'll see you tomorrow, and I'll send it into overtime.
The bells bring an end to the trading day at the NYSE. M&T Bank ringing the closing bell, and at the Nasdaq, Fortunex acquisition doing the honors. Welcome the closing bell overtime. Live from Studio B at the Nasdaq market site. I'm Melissa Lee. Mike Santoli's off today. Stocks sliding as Treasury yields rebound. The Dow down about 700 points. S&P 500 down a little less than 1%. The Nasdaq down a little more. Bond yields are reversing course following yesterday's losses after Treasury's efforts to try to ease rates. Much more on this, including comments from Treasury Secretary Scott Bessent. A jump in oil prices may also be contributing to that move, that backup in yields. Oil higher by nearly 3% on the latest threats against Iran. And Bitcoin above 70,000 for the first time since June 1st, tracking for its best week in nearly 2 years. Let's get more on the stocks making big moves today. Christina Partsinevelos joins us now with that. Christina.
Well, Melissa, defensive stocks just couldn't catch a bid as bond yields, like you said, drifted higher. Real estate, energy were the only sectors up. Staples, healthcare, and industrials all fell more than 1%. Earnings did a lot of the steering today, starting with Advanced advanced auto parts. It slumped on a sales miss, with management saying tighter household budgets really constrained spending more than anticipated. AutoZone, O'Reilly also fell in sympathy. You had Deere went the other way, raising its 2026 net income forecast after its first quarterly profit rise in 3 years. The company pointed, of course, to strong demand from large-scale infrastructure, data centers, and energy projects. CrowdStrike dropped about 6% today, specifically after an Axios report that said its CTO's chief technology officer is leaving to launch his own AI-focused cyber venture fund. Then you mentioned crypto. The names extended their rally to alongside Bitcoin and Ether after the president pushed Congress to pass crypto-friendly legislation. Coinbase, Circle, Strategy, all up at least 5%. SpaceX, though, fell roughly 5% after its second post-IPO share unlock hit the tape today. And then Micron rose about 3% after unveiling Micron Research Labs in Boise. We had Jim Cramer there, too, a memory AI hub packed by a planned $10 billion investment over the next decade or so. And so that's just general. His comments about memory is really what drove the stock, though.
Christina, thanks. Christina Partsinevelos. Let's get to the bond market now as yields bounce back today following the Treasury's repurchase efforts aimed at bringing yields down. Let's bring in Steve Leisman now for what Treasury Secretary Scott Bessent is saying about all of this. Steve.
Yes, on our air here, Melissa. Treasury Secretary Scott Bessent, in an exclusive CNBC interview this morning, putting the market on notice that the controversial bond market intervention yesterday may end up being above the bottom end of the $4 billion minimum that Treasury announced.
We routinely do buybacks, and we're going to increase the size of the buyback. And, Sarah, I would note that it could be more than the $4 billion per issue.
The secretary's unprompted comment suggests he may not have been satisfied with the market's initial reaction, which has seen the 10-year now trading around 470, pretty much undoing the benefits from yesterday's surprise action, calling it a Treasury twist in which the Treasury buys long-dated bonds funded with short-term bills. Bessent defended the action, said it would address liquidity issues in parts of the bond market, that the bond market was not reflecting underlying economic fundamentals, and the Trump administration will be focusing in coming days on deficit reduction. The bond market surprised by the action, creating longer-term concerns. Luke Randall from Wrights and ICAP tells me the long end was already having to contend with increased risk premiums in the wake of Chairman Warsh's July 29th press conference, creating additional uncertainty about the Treasury's commitment to a regular and predictable financing strategy is not helpful in the long run. The big change might be this, Melissa. Don't fight the Fed. That was the old statement. May now be don't fight the Treasury when it comes to bonds.
Yeah, that's what Elizabeth Burton was telling us here in Closing Bell Overtime yesterday of Fortress. Steve, I'm wondering, he seemed a little bit dismissive. I don't know if that's quite the right word when it comes to the impact of the concerns about the national debt. He said this is probably going to be peak deficit. We'll just grow our way out of it. I mean, all the other sort of structural issues that a lot of experts out there say are driving yields higher. He seemed to sort of say, that's not where, we're in this market. It's thinly traded right now. They're not reading the signals right, and here we are playing in it.
So I'm tempted to give the secretary the benefit of the doubt on this, and I'll tell you why, Melissa. A couple things. He does have some short-term issues. He had to refund all that tariff money, which, that's the administration's fault. They should have known better in that regard. But they've replaced it with other tariff issues, so that money will begin flowing back in. That's one. Two is the idea that they, over time, if you do get this growth, you should get some deficit reduction. The other side of this thing, though, is that structurally, over a long period of time, this country, almost everybody agrees, has a major deficit problem. And as far as I can tell, the administration is not taking that on despite their promises to do so. And in fact, in some ways, they've made it worse. So at best, I think they've had some reduction in the deficit, but only to a very small degree that keeps it at a very high level, especially for peacetime, expansion time, when we should be doing or making progress on the deficit.
Right. Steve, thank you. Steve Leisman.
Pleasure.
So what's next for the bond market? Will any amount of purchases by the government help bring down yields? Joining us now, Robert Tipp, Chief Investment Strategist, Head of Global Bonds at PGIM Credit. Robert, great to have you with us.
Great to be here. Thanks.
Is this going to work? I mean, the markets seem to be telling Treasury Secretary Bessent, we don't care what you're saying. We're going to go the way we want to go because we believe that yields are going higher for a lot of reasons that your buyback can't address.
Right. And that's absolutely true. And so the answer would be no and yes. No,
Okay.
it's not going to work. It's not going to get rid of the upward pressure on interest rates around the world. You know, whether you're looking at Japan, the United Kingdom, the Eurozone, growth is doing pretty well and inflation is above target and deficits are big, almost uniformly. The U.S. deficits are bigger, but the U.S. has other countervailing features like our resource security, our high growth rate, the way we attract investment into this country. So all those things considered, the U.S. is pretty much on a fair footing. So, you know, it's a bad environment and that there's upward pressure on rates, but I think there's evidence that this policy, which they increased, has been working already when you look at the relative performance of the U.S. bond markets relative to other government bond markets.
Okay. So what do you tell clients at this point in terms of where you see yields going, you know, in the next 3 months or so?
Yeah, absolutely. And on that point, I don't mean to be abstract there. I mean, when you look at the yield on the long-term treasury in the United States versus the United Kingdom, France, Germany, Japan, you know, since June of last year, in 2024, when this was initiated, or whether you're looking versus a year ago, the yields in the U.S. have risen less than in these other countries. So it has been an outperformer on a relative basis. In terms of where to from here, I mentioned the upward pressures are likely to persist, but there has been some upward movement already. We were in an environment with the Powell Fed where people were expecting the Fed funds rate to fall towards 3%. Starting right away when Warsh was nominated, the short-term interest rates started to move higher. And basically expectations on where the Fed funds rate would be, say, 12, 24 months down the road went from just over 3% to now over 4%. And long-term interest rates have risen along with that. And corporate yields have risen as well. And I think that's what Chairman Warsh was pointing towards at the press conferences, that, you know, if you want to slow the economy, slow demand, slow investment a bit, to bring down inflation, to bring down demand for goods and services, you need tighter financial conditions, and we've had some of that. So I think that may be why they're not in a huge rush to raise rates. And the increase in rates that they may do of, say, 50, 75, or 100 basis points, a lot of that is in the market. So I think you may get stability in long-term yields from here.
Oh, okay. So do you think we've seen peak on the 10-year, peak on the 30-year yields for the year?
I think we're pretty much in the zone. I think, you know, are we going to go back to 4.25% or 4%? We'll have to get lucky. We'll have to see inflation come down, growth slow down, and so on. But if the economy continues a healthy pace of growth and the inflation, I mean, given what we're seeing in terms of climate impacts, in terms of oil prices, inflation is probably likely to stay above target. I think, you know, staying between 4.5% and 5% on the 10-year seems likely. In terms of the performance of the bond market, you know, the higher yielding sectors of the market, like high yield or even bank loans, hard currency emerging markets, intermediate corporate bonds, these have had solid returns and are presenting very attractive yields here. So I think, yes, it sounds bad, but I think a lot of this is in the market.
How does this twist, which Secretary Bessent himself used the word, you know, he said something like, I would consider this twist, or I would call this a twist operation, since they're issuing at the shorter end in order to fund, so to speak, the repurchases. How does that sort of muddy the waters here when it comes to the Fed and what they're trying to do, if we're going to have all this issuance on the shorter end impacting yields there?
Yeah, absolutely. Well, you know, the Fed is going to run their game, and the Treasury is going to run their game. And the Treasury's job is to finance the government's needs, and the market was on a roll towards a steeper yield curve, and people were really, you know, uniformly hating the back end and leaning into these bearish trades at the back end of the yield curve. And I think Scott Bessent took advantage of that in order to kind of shock the market, let them know we're on notice, and we can do a lot more of this. So I think that's helpful. Does this have a countervailing impact for the Fed? You know, does this make it more difficult for them to tighten financial conditions if the Treasury is successfully bringing down long rates? It would, but I think that's unlikely. I think they're just introducing a stabilizing impact into the market here. They're not going to reverse the tightening of financial conditions that the Fed is looking for.
All right, Robert, great to speak with you. Thanks. Robert Tipp, PGIM. So how do the moves in the bond market and the Treasury intervention mean for the Federal Reserve? Does it put more pressure on them to lower rates? Joining us now, Esther George, former Kansas City Fed President. Esther, great to see you, and great to get your thoughts on this. What is your take? Because even if yields come down a bit, I mean, the issue here is the national debt, it's the deficit, it's the funding costs behind it, and yields are still fairly high, even if they are going to stabilize, let's say, from here because of these repurchases.
Yeah, I think, Melissa, since the last FOMC press conference, we've seen the markets really trying to sort out a number of issues. First of all, trying to sort out the Fed's communication at that press conference relative to the fact that we have elevated inflation in this country. It's persisted for years now, and trying to understand where is the Fed looking at its own tools relative to that. And then you combine the issues of watching the war and how it continues to unfold. It is not settled yet. And that, of course, has implications for oil. So there are a number of things that I think the market is sorting out here that is resulting in the move higher in yields. And of course, we know for our federal deficit, the underlying issue is those are not sustainable, and there is no apparent plan yet for how that will be addressed. And I think until that happens, ultimately, you're going to see that kind of pressure on these longer-term yields.
Do you think that the Fed factors all of this in? I mean, we're just about a week away from Jackson Hole, and this is an opportunity for Kevin Warsh to more clearly sort of communicate how he views the situation on inflation, maybe not actually outline any sort of guidance, but just his thinking. And he has that opportunity. Should he take it? I mean, if you were to call you and say, Esther, what should I do? Would you say, you know what, now's a great time to clarify because the markets are muddied on this, given all the other factors involved?
Yeah, I think it is an opportunity for him. Again, I agree with him. You don't want to be leading the markets and forecasting things that you're not able to forecast. But I do think we all understand inflation has been elevated for a long time. There have been a number of shocks hit the economy, and yet inflation has persisted. And so hearing from the Fed, how do they think about that? How does it align with their current stance of policy? I think is an important message both to the markets and the public. And I think we got a little bit of a sense of that from looking at the Fed minutes this week, where you can really begin to see where was the weight, what were the things the participants were considering as they made their decisions at that meeting.
And to that point, Esther, I mean, at this point, you know, as you point out, we've been above target for a long time, even before the war. So inflation has shown to be persistent, even beyond the inflation shocks that we've seen more recently in the past months or so. And so I'm wondering, from your standpoint, what has the cost been? I mean, there's a certain cost to not acting and allowing inflation to persist for this long. And at this point, with the shock still in place, with still the underlying inflation persistent, what is the cost of not acting? What is the cost of not acting swiftly enough in your view?
Well, I think there are several costs. Obviously, inflation is a tax on the consumer and on businesses. So it erodes their purchasing power. And that is the primary reason the Fed is tasked with keeping prices stable. The other cost, though, of this patience of sort of living with this inflation is an issue of credibility and expectations on behalf of the public. So I think the Fed has taken great comfort that inflation expectations, as they look ahead, have remained, as they call it, anchored. But those can begin to drift, and they have drifted higher. And so you don't want to lose the public's confidence that you will address this issue and return inflation to 2%. The question is when and how will you do that?
Do you think the Fed has lost any credibility?
Well, I don't see obvious signs of losing credibility, but it's the kind of thing, Melissa, I would not want to test. This is an institution that has long been willing to keep its reputation solid in terms of how it thinks about this, how it communicates with the public. So I wouldn't want to test that foundation of credibility right now by watching those expectations move. And I think that's why, if you're not addressing higher inflation with your interest rate, it's really incumbent on explaining why that is the case and what you see in the economy today that gives you confidence that holding those rates where they are is the appropriate stance.
Esther, it's always a pleasure speaking with you. Thank you for your time.
Thank you.
Esther George. Well, on a down day for the Dow, the worst performer was Walmart following its earnings. Up next, we'll hear from the CFO on the state of the consumer and get an analyst's take on whether this is a Walmart problem or an issue for all of retail. You're watching Closing Bell Overtime live from the NASDAQ market site. A new entrant in the prediction market space competing with Kalshi and Polymarket. It's called Novig, and it made quite a splash by posting $125 million in trading volume in its first week, but also getting a lot of attention for its legal strategy, filing preemptive lawsuits against 5 states to protect its sports event contract markets. Central to the suits, the claim that these contracts are not sports gambling. Joining us now to explain the difference, Novig CEO Jacob Fortinsky. Jacob, great to have you with us.
Thanks so much.
So how is it different from sports gambling?
It's a good question. I would say that gambling is a type of behavior, not a type of product. People gamble on everything. People could gamble on stocks, on meme coins, on sports. I would say is that there are 2 different ways of structuring this market. One is, as it has been, as a casino product, where people bet against the house, where your counterparty is the sports book itself. They make money when you lose money. They lose money when you make money. Which is why the house always wins. They kick off anyone that makes money. On the other hand, you have financial exchanges, prediction markets that list sports event contracts. And that is basically a more fair way to trade sports events. So what we would say is it's not really a question of is it gambling or is it not gambling. Gambling doesn't apply to the product. It really describes to the way people interact with the product. What's important is that this is a more consumer-friendly, more responsible, more trustworthy, and high-integrity way of structuring sports markets.
So the main difference is that in gambling, as it's defined traditionally, there is a house, and it is less fair. And in predictions markets, it is peer-to-peer. There is no house, and so inherently it is more fair because it's consumer to consumer. So if it's behavior and sort of how you interact, I mean, there have been lots of studies that there are algorithms in these markets distorting what the odds are. I mean, how can you say that it is more fair on a predictions market as opposed to in traditional gambling?
Yeah, let me just simplify this. I think if you wanted to place an $100 trade on, let's say, the Knicks to win the championship, if you were to go to a casino or a sports book, they would give you a price, and your only option is to take it or to leave it. On a prediction market, you have thousands of participants, both retail and institutional, competing to offer you the best price on the market. So as a result, you as a consumer get better odds. You'll win bigger, whether it's against a sophisticated market maker or an everyday Joe Schmo user. What we essentially are doing is cutting out the middleman, creating a 2-sided marketplace that is essentially structured the same way equities markets are or futures markets are. And as a result, it's a more level playing field. It allows people to compete on equal footing rather than giving a structural advantage to the house or to the casino.
The argument, though, that it's more fair and so therefore it shouldn't be considered sports gambling, I mean, I don't know, if you're a state, you would say, well, if we provide studies showing that it's not more fair because of the entrance of institutions who know how to game the system or algorithms, then that argument would go away that it's not more fair. So then, therefore, does that become gambling? Is the definition because it is more fair?
Again, I would say the question of gambling is about consumer behavior. People can gamble in the stock market. They could say, I'm going to put $10,000 randomly on an equity. I would say that's gambling. That would not make the stock market itself a gambling product. Prediction markets are event contract markets. They're futures markets that list sports events, and they let users buy and sell contracts on sports events. So I would say there's not anything inherently, gambling about prediction markets. It's about consumer behavior, and the traditional way of structuring sports betting, the casino model, I'd say is more susceptible to irresponsible trading. Basically, I would say that there's responsible trading and irresponsible trading, and a responsible platform encourages and facilitates responsible trading and prevents irresponsible trading.
So at Novig, for instance, if you see somebody who's repeatedly entering contracts, would you tap them on the shoulder and say that's no longer responsible? And so that you're entering the gambling territory as opposed to what you call responsible behavior on predictions markets.
Yeah, we are very proud to, I think, be a leader when it comes to responsibility, to trust, to integrity. We're the only prediction market that is 21 plus. And in many ways, we have restrictions on irresponsible types of behavior on the platform to ensure that people aren't abusing it. But I think the fundamental issue is that on casino platforms, the elephant in the room is that they make money when their users lose money. Prediction markets are agnostic to the outcomes of events, and as a result, they are structurally more fair because they're just a peer-to-peer marketplace that facilitates trading.
Okay. We got to leave it there. It's a longer conversation. It's fascinating. Jacob, thank you very much.
Yeah,
Jacob,
thank you so much for having me.
Of Novig. Up next, what's at stake for the resurgent software industry ahead of key earnings from Salesforce next week? Closing bell overtime, live from the NASDAQ market site. Be right back. Let's get you set up with tomorrow's trade today. It's just BJ's Wholesale on the earnings calendar. And on the economic front, we will get the August S&P Global Flash Manufacturing and Services PMI reports. And looking ahead to next week, the biggest report, of course, is NVIDIA, but the focus will also be on software with CrowdStrike, Salesforce, Intuit, and Workday among the names reporting. The IGV software ETF has staged a comeback that's up 26% in 6 months. But these earnings will be a big test for that rally. Let's bring in Seema Moni now with more on software. Seema.
It absolutely will, Melissa. This whole rebound will be tested by what Salesforce delivers for the quarter. If its AI platform Agentforce is Unable to show a meaningful pickup in enterprise customers, the street will likely ask tougher questions on the scale of future buybacks, the spending on agent force, and whether it's got the right executives in place to lead this turnaround. Just 2 weeks ago, CEO Mark Benioff made changes to his leadership team. Now, CrowdStrike has seen a huge run-up in its stock, meaning expectations are high. Yes, sure, it's cybersecurity, bigger risk with increased interest in managing rogue AI agents. But the question, Melissa, is whether it's translating into bigger contracts with American business. So far this earnings season, annual reoccurring revenue beat expectations have come in at the highest level in 4 years, according to RBC Capital, a sign that not all software companies are vulnerable to being displaced by AI. That will be the key metric to watch when Intuit, Workday report next week. Both stocks have been hit by SaaS apocalypse fears. For Workday, investors will want to know if it is in fact throwing in the towel and getting acquired by private equity firm Silver Lake for over $40 billion. That's according to a report, and whether that, Melissa, becomes a bigger outlet for software.
Yeah, and it is striking, Seema, if you take a look at some of these names within software since April lows, a lot of them are up. You know, it could even be 100% in the cybersecurity sector. And so, you know, you wonder how high the bar could be going into this quarter.
Absolutely. Bar is high for certain subsectors within software, to your point. Cybersecurity, very much the case for Palo Alto and CrowdStrike, even SentinelOne and Fortinet. Some of those names that live or operate in that mid-cap software security space. But the question is at hand, how much is the frontier labs and their ability to move so fast, the security risks that come with that, is that creating a bigger opportunity for them? Do they have the tools in place to defend against those attacks? I think that level of granularity is what we want from these earnings calls.
Yeah, and if they're seeing any inflection when it comes to revenue because of AI,
Right.
I think that there is an expectation that they will get business. And the question is, do they actually have business because of AI hacks?
Right. And you know what? Even early on, one of the big questions was when Anthropic came out with one of its latest models, we saw all the cybersecurity names respond negatively because the concern was, well, if you have these robust models coming to market, only Anthropic and OpenAI will know how to fix those agents, not the cybersecurity companies. That narrative has certainly changed in recent months. But again, the numbers will give us the real story.
Yep. Seema, thank you. Seema Modi. That does it for Overtime. Fast Money starts right after this.
It's the final trading day of the week. Whether that turns out to be Friday fever or fervor, we shall know soon. You're watching Power Breakfast right here on CNBC TV 18 in the Mumbai News Center. I'm Hormas Fatakia. With me, as always, Rashna Thanrajani. Rashna, good morning to you.
Good morning. Let's get through the headlines then this Friday morning. Tensions in West Asia continue. The US warns Iran of toughest sanctions in history, urges China to get with the program, while Iran brands the proposed sanctions as economic terrorism.
A sharp pullback on Wall Street as Treasury yields continue to rebound despite the buyback intervention from the US Treasury. The Dow marked its worst day since the 29th of July, falling 700 points, while the S&P 500 and Nasdaq are on track to snap their 3-week winning streak.
Asian markets too trade lower following the weak handover from Wall Street, with South Korea's Kospi leading the losses. The GIFT Nifty hints at a flat start on the street.
Oil prices rise above $93 a barrel and are nearing 94 now, and is on track to post a second consecutive weekly advance after US-Iran tensions show no signs of abating. Gold is also set for its third straight weekly advance as investors turn to safe haven metals amidst heightened volatility across the currency and the bond markets.
HDFC Bank raises a record $1.75 billion via overseas bond sale, among the largest by an Indian bank recently. A twin tranche issue with $500 million raised via 3-year bonds at 5.159% and $1.25 billion via 5-year bonds at 5.401%.
Well, looking at what Wall Street was last night, Asia is fairly okay, if you could call it that. And it's not the kind of sell-off that you witnessed on Wall Street last night. The Hang Seng is up 0.5%. And the Taiwanese index is also trading above the flat line. The Nikkei and the Kospi are the ones where the action has been taking place all through the last couple of months now. And the Kospi has been held around by the Samsung and SK Hynix, both of them trading with gains. And that's why the Kospi is in the green, while the Nikkei is down 0.6%. Samsung is about to announce $80 billion worth of shareholder returns in various forms. The board meeting is taking place today, so that's something that you have to keep an eye out for. The stock right now trading 1.5% higher. SK Hynix is up 3.5%. That's contributing to the Kospi not being in the red, while the Nikkei though continues to remain around 0.6% lower. And despite all of that, the GIFT Nifty 2 is indicating a fairly okayish start for our own markets as well. At 35 points higher, you take that considering the fact that bond yields are higher, oil prices are higher. We'll get to that in just a bit. But as of now, the implied open is suggesting a fairly subdued start now.
All right, a weak US handover, a mixed Asian trade, but a positive start for Nifty it may be. But tensions in West Asia continue. The US warns Iran of toughest sanctions in history, urges China to get with the program. US Treasury Secretary Scott Bessent tells CNBC that Washington will impose the toughest sanctions in history to collapse the Iranian government, while warning of tremendous consequences for any nation that maintains economic ties with Tehran. Listen in.
We are going to squash the economy of this murderous regime, which that will curtail their ability to project power through their proxies. It will mean that they cannot pay the military, and we have substantial inflation, both food inflation and ordinary inflation in Iran. And what we have seen, I see lots of reports that said, oh, well, this has never worked. It does work because we have a combination. It is a 1-2 punch. We have the blockade, and we are going to have the toughest sanctions in history. And I will tell you, this will work. It worked in Venezuela once we put up the blockade. It is working in Cuba right now, and it is going to work in Iran, and we are going to collapse this regime.
Meanwhile, Beijing has rebooked the American president's economic D-Day pressure campaign on Iran, asserting that further sanctions will not settle existing conflicts. Additionally, Iran's foreign ministry has condemned the U.S. threat of new economic sanctions, describing the proposed measures as illegal and inhumane, and branding the proposed sanctions as economic terrorism. Meanwhile, the U.S. Central Command reports that American forces enforcing the naval blockade on Iranian ports have redirected 67 commercial ships, disabled 3 and boarded 2 others. Oman says long-term security in the Strait of Hormuz depends on enduring regional peace, rejecting further escalation or conflict. But now to get us an update from the commodity space, how is all this action affecting Brent, crude, all of it along with the metals, is Manisha Gupta. Manisha Gupta, thank you so much for joining us and good morning. Take us through the update.
Hi, morning. Thank you for that, Rachna. I'll start with the crude oil prices because we're looking at a second weekly gain. Prices trading above $93 a barrel, and it's seen a 5% of a gain in this week itself. Well, as you were mentioning, the U.S.-Iran conflict shows no signs of abating. The U.S. now has proposed sanctions to cut Iran from international financial and commercial channels, and that really seems to be supporting prices. Add to that the fact that there are series of Ukrainian strikes on Russian energy infrastructure. That also seems to be causing fuel shortage. But yes, the precious metal prices have seen a lot of safe haven buying. So this week we have gold, which is up by 5%. Silver is gained 6% as well. Not so much of gains for the base metal prices as the near-term supply concerns ease. So has the metal prices as well. So whether it's about copper, aluminum, zinc for that matter, many of these metals are trading in the negative for this week. But this strength has just about continued for the agriculture space. Whether it is about Red Sea issues, weather, all of that really seems to be supporting prices. So you have cotton trading at a 2-year highs, rubber at a 2-month highs, and sugar, where India has now allowed raw sugar imports of 1 million ton. The global markets anticipate India to come, and that is leading the global prices also higher.
Manisha, thank you for that update. Sugar stocks have had a fairly decent last couple of days as well, and that is also showing up in the global markets as well. Let's set you up for today's trading session, though. Our research team is here. The stocks that should be on your radar, and of course, cues from the F&O side of things as well. As of now, the GIFT Nifty is indicating a fairly okay start for our own markets, and finally, after 7 days of losses yesterday, the index finally managed to end in the green. Not just in the green, it also managed to arrest this 12-day streak of making lower highs every single day, and that was also something that the bulls will take a lot of comfort from. The futures and the spot price differential currently also around about 60 points. That's also been a constant over the last few days. The other positive yesterday was the fact that we managed to defend that 100-day moving average on the downside. We spoke about 23,920 being that 100 DMA. It managed to defend that. It managed to defend 24,000, and it managed to move higher as well. The only negative, if you would want to call it that, is oil. And although prices are seeing a bit of a cool off right now, they are still close to the $94 a barrel mark. NYMEX 2 or the WTI is nearing 87, so they continue to remain elevated. That is something that needs to be watched out for. Now, for today's date, if we do manage to cross this week's high, which is 24,360, that will be viewed very positively by the street. Of course, we are still around about 130 points away from that, but that's one good session, and that's what the index needs. 24,360 is that level on the upside, and of course 24,000 on the downside continues to remain a strong psychological support. The Nifty Bank continues to follow a similar trend. Buying interest at lower levels, supply emerging between 57,500 to 57,700 zones. Yesterday's high was 57,760 or something, but it managed to close below the 57,500 mark. So that level remains the most important one to watch out for. 57,491 is the level at which the Nifty Bank needs to close higher to post a weekly gain, and Nifty needs to close above 24,366, which is almost the same as this week's high. And about things to watch, of course, there are more block deals lined up today. More IPOs are opening for subscription next week. And of course, we watch out for sugar stocks, as Manisha was highlighting, and of course, whether the market takes note of the rise in crude oil prices. But for now, the GIFT Nifty is indicating a decent start. Interesting to see how this turns out, Rachna.
All right, let's go over to Ananya now, who will list out the stocks to watch out for in today's trade. Good morning, Ananya.
Good morning. So let me first start with HDFC Bank. So what happened is they raised $1.75 billion through its Gift City branch, its biggest overseas fundraise since the global financial crisis. Now, coming to Welspun Corp, they have secured its largest order of around 17,200 crore, that is $1.8 billion from global energy players for pipe supply from its US facility to be executed in FY28 and FY29. Tata Motors passenger vehicles has fully restored operation at Sanand plant after the flood disruption, with damage estimated at 35 to 40 crore rupees and no major financial impact here. Now, Niva Bupa, they faced a 6-month restriction from the regulator on adding a new business location over a compliance issue. Now, KIMS has entered into a 5-year operating agreement for elite hospitals. Indoborex will acquire 64.26% of Cronax Lab for 246 crore rupees, along with an open offer for another 25.79% share. Now, Amagi, they launched a block deal for around 5% stake, targeting about 600 crore rupees. Sattvic Green Energy has received a 190 crore rupee solar module order, while RailTel has secured a 164 crore rupee order from Western Coalfields. So watch out for these stocks today.
Ananya, thank you for that update there. Lastly, Sudarshan joins in with cues from the F&O space, who breathed a sigh of relief yesterday because the Nifty ended higher. He's hoping that it continues today, but is the data indicating that? Sudarshan, good morning to you.
Good morning, Hamas. So, F&O segment, it's that segment in which almost 88% of the people who trade make losses as per SEBI in FY26, but that too was lower than the percentage of losses that we had seen in FY25, where it was around 91%. Now, yesterday, what exactly happened? Why did we manage to hold on to the levels above 24,200? And that can be attributed mainly to the aggressive put writing that we have seen above the level of 23,950 to as high as 24,300. And the aggressive put writing was so huge that if you compare with the volumes of call buying and put writing, the put writing volume on 24,200 was around 1 crore shares, while call buying around 24,350 was just 5 lakh shares. And that was one of the reasons why did we sustain at the higher levels. Now that's reflecting in Nifty PCR also. Put call ratio has moved above the level of 1, and yesterday it was 1.12 versus 0.81. One problematic part is FIs continue to add position on the short side. But if you try to take positive out of that also, the quantum of addition yesterday was lowest in last 8 trading sessions. Another negative part for us is the crude. While it's been steady in the last 24 hours, but it remains elevated, Brent continues to be around $94 per barrel. So yesterday, FIs in the index futures, they were minor sellers, but in the stock futures, they have done buying of almost 3,200 crore. Longs, they have reduced by 500. Shorts, they have added by 1,800 contracts. Put and call options, I have told you, put side 24,200 and 24,250. On the call side, 24,350 were the most active ones. So first support around 24,160. Rest is 24,350. 3 stocks are in the band: Bandhan Bank, SAIL and Manappuram. Some of the stocks that I'll keep an eye on. First one is MCX has been seeing addition on the long side. Glenmark also yesterday has moved almost 4% higher and has seen addition on the long side. And Premier Energies has seen short covering.
All right. Thank you so much, Sudarshan, for that update. But now let's slip into a break. Up next, we get you all the cues from Wall Street on the other side.
The U.S.
Welcome back. You're watching Power Breakfast on CNBC TV 18. Now, in the U.S. market, Wall Street ended lower on Thursday as Treasury yields climbed higher. Walmart weighed on the index too, missing on the comparable sales despite a revenue beat. CNBC's Seema Modi gets us a wrap of all the action.
U.S. markets all closed lower Thursday as Treasury yields continue to inch higher despite the Treasury Department's debt buyback operation. The Dow shed 704 points. S&P 500 was down 67 points. Tech-heavy Nasdaq dropping 1%. Treasury Secretary Scott Bessent told CNBC Thursday he plans to increase the size of the government debt buyback and that it could go higher than the already announced $4 billion. His comments briefly eased yields, which had largely reversed after Wednesday's announcement. The Treasury Secretary also said that there's a very good chance that the U.S. budget deficit has peaked. The monthly U.S. budget deficit topped $432 billion in July, its highest level in more than 5 years. And Walmart was one of the biggest drags on the Dow Thursday, despite reporting a revenue beat. Investors appeared disappointed in the company's quarterly comparable sales miss, which came in almost 1 full percentage point below estimates for the first time in more than 4 years. The country's largest retailer also raised its full-year guidance, but that's likely due to the $2.9 billion in tariff refunds they were eligible for, most of which was received in the just completed quarter. That's what's happening here in the U.S. Back to you in Mumbai.
Seema Modi, thank you for that update there. On that note, let's in fact listen into the exclusive interview to CNBC where U.S. Treasury Secretary Scott Bessent said that a debt buyback program announced on Wednesday could be larger than the upper limit of $4 billion. He added that there is a very good chance that the U.S. budget deficit under President Donald Trump has peaked. Listen to what he had to say.
We're trying to signal that we think that this is a thinly traded area of the market, that we're in August, and there's been a lot of corporate issuance that's influenced the market, and we believe that there are many underlying factors that the market is not looking at, and we are going to make a market in these. We routinely do buybacks, and we're going to increase the size of the buyback. And Sarah, I would note that it could be more than the $4 billion per issue.
All right, let's slip into a break. Up next, we'll get you all the details on HDFC Bank's record bond sale.
Sanctions relief.
Welcome back. Now, HDFC Bank has raised a total of $1.75 billion through a twin bond sale to overseas investors, the largest debt capital market fundraise from an Indian financial institution as it aggressively collects dollars to support its FCNRB deposits. And since Ritu was here in Mumbai, even they thought, let's do something more important. She's here bright and early to tell you something more. Ritu, good morning.
Good morning. Well, yes, HDFC Bank has raised this mega $1.75 billion overseas borrowing in what is the largest such issuance by an Indian bank since the global financial crisis, at least in recent memory, topping that $1.25 billion that State Bank of India had raised. It's in two parts. $500 million is going to be through 3-year bonds and $1.25 billion through 5-year bonds. The 3-year bonds will carry a coupon rate of 5.159 and the 5-year at 5.401. Now, the bonds have been issued through the bank's GIFT City branch. And in terms of pricing, we understand that the 3-year bond was priced at 88 basis points above the 3-year US Treasury yield and the 5-year bond at 100 basis points above the similar US Treasury, both far tighter than the initial guidance that the bank had. And that shows you that there was pretty strong demand as far as investors are concerned. Now, this, remember, is the second such borrowing from the bank after they'd raised that $750 million odd in the month of July through overseas or offshore borrowing. So the total borrowing by HDFC Bank now goes to about $2.5 billion in under 2 months. Now, this, of course, is coming after we heard from the Reserve Bank of India that it was closing that special FCNRB window a month earlier by the end of August. And that, of course, has prompted a bevy of banks to accelerate both foreign currency fundraising and their efforts to mobilize more deposits from NRIs before the window closes. So multiple private and public sector banks have tapped this overseas debt market in the recent days. Most recently, you had ICICI Bank with a large raise, IDFC and Kotak. All of them have been coming to the markets and expect even more in the days ahead.
All right. Thank you so much, Ritu, for that update. But now Delhi has a new blueprint for how the capital city will grow over the next 2 decades. Master Plan 2047 envisages more homes, a major expansion of public transport and potential congestion pricing to reduce traffic. Shivani Bazaz is here with more.
Well, yes, there are some very significant changes being proposed here in the Delhi Master Plan 2047. The first is housing, clearly. Delhi could need around 40 lakh additional homes by 2047. The plan proposes redeveloping and densifying existing neighborhoods while also developing new areas through planned greenfield development is what the government has said. Now, second is a major push on public transport. Delhi's existing 416-kilometer metro network is proposed to expand by another 279 kilometers, while the RRTS network could reach around 383 kilometers. The larger objective is to prioritize public transport, walking and cycling, and reduce dependence on private vehicles in the national capital. Third, Narela could become a new knowledge and innovation hub. The plan proposes 138-hectare educational hub, bringing universities, research institutional vocational training and startups together in this area. Fourth, the environment gets a major place in the blueprint. The plan proposes strengthening Delhi's green network, including forests, biodiversity parks and ecological corridors, while also focusing on the restoration of Yamuna wetlands, lakes and other water bodies in the national capital. And finally, which is interesting, is the congestion pricing. The plan provides for identifying congestion pricing zones where vehicles entering congested areas could face a charge. Areas around TOD nodes, the World City Heritage Zones and Metropolitan City Centre may be considered, with RFID tagging among the technologies mentioned for implementation of these charges. But officials here clarify that this is not a final decision right now. They say congestion pricing could be taken up if necessary to decongest the city, and any such move would involve proper consultation with the stakeholders. So all in all, these are the 5 highlights of the broad and deeply researched Delhi Master Plan 2047. Back to you.
Shivani, thank you for that update there. We take your leave on this note on Power Breakfast. From Rachna and me, thank you for watching. Bazaar Morning Call on the other side sets you up for the day's trade.
P retains its
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Friday morning. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. It's looking a little dull and down, I must say, if you look at some of the macro indicators. That's where we are at. We're coming to you from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel and Reema. Guys, hi, morning.
Hi, morning. Hi, morning. So crude is spiked back. It's now closer to $94 per barrel, and the US bond yield too have spiked back from the levels that they'd retreated just in yesterday's trading session. So those are the macros. But finally, we had 7 days of losses, and yesterday markets bounced back, right? So that's the Friday we're going to latch on to.
Well, that's right. And post-market is going to be even better. But for the time being, we have got a day of trade to look at. So Prashant, take us through the action.
Yeah, absolutely, Nigel. And, oil still, the macro indicators are all sort of stacked up in the wrong way. So almost 94 on oil. So that is point number one. So last night, oil prices went up 2.5%. Is there really new news flow? Not exactly. So US is essentially saying that they're going to impose a tougher sanctions on Iran. It's urging China to back its move, essentially saying that stop buying Iranian oil through shadow fleet, etc. Chinese, some commentary coming in from spokespeople in the Chinese government saying, well, they're not interested and they will continue to buy Iranian crude. They're not sort of, backing off on the threat of sanctions, etc. US, of course, trying to get its allies to come together on this as well. So we'll see. But as I said, it's not very much in terms of news flow. If you're looking for reasons why oil is now at 94, not 91, there's not very much. Now, US equities were lower. So the S&P was down almost 1%. The NASDAQ was down about 0.75%. And so that is point number two. And point number three, and I think equities were also down because of the move that we saw in bonds, right? So bonds sold off. Yields climbed up once again. This is important because the 10-year will come up, the 30-year will come up, the long end is rising once again. This is important because, over the last 24 hours, we've heard U.S. Treasury Secretary Scott Bessent coming on and saying that we are going to be buying in every purchase of U.S. Treasury bonds that we buy back. We're increasing the tick size from $2 billion to as much as $4 billion, right? Every purchase is going to be not 2, but 4 billion. So they're saying we'll buy a lot more starting September. But guess what? The impact did not last even for 24 hours. And that's the move that you saw. The 30-year, about 6 basis points higher to 5.25. I think the recent high was about 5.31 or so. So U.S. Treasury Secretary Scott Bessent went back on CNBC last night, and he said a bunch of things, right? He said that he was basically referring to the rise that the question was about the rise in U.S. bond yields on the long end as he was on air. And he said, well, anything that happens within a 24-hour period is noise. We have a big toolkit, so we'll see. And he said a bunch of other stuff. And then he said that we are announcing that probably at the end of this week, beginning of next week, an increased focus on fiscal consolidation. So maybe today evening out of the US over the weekend or early next week, something with regards to consolidating the fisc. Now, if you remember, Treasury Secretary Bessent, in his past life, is essentially a financial markets person. And when he was made Treasury Secretary, markets rejoiced, essentially because he, of course, more than anyone else out there, understands that fiscal consolidation is important if you want the cost of capital to be well behaved at a sovereign level. And of course, none of that has happened because and that was the expectation initially with President Trump taking in as well, that the dollar would strengthen and all kinds of things. But none of that has materialized. Deficits have continued to expand at the pace or perhaps even slightly more compared to what it was under the last president. So I think, you can read the latest comments from the Treasury Secretary to say, and by the way, he said something like, the markets don't have full information. I have asymmetric information. I know more. Markets are wrong. And that always kind of makes you a little uneasy when you've got people in charge essentially saying that the market is wrong. And we know where prices should be. In this case, not stock prices, but bond prices should be at. And I think it's a slightly uneasy feeling. I would say that, the way especially global markets have been trading, and they've been trading poorly, is also, of course, because of the fact that the long end of the curve in the US is rising, not just in the US, by the way, across the developed market is rising. Actually, this matters not just for bonds, but even for equities, right? I mean, everything. The weighted average cost of capital, DCF, everything basically at the end of the day takes in, bond yields as an important factor. So I think it's worth watching in terms of where we finally settle. But I think we've got to watch this very closely. I'll just come back to some stocks, right? Walmart, which is, of course, a bellwether for consumer sentiment, consumer demand, that fell 9%. They posted their weakest quarterly showing in over 6 years. The CFO said that lower income shoppers are making choices between necessities because of rising gas prices, right? That again talks about essentially high gas prices at the pump that retail consumers are paying because of what's happening, of course, in Iran. And of course, US policies, etc. So all of this, of course, is linked and is important to note. I'll just tie in the levels here. The market, of course, yesterday saw a bit of a move on the other side. And as we were highlighting yesterday, that the market is oversold, extremely oversold. So a bounce is possible. It was not a big bounce or anything. It was a decent-sized bounce. But these are levels. 24,200 is the first support level. 24,086 is the next one. 24,200, the immediate one. 24,086 next. And on the upside, on the falling channel, the resistance is 24,340. So that's the those are the numbers that we are working with this morning. GIFT Nifty will come up on your screen, gives you a quick sense of how we are starting. It's kind of undecided, non-committed, 26 odd points high. Nigel has walked across to the wall with the F&O positioning and the cues. Nigel.
Well, it was good to see a good relief rally that we saw in yesterday's trading session on the Nifty. The worry, though, is that Brent crude prices, they continue to remain elevated. And in fact, the yields, US 10-year yields as well, that cooled off in the previous trading session, that's back at around 4.7%. The good news, though, is that the dollar index that was threatening to run away when it went to around 101 odd, that's cooled off to around that sub 99 odd level. So that's basically a bit of a mixed picture. But, going by all the sound bites and, all that we're hearing globally, it'll be hard to imagine actually that Brent crude prices get past this $100 per barrel mark. At least that's the hope. So let's see how that goes. Moving to the flows, the DI flows, well, they were solid in yesterday's trading session. Need to account, though, there were a couple of large trades, so bulk of that could be on account of that. While the FIs, they were marginal sellers. Net institutional flows could be positive in yesterday's trading session. Moving to the options data on index futures. We did see some mild short positioning getting added, close to around 2,000 contracts on the short side. Short positioning holding at around that 91% or thereabouts. But on, if you look at it, the clients, they are net long on index futures. And we made this point yesterday. We got a bit of a pop and they unwound some long positions yesterday. Close to around 12,000 contracts were unwound, though they continue to remain aggressively net long. So clients net long, FIs net short, not a bad combination, as I always say. Moving to what else the FIs did in the F&O market. Well, on stock futures, they added close to around 50,000 contracts on the long side. So that's telling you that, in fact, stock-specific action will continue and stock-specific long bias will continue even in this sort of a market that's moving more or less sideways for quite a bit. On the option side, the FIs yesterday, they went ahead and they wrote puts after a while. So they wrote puts rather aggressively. Close to 1.4 lakh contracts were written. And the calls that were written earlier, they had to pack their bags. They had to get out of the market because the markets moved up with a good amount of velocity from oversold levels. Which tells us that, in fact, in yesterday's trading session, the 24,100 call, out there was big unwinding. 65 to 70 lakh shares were unwound out there. So those call writers, they were trying to get out. While on the put side, the 24,200 put, it added close to around 70 lakh shares thereabouts, and the premium holding at around 50 to around 60 rupees or thereabouts. Which brings us to the levels. So 20 DMA, that's the line in the sand on the upside. The first resistance level comes in at around 24,350. While support zones that I've been talking about for the recent past as well, 23,950 is extremely important on the downside. And the recent low, 24,026, you'll want that range to get defended on the downside. So we start with a bit of a positive bias. I think at some point of time, we go into the red, but this 400, 450 point band continues on the Nifty. The stocks will continue to do a thing of their own.
And trading with the positive bias are also the Asian markets this morning. No big runaway gains, but you've got the Taiwanese market with Hang Seng is the one with a gain of about 3/4 of a percentage point. Kospi Taiwan mildly in the green. But as I said, no runaway gains, but it's positive. But let's get back to the big story, and that's the concern surrounding the rising U.S. bond yields. In an exclusive interview to CNBC, U.S. Treasury Secretary Scott Bessent said that the debt buyback program, which was announced on Wednesday, could be larger than the $4 billion upper limit. He added that there is a very good chance that the U.S. budget deficit under President Donald Trump has peaked.
We're trying to signal that we think that this is a thinly traded area of the market, that we're in August, and there's been a lot of corporate issuance that's influenced the market. And we believe that there are many underlying factors that the market is not looking at. And we are going to make a market in these. We routinely do buybacks, and we're going to increase the size of the buyback. And Sarah, I would note that it could be more than the $4 billion per issue. I think that there's been a lot of misinformation in terms of what's going on with the deficit, what's going on with the deficit to GDP. We actually had a fiscal consolidation for the calendar year 2025. We were at about 5.7% of GDP. And one of the things that's temporary here that's influencing the deficit has been these tariff refunds. And we won't have to do that again. And the Ambassador Greer, through the 301 process, is re-implementing the same level of tariffs. And I would expect that our 2026 tariff income is going to be roughly what it was in 25. And we're going to be able to keep that in terms of the budget consolidation.
So do you think we've seen peak deficit during this administration?
I think a very, very good chance we have.
Well, the Scott Bessent interview or the planned intervention didn't seem to have any impact on the markets. The relief was short-lived because yields spiked back up to 4.7 on the 10-year, while the 30-year went back to levels of 5.25. So pretty much erased the gains that it had in the prior session. Arvind Sanger, managing partner, Geosphere Capital, is now joining in. Arvind, what's the U.S. bond market telling us, and how concerned should an Indian investor, equity market investor, be about what's happening in the U.S. bonds?
Well, first of all, what's happening in the U.S. bond market is that the bond market is having a hard time digesting the amount of issuance that is being done by the U.S. Treasury. And with the major central banks around the world not participating in a meaningful way, this has become more relying on financial types, hedge funds and others, to finance that. And the reality is that hedge funds and others are looking for higher yields to compensate for this, and so interest rates or the yields have been climbing, so the cost of borrowing is going up, and I think the one-day relief rally when the U.S. announced buying long end didn't last very long, and despite Secretary Bessent's talk about doing even more, the reality is everybody knows that the deficit is still high, and if they're buying the long end, that just means they're issuing even more on the short end. So, I think people are saying, show me the money, show me what Bessent is saying, which is we doubt that the deficit is going down. We'll wait and see. If it turns out to be true, then maybe yields settle back down. But if it doesn't, then yields are going to keep climbing.
Yeah, absolutely. The thing is, these things typically settle down, right? Sometimes you have flare-ups, Arvind, but we can go back so many instances in the past, right, where it looked like this is it, this is the moment of reckoning, and then it's not. It's usually not, right?
Well, it's usually not, but if you look at the reaction of gold and Bitcoin, what you will see is that people are now recognizing that, if the U.S. is practicing what is sometimes been called financial repression by trying to artificially influence the market from keeping rates from going up, which is understandable because they don't, they want to try to minimize their borrowing costs. The reality is, you can press the balloon somewhere, but it's going to, if you squeeze the balloon somewhere, something else is going to bulge. And what you're seeing is people realizing that maybe with oil going up, there doesn't seem to be anything structural that is going to keep oil prices down as long as the standoff between Iran and U.S. continues. So you've got that as an inflation tailwind, notwithstanding the July benign data. Inflation is headed higher. Deficit doesn't look like it's coming down. And if the U.S. government is, pumping money at the long end, then it's trying to buy non-dollar assets like gold and, and hard assets And frankly, emerging markets should benefit from U.S. Printing money to buy the long end of the curve.
Arvind, what's the view now on India? Earnings season done, a pretty good showing. But on the other hand, crude prices are much higher than where they were 3 months back.
Well, it's that old Ajit saying of liquid oxygen. You don't know whether it's going to kill you or make you stronger. But the reality is that India has two problems. One is the rising, not just oil prices. I like to remind people that diesel in the US right now is over $190 a barrel. It's a little bit less in Asia, but not that much less. Gasoline is over $160. So you don't consume crude, you consume refined products as a business and as a consumer. And those are extremely high. And I think oil is going to keep going up. And of course, those refined products are telling you that things are extremely tight. So that's one problem for India. The second problem is monsoon has been deficient. And it looks like there's a strong El Nino end to monsoon, which could cause it to stay deficient, which means that you have inflationary forces that are going to be a bit of a headwind. But like you said, this was a great earnings season. It was one of those where the mid caps and the small caps did even better than the large caps in terms of earnings growth. So you've got these two competing forces. And I think just as things were starting to look very rosy on the bottom-up earnings growth story for India, you've got these two flies in the ointment. So I'm constructive, but I'm cautiously constructive because of these two macro factors that could be a bit of a headwind short term.
Got that. Fair enough. By the way, you mentioned gold briefly. You think now's the time to sort of accumulate gold?
I have not been a gold bug in my career, but there have been three major catalysts for gold, and this was the fourth one. The first one was the Russian treasuries being frozen by the U.S. The second was U.S. trade war, Liberation Day, which caused other countries to worry about U.S. reliability. The third now is the Strait of Hormuz, and it looks like Iran is in charge, and that makes the petrodollars that the Persian Gulf countries were putting into U.S. treasuries quite suspect how much they will continue to do versus put money elsewhere. And now the fourth one is that the U.S. yields blowing out is causing the U.S. Treasury to do a bit of a panic step. So I think gold is absolutely, in my opinion, has to be a core part of holdings. We've added to gold in the last few weeks, gold equities, because we are very bullish on gold as a secular play driven by geopolitical factors.
Got that. Arvind, we'll leave it there. Thank you very much for joining us. Always a pleasure having you here on CNBC TV 18. And
thank you.
Have a good one. Thank you. Let me just quickly run you through what's lined up here on the program. So 8:35, we have the management of Welspun Corp to talk about the order win, US pipe order win, and the road ahead. Stocks done phenomenally well. 9 o'clock, Sandeep Agarwal of Sovilo Investment Managers is going to focus on the IT space. 9:20, Vikas Khemani of Carnelian Asset Management will be a market master of the day. 9:35, the management of KFin Technologies speaks to us post the company's 1,400 crore block deal. Following that, we'll get you a discussion around government allowing duty-free sugar imports at 9:45 and 10:15. Lata in conversation with agricultural experts, Ramesh Chand, on whether the use of ethanol as fuel may hurt farmers. And of course, the environmental impact therein as well. Stay tuned.
Well, time to slip into a short break. On the other side, we go full tilt on stocks that we're tracking for you. Tata Motors PV, HDFC Bank, Welspun Corp, Kims, Sattvic Green Energy, all of them will be reacting to positive news flow. Add to the list, Railtel Corp as well. On the flip side, Sugar Mills, Niva Bupa, Amagi Media Labs, they'll be reacting to negative news flow. And expect a mixed reaction coming in on Interglobe Aviation. Take that break, come back, we get into further detail on all of these names.
Wait for a boat.
Symbiotic Pharma Lab Limited proposes an initial public offering of its equity shares. The 100% book build offer is being issued at a price band of rupees 938 to rupees 988 per equity share of face value of rupees 2 each. Offer opens on Monday, August 24th, 2026. Offer closes on Thursday, August 27th, 2026. For risk involved and other details, please refer to the red herring prospectus and addendum, which is available on the websites of the company, the SEBI, the BRLMs, and the stock exchanges.
Welcome back. It's a Friday morning and it's time now for CNBC TV 18's list of top stocks for the day. Good morning, everyone. Sudarshan, why are we watching Indigo today?
So we have got domestic air traffic data for the month of July. And if you just talk about the domestic air traffic, we have seen that it's been falling for second straight month. In the month of June, it was down 12% month on month. Now it's down 11% again in the month of July. And if you compare year on year, it's down 5%. And July 2026 total air traffic is the lowest that we have seen in last 4 years. It's the lowest since November of 2022, and even just July month, July is also the lowest since 2022. And if you talk about Indigo, while its market share has increased to 67%, but the number of passengers who have traveled through air has come down significantly in the last 2 months. And another concern for Indigo remains the crude price, which remains elevated. Brent is now at 94. That's the reason I'm going with yellow color.
Got it. All right. Thanks a lot for that, Sud. But busy man as always. You're also tracking a couple of companies from the auto pack, Tata Motors PV. Tell us more.
That's correct. So remember, after Q1 FY27 earnings, company had announced that it had faced the production disruption due to a flood in Gujarat, and especially at Sanand unit. Now the company has given some details about the impact of that, and the biggest positive part is that production at company's plant and the suppliers' plants are back to normal. As far as the impact is concerned, damage impact is very non-material. Total impact is seen in the range of 35 to 40 crore, and insurance claim almost covers the 90 to 95% of the total amount, that is 35 to 40 crore. But the important part of production being back to normal, and that's one of the reasons I'm going with green.
Thank you very much for that. Sugar stocks were very excited yesterday. Ria joins in with the latest news on sugar mills. Ria?
Well, yes, yesterday the government has allowed 1 million tons of raw sugar to be imported duty-free until the 31st of October this year. And this is because the government is trying to bring down the record high levels of sugar prices that we've seen domestically in the recent months. Now, sugar mills and refiners with functional capacity to convert this raw sugar into white sugar will be able to apply between the 21st to the 28th of October, August for this, for the tariff rate quota that allows these imports at zero duty. And preference will be given to importers that undertake to complete imports by October 15th. Now, after this announcement, the benchmark white sugars in London and the raw sugar futures in New York jumped by as much as 4% after this announcement came in. And some reports are also suggesting that India is likely to import a large portion of this from Brazil, which can take nearly 2 months. And domestic supplies will then be boosted from October onwards rather than an immediate boost that most people were expecting. And in terms of the impact, this can cap the domestic sugar rally that we've seen of late, and sugar mills can also see a slight hit to their margins in the near term, but still the domestic prices do remain high up until now. And although on the stock front we can see some profit booking after the rally that we have seen yesterday in sugar stocks.
Okay, all right. Thanks very much for that. Well, let's talk about more stocks with news flow. Ananya is here with that list. Ananya, morning.
Good morning. So let me first start with HDFC Bank. So they completed $1.75 billion bond issue through its Gift City branch, making it one of the biggest overseas fundraisers since the global financial crisis year. Now, coming to Welspun Corp, they had secured its largest ever order of around $1.8 billion or 17,200 crore for pipe supply from its US facility. The order is to be executed over FY28 and FY29. Giving the company strong revenue visibility here. Now, Niva Bupa has been warned by IRDAI for not complying with the expenses limit in FY25 and has been barred from opening new business location for 6 months here. And finally, KIMS has entered into a 5-year agreement to operate REIT hospitals at 9% of net revenue, along with a call option to acquire the hospital in the future. So watch out for these stocks in today's trade.
Thank you very much for that. Over to Vivek now for more stocks in the news. Vivek.
Well, good morning. Once again, another block deal, recently listed name, Amagi Media Labs. So that particular company, there's been a block deal that's launched last evening. Total size of this particular block is close to 600 crore, implying 5% of equity is expected to change hands. The sellers are the early stage investors in the company, that actually had divested part stake in the IPO as well. So Trudy Holdings, AVP1 Fund, as well as Axel are the likely sellers in today's block deal. Floor price for this particular block is at a little over 4.5% discount to yesterday's close of 550 rupees a share. There is a 90-day lockup on further sale of shares after this particular block deal. Two news flows as well as far as two companies are concerned. Satvik Green has received an order worth 190 crore rupees. This particular order is for supply of solar photovoltaic cells and it's from an independent power producer. And lastly, keep an eye out on Railtel as well. The company has received an order from Western Coalfields. Total size of this particular order is 165 crore rupees, and this is for establishment of a VPN network on a rental basis for a period of 60 months for Western Coalfield.
Thank you very much for that. For Amagi, the IPO was earlier this week. Issue price was 361. The stock yesterday closed at 576. So from the issue price, it's given a return of nearly 60%. Those are details of the block deal Vivek was telling us earlier. A quick recap then of the top stocks. Stocks with positive news flow are Tata Motors Passenger Vehicle, HDFC Bank, Welspun Corp, Kim, Satvik Green Energy, Railtel Corp. Stocks with negative news flow are Sugar Mills, Niva Bupa, and Amagi Media Labs. Interglobe Aviation could open up mixed. Well, that's equities. What about commodities, where crude prices continue to rise? Manisha joins in with the details, and she's watching for the increase in gold prices too.
Oh, I am, yes. But I'll start with the crude oil prices because we're looking at a 5% of gain in this week, second weekly gain as well, and $93 per barrel seems to be holding. This is as the U.S.-Iran conflict shows no sign of abating, and the U.S. has now proposed sanctions to cut Iran from international financing and commercial channels. So while the crude oil prices have been gaining, so has been the case with precious metals, where gold is headed for a third weekly gain. And we're looking at a 2-month highs for gold and silver both, with nearly 5% of gains in gold in this week, while silver is up by 6% as well. But the gains clearly have continued in case of food prices also. You have cotton, which is trading at 2-year highs. palm oil at 20-month highs, rubber at 2-month highs, the Indian sugar prices near record highs, the global sugar prices at 15-month highs. So everything in agriculture also seems to be moving on the higher side.
All right. Well, Manisha, thank you very much for that. Thank you very much with that update. We'll talk more a little later. Now, HDFC Bank is raising a record $1.75 billion via overseas bond sale, among the largest by an Indian bank recently. We have Arup Rakshit, Group Head Treasury at HDFC Bank, now joining in to talk to us a little bit about this. Mr. Rakshit, good morning. Good to have you with us here. Thanks for joining in. Tell us about this $1.75 billion bond fundraise, largest in recent memory. What was the demand from investors like compared to your earlier issue, and what did you price it at? We understand it was 88 and 100 basis points above the US Treasury rate.
Yes, you are right. The demand from the investors was very, very strong this time. At its peak, the order book was $7 billion. Which was quite a significant one, and just shows the strength of both the Indian banking sector and obviously the investors' belief in the HDFC Bank itself. Yes, the pricing, you are right. It was for 3 year we got a T plus 88 basis, and for a 5 year it was T plus 100 basis. And in July we had raised the Reg S bond at T plus 90, but since then the spreads had widened with so much issuance out of India. But I mean, from a comparative perspective, if you see the other players where they have been raising, T plus 100 was well within what some of the people have raised in the last 7 to 10 days.
All right, got that, sir. But RBI's concessional window for overseas borrowings by banks is for a limited period after the $750 million raise. And now this $1.75 billion. Should we think of HDFC Bank as having substantially front-loaded its foreign currency funding for the year, or is there still some meaningful funding requirement left? Help us out with those details.
We actually approach it a little differently. We go up across and raise money when we see a customer interest in whatever form and shape. So we have always been doing these kind of transactions based on customers' demands and interest. So yes, we have raised about $2.5 billion already through the public bonds in this window so far. And it's too preemptive to say whether this is the last or there will be further issuances. As I said, it will be client-dependent, customer interest-dependent. Never say never.
Okay. Mr. Rakshit, how much of this $1.75 billion will be used to support the FCNRB book? How much can be used for overseas assets or lending? And how much is essentially liquidity, or balance sheet management?
So this has been raised in the overseas book primarily for the overseas balance sheet, which would, yes, there will be elements of FCNRB deposits leverage, which is there, the flavor of the day at the current moment. And we also have our overseas balance sheet to run, which as a percentage of our total balance sheet is not too large. But then there are requirements which come up there. It's not fair that I give a breakup of that, how much is for what. But let's put it this way, that it is for our overseas balance sheet, and it will be equally, I mean, it will be well distributed between the needs for the FCNR deposits as well as some of the usage for my overseas requirements as well, for other lending purposes.
No, got that. You know, the Reserve Bank has now ended the special FCNRB swap window earlier than planned because inflows were so much stronger than what was expected. How much have you raised so far, Mr. Rakshit, and what's the total FCNRB raise target the bank is hoping to get by the end of the month, by the time the window closes?
Let the thing end and then you can hear those numbers. So I think it's too preemptive for me to comment on the actual numbers that we have raised or we plan to raise. It's only a question of another 10 odd days. Once the window is over, I'm sure banks will come out with their numbers a lot more openly.
Yeah, but Mr. Rakshit, it's fair to assume that it may be larger than the $6-7 billion raised by some of your peers?
Let me put it this way. We are very much anchored in the way some of the larger players are in the market, rather than giving any specific numbers at this juncture.
Okay, and then one final question then. How does this overseas raise affect your cost of funds overall across domestic and dollar funding? So should we expect overseas borrowing to now become a structurally larger part of the bank's liability mix, or is this still opportunistic borrowing when pricing is attractive?
See, from a usage in domestic market, the FCNR deposit, obviously, with the hedge cost being borne by RBI, it becomes a 6.25, whatever rates that people are offering. That becomes a very healthy cost of fund deposit for the bank. And this also does not incur the statutory cost of CRR SLR. So this gives you a very healthy cost of fund from that perspective. With regards to how much more can we borrow or not, as I said, that's more of a overall balance sheet planning, and one keeps looking at opportunities and seeing how the local deposit rates would be versus what will be the otherwise the cost of funds kind of a scenario. But yes, the FCNR deposit gives a very healthy deposit rate as compared to other comparative deposit rates in the market.
Got that. Thank you very much, Mr. Rakshit. Really appreciate your time here, and thank you. Well, it's a strong raise, right? I mean, so if you look at order book, right, the amount of demand they got for the bond raise, they finally did 1.75. Mr. Rakshit said that the demand was about $7 billion, and they finally closed with and raised 1.75. We'll take a break. We're back. The management of Welspun Corp on the order in the US coming up in just a bit.
Appearances this week.
Symbiotech Pharma Lab Limited proposes an initial public offering of its equity shares. The 100% book-build offer is being issued at a price band of rupees 938 to rupees 988 per equity share of face value of rupees 2 each. Offer opens on Monday, August 24th, 2026. Offer closes on Thursday, August 27th, 2026. For risk involved and other details, please refer to the red herring prospectus and addendum, which is available on the websites of the company, the SEBI, the BRLMs, and the stock exchanges.
Welcome back. Hope you're having a good morning. Well, let's focus on one of the top performing stocks of this year. That's been Welspun Corp. So to help us out with details of a big order that they've got overnight, we have Mr. Vipul Mathur, the MD and CEO at Welspun Corp, who joins us. Hi, Mr. Mathur. Good morning from here in India. I believe you're in the United States, so appreciate you staying up for us. And congratulations on securing this largest ever single order, $1.8 billion of a single order, which takes your order book to 42,000 crores. Now, this gives a good runway in terms of growth from here on. But we want some details, Mr. Mathur, so that's why we invited you on the show. Tell us first, is this order related to data center gas infra capex, or is it the oil and gas export-related capex in the United States? Give us some idea.
Good morning, Nigel. Thank you for having on the show. And don't bother too much about the time zone difference. I think so we are all accustomed of that. But greatly appreciate you taking time out. Coming back to this order, I think so it is very rightly so. It is one of the largest order in the history of Welspun, and more important than that, I think so it's an extremely prestigious order, very very important for the company, and I think so it could not have come at a better time. I think so when the markets are we are seeing a growth in the U.S. economy in the energy sector. I think so it is completely reinforcing that, this the growth, what is happening and which we have been talking about it for a very long time in all our conversations is real, genuine, and it is a testimony of that. Coming back to this order, I think so this order is not for a data center. This is the Permian line. This is an export pipeline, which is for the export of LNG. And there is, as you know, that Permian is still the largest producing basin. And, there are multiple opportunities and multiple, projects at this point in time still being contemplated out there. So it is one of them.
Got it. All right, Mr. Mathur, fair idea then. So, and as you told us, in the United States, you're going at a run rate of 300 through around 350,000 tons, and you're adding another 250,000 tons. So the capex that you've laid out, that's sufficient to take care of this order. Would that be fair to assume, or do you need to put in some more capex? Point number one. Point number two, what kind of EBITDA margins will you be looking at? If you want to break it up for us, or you could tell us on an EBITDA per ton basis as well. Normally, you've told us that in the United States is elevated, $200, $300 per ton.
So on the capex side of it, I think so the capex what we are doing at this point in time of almost $250 million, that's pretty much on track. And those capex is definitely going to be used for executing this particular order, number one. Over and above, I think so we are also looking at, we have some scope of capacity augmentation in our existing capacity, which we are going to do that. Some debottlenecking we have to do, some capacity augmentation which we can do. These are the 2 or 3 things which we have clearly chalked out, planned out. And I think so by debottlenecking, some mild capacity augmentation, and all that in capex investment what we have done at this point in time, and which is all coming on stream. These 3 things put together will take us through this order execution.
And you wanted to give us the margin number as well. Normally you do mid-teens, on a blended basis. Something between, I think, 14 to 17% if I look at it over the last few quarters. Give us some details with regard to this order. Is it at better margins?
Nigel, I think so. Margin, generally we don't talk about margins on an order-to-order basis. I think so. What we always talk is all about the blended margins. Okay. Of course, this order definitely represents the margins profile what we always enjoy in US. It will be in the same zone. In
$250 to $300 per ton, very roughly. $200 to $300 per ton. You want me to give you a wider range?
I mean, that's the way it has historically been. Some quarters have been good, some quarters it has been much even more. So I think so, from a margin perspective, it is a fairly decent, respected margin business as one can expect in the American market. And but what it brings on the table, Nigel, is more important is that the complete business continuity and visibility till 2030. I think so that 3 to 4 years of run, the visibility of business for the next 3 to 4 years time, which is very, very important for, for us. I think so that is what addresses the question.
This is Mr. Mathur. Hi, good morning. Prashant here. Good morning. Good to see you and congratulations. This is a fixed, there is sort of cost increases, etc. built in. It's a variable. I mean, these would be variable price orders or fixed price orders?
Prashant, good morning. As you know, we have talked about it. In Welspun, we never do sort of a variable pricing order. These are all fixed price orders. These are absolutely project to project orders on which we have a complete backup of, for the steel. And we enjoy such a great partnership with the steel guys here in the US. And I think so they have been supporting us, on all these mega projects. And same is the case out here on this particular project. We have a complete support from our steel partners out here, and it's a fixed price contract. So there's nothing called variability. Everything is locked in.
Sure. Now from the US, Mr. Mathur, let me get you all the way to the other big area where there's, predictably perhaps a opportunity building, right? Which is the Middle East, Saudi, the Strait of, and this has been the big talking point, which is that, as the countries will want to build, pipelines circumventing the Strait of Hormuz, and perhaps it's an opportunity for you as one of the companies there, right? And I think we've spoken about this in the past. So there was this the Public Investment Fund, which is the Saudi sovereign fund, some $900 billion in assets, and they are responsible for executing a lot of stuff. They recently put out 10 days back. They put out their strategy document from FY 2026 to 2030. And I kind of sort of read through the synopsis of it. That document barely mentions anything, sir, with regards to oil pipelines or whether they want to do some stuff to build these pipelines out. I just wanted to ask you, how much should we read into this? Because this is the primary investment vehicle for the Saudi government.
I think so, Prashant. Somehow I have not had a chance to go through that document more in detail at this point in time. But but on the ground, I think so. What we are seeing is a very different thing, a different story happening around there. I think so. There is a huge demand, which is at this point in time is on a drawing board, and it is being conceptualized. I think so. It's just a matter of time that this demand will come up. With our positioning in Saudi Arabia, which was a very strategic positioning, what we had anticipated, and we have created a large-scale facility out there. I am very sure it's just a matter of time that this demand will start kicking in. And let's be practical. This is bound to happen. Whatever we may say.
There are lots of absolutely, and that's why I always asked you this, because there are lots of news reports, reported out of the ground in the Middle East. People who are there who are saying, well, this is being contemplated, etc. So, but this document just came out 10 days back, and this is from the government. So I thought I must ask you this. But what you're saying is it's a matter of time. It's a large opportunity. And what we're talking about is, essentially capacity augmentation to avoid shipping oil out from the strait, right? That's essentially what we're talking about here.
Exactly. They have to create multiple exit points. They have to de-risk completely de-risk the, production, evacuation of their production. So it is pretty natural. It is bound to happen. It would be, it would be just a matter of time here and there. But what we are seeing on the ground, when we are interacting with the authorities out there, and when we are in touch with the largest, user of those pipes, I think so. We are getting all very, very positive signals, and and we are very optimistic that that part of the geography also is bound to grow very exponentially.
All right, Mr. Mathur, final question before we let you go. Last year, in fact, it was a strong year. Last couple of years have been a little bit better, and this year you go to around 2,800 crores in terms of an EBITDA number. Very quickly, if you could tell us, since you're saying that this order is giving you visibility, now by 2029, 2030, should we assume that Welspun Corp's EBITDA number looks closer to around 5,000 crores? Would that be a fair estimate? That's double of what you did last year.
There's nothing wrong to it.
It's working out like that, sir, because 8,000 crores you'll be executing in the next 2 years. That's FY28 and FY29. And you have as been guiding that you will grow at 15-20% approximately. So it appears that 4,500 to 5,000 crores of EBITDA from Welspun Corp in the next 3 years is there for the taking?
That's our wish list as well, and I think so. We're all striving toward in that particular direction. And but to get to that number, Nigel, we have to be clear that all the geographies have to kick. I think so the US economy is kicking very well. We are very, very optimistic about our Saudi investments, and that will also kick in. And if that happens, and which is bound to happen, I don't think it is not unfair to assume something what you're suggesting.
All right, Mr. Mathur.
When should we, sorry, if I can just ask you one more thing. When should we, in your opinion, right? This is the government and this is Saudi Aramco, I'm assuming, which is a large player. When should we expect the first big move or movement or order, etc., in the in the Middle East?
Yes, my sense is that I think so the later part of this year, what we are seeing at this point in time, a lot of projects being discussed, they are coming up on the table. And, when I'm sure that they will come up for finalization maybe in the later part of this year. So I think so it will be fair to assume that in the later part of this year, we should see a significant traction coming there as well.
And the size we're talking about is similar to this order. It's, of course, a huge one, what you got out of the US. But,
No.
If the investment... No. Yeah, sorry, go on.
No, I think so. There it will be, there are multiple projects which are being discussed. Permian is different. I don't think so that it could be an apple-to-apple comparison.
Yes.
But from a Saudi perspective, I think so there are multiple projects, multiple, priorities, and I think so we will see multiple projects coming up on the table. And out of that, we will have to cherry pick and execute few of them. To your question that when we see the traction coming up here, I'm answering to that it is in the later part of this year. I think so that we would see a significant traction on the businesses coming up in Saudi as well.
All right, Mr. Mathur, we'll wait for that big opportunity as well in the Middle East. But congratulations on this one. And I recall a few years ago at your Gujarat unit, at around 10:30 p.m., you were still on the shop floor. You all were planning what to do in the United States. It appears all that hard work is paying off. So congratulations. We'll track you to these numbers. Have a good remainder of the evening in the United States. We'll catch you again.
Thank you, Nigel. Thank you very much.
All right, well, time to slip into a short break. Then on the other side, we'll be joined by Sid Kemka. He'll help us out with some fundamental analysis. Stay with us.
With
Symbiotech Pharma Lab Limited proposes an initial public offering of its equity shares. The 100% book-build offer is being issued at a price band of rupees 938 to rupees 988 per equity share of face value of rupees 2 each. Offer opens on Monday, August 24th, 2026. Offer closes on Thursday, August 27th, 2026. For risk involved and other details, please refer to the red herring prospectus and addendum, which is available on the websites of the company, the SEBI, the BRLMs, and the stock exchanges.
वाह सेंचुरी प्लाई क्लब प्राइम फिर भी कुछ हुई तो हुई तो फुल कॉस्ट वापस सिर्फ प्लाईवुड का ना पूरे फर्नीचर का इडियट है क्या कौन देगी सेंचुरी प्लाई टोटल कवर
10 साल तक प्लाई लैमिनेट लेबर ग्लू ट्रांसपोर्ट सबका फुल कॉस्ट वापस इंडिया में पहली बार
तू ना सिर्फ नाम का चतुर
ये बॉन्ड्स अब सबके लिए क्या है? अरे तुझे नहीं पता, इंडिया बॉन्ड्स पर अब सिर्फ 1000 रुपए से बॉन्ड्स में इन्वेस्ट कर सकते हो। Fixed returns do not constitute guaranteed or assured return. Investments in debt securities are subject to credit risks, market risks and default risks including delay and or default in payment. Read all the offer related documents carefully.
CNBC TV 18 tracks the pulse of markets and business in real time, bringing you the stories that shape the economy.
From breaking news to sharp analysis, we deliver insights that help you navigate businesses, markets, and investment opportunities.
Nuvama presents CNBC TV 18 Market Central.
Providing sharp market intelligence for wealth creation with a commitment to doing it right.
Welcome back. Well, let's get chatting then about a couple of stocks then. We have Sid Kemka, Motilal Oswal Financial Services, who joins us on the show. Hi, Sid. Happy Friday. Good to see you in as always. Let's talk about Welspun Corp, the management you just heard, on the channel. There was a period, for a couple of years when they didn't get any orders in the United States. And the street was getting very pessimistic. You have capacity and you have no orders. And that's the margin accretive part of the business. However, the management seemed to have pivoted when Mr. Trump came on. They front-loaded the capex and now the orders are coming in. And that's why, from around 1,500 crores of EBITDA, it's headed towards 5,000 crores, as the management told us. Your view, since the market cap is already 50,000 crores, but they have no debt in their books?
Yeah, hi, good morning, Nigel. Good morning to Prashant and Rima as well. And happy Friday to all the CNBC viewers. Good to be on the show Friday morning. I think if you look at specifically, if you look at Welspun Corp, it is one of the largest manufacturer of the large diameter pipes. And as you rightly highlighted, now at a record order book, one of the largest ever order. So overall order book has grown past the 40,000 crore mark with this 17,000 crore order book. Interestingly, stock has also seen a sharp rally. If you look at last 6 months, stock has rallied almost 150%. And now at 50,000 crore market cap, trailing P will be somewhere around 22, 23 times. What we believe is that definitely the company is now started delivering not only in terms of getting those order books, but the execution has also improved sharply. So Q4 earnings, if you look at very strong Q4 earnings, and as the order book keeps accumulating, the execution could continue to take pace. And what we see is that operationally, the efficiency is improving, as you were asking continuously to the management about sustaining that margin, getting to that EBITDA number. I think with the margin sustaining, with the ROE comfortably sitting around 20%, and company also diversifying its businesses to some of the other segments like the acquisition of Syntex, where the revenues have started improving. Now the earnings have to start seeing an improvement. They have also got into some of the other pipe segments like the gas pipes and some of the other infrastructure pipes. I think overall sits pretty strong with this kind of strong order book, strong execution. The only challenge is with the sharp rally behind already in the stock price. I would say that the view here is to accumulate gradually, and any dips would be a good opportunity to add. But the view definitely remains positive on Welspun Corp.
Okay. Siddharth, hi, morning. Thanks so much for joining in. Aditya Infotech, that's a stock that Motilal Oswal was recommending yesterday, initiated coverage. And you all see this company, it's a manufacturer of security, CCTV in the surveillance space. It's an industry which is growing well in double digit. And in that, you expect Aditya Infotech to outperform and see some market share gains. So take us through the thesis and how much more upside in the stock.
Oh, yeah, good morning, Rima. I think if you look at an interesting company, it enjoys strong competitive moat in India, especially in the video surveillance market. It has a 44% kind of a market share, a large distribution network of 1,000 plus distributors, 2,500 plus system integrators, making it a dominant domestic player. What has also helped is that they are kind of consistently integrated backward, evolving from just an assembler to a manufacturer, and now to a technology AI-driven product as well as a platform provider. The government policies have also been supportive for domestic manufacturers in this space, and I think their market leadership could continue. We expect Aditya Infotech to deliver about 44-45% kind of revenue CAGR, but with margins improving, getting into the high value-added segments, the AI and the digital platforms that should contribute about help the company to scale up the overall earnings by about 65% CAGR over the next 2-3 years. So this will be driven by market share gain, operating leverage, as well as the operating margins expanding from 13% to 16%. So it's a good manufacturing play in India and a space where you see the criticality because of the security, surveillance. I think and with the government kind of trying to support this segment, we see huge runway for growth. So for now, we have set a target price of 4,200, which is about 24-25% upside from current level.
Siddharth, request you to stay on. We want to go across to Harmis to get a sense of the big movers from yesterday, which saw heavy volumes. Harmis? or miss?
Well, there was significantly lower turnover yesterday in comparison to what transpired when it was expiry on Thursday. And when it transpired, look at Bharti Airtel yet again dominating the list of stocks that were there among the top 5. But the turnover compared to the 300 crore plus that it saw on Wednesday, yesterday's top turnover was only 60 crore for Bharti Airtel, and yet it again ended below its reference price. Same is the case for the other 5 as well. The other 5 also ranging anywhere between 30 crore to 40 crore. So surprisingly, despite the expiry yesterday, the turnover was sub 1,000 crore rupees on the cash session yesterday. But to go beyond cash, of course, there were plenty of movers. Sugar names were one of them. Balrampur Chini, of course, the stock was up 20% in yesterday's trading session, the biggest single-day gain that it has seen since January of 2008. And 3.5 crore shares were traded yesterday on Balrampur Chini, the 20-day average being just 8 lakh shares. 13% of those shares were marked for delivery. So around 45 lakh shares on the delivery front, just 3 lakh shares is the 20-day average on the delivery front as well. So significant volumes and significant delivery as well for Balrampur Chini. Cohance was another one that did well yesterday. The stock was up 7%. So 66 lakh shares were traded. The 20-day average is only 2 lakh shares. And here too, the 21% of those shares were marked for delivery. So 13 lakh shares on the delivery front. The 20-day average was around about 4 lakh shares. And lastly, Meesho was another name that did well yesterday. The stock was up 6 odd percent, and 3.5 crore shares were traded yesterday on Meesho. 1 crore shares was the 20-day average. A third of those were marked for delivery, so just over 1 crore shares were marked for delivery as well. That too was around about 2.5 to 3 times its 20-day average.
Okay, well, thanks very much. For that, there is a break we need to take, so we'll do that. There's a news at the bottom of the screen. Tube Investments is acquiring an additional 2.75% stake in Shanti Gears via block deals. More on this in a bit. We also have Sandeep Agarwal of Savilo Investment Managers to focus on the IT services sector. We've got a slew of downgrades, by the way. I think Kotak Equities has put out a note this morning with their view. And I think we also had another broker over the last 2 days coming up with some picks. I mean, I think it was CLSA downgrading large caps and highlighting their picks in the mid-cap space. So all of that with Sandeep, who's liked this space, from the recent lows in a bit from now. Stay with us.
Based, which means that
Okay, welcome back. There's 12 minutes, 30 minutes to go for the market open. The pre-open has kicked off. Just some important news which is coming through. Prabha Narasimhan, who is the CEO of Colgate-Palmolive India since September of 2022, is stepping down. It's essentially a big global promotion for her. She's stepping down because she's being elevated. She's being elevated to the parent, that is Colgate, as Executive Vice President, Marketing Asia Pacific Division. And that's the reason why she's stepping away from her role here in India as the head of India business. And her successor is Manish Anandani, and he's he's currently the managing director at Kenvue. It's a consumer health company which was spun out of Johnson & Johnson. So I guess the thing to note here is that for Prabha Narasimhan, she's stepping up in the Colgate-Palmolive ecosystem. But the person who's stepping into Prabha's role, into her shoes, is an external candidate. So I guess that perhaps becomes more relevant in that sense. So this is an external CEO hire rather than sort of an internal succession, someone from within Colgate taking over. So he takes charge on the 28th of September for a 5-year term, of course, subject to approvals, etc., coming through. So, I think that's an important one to take note of. We'll try and get more reactions around this. I think maybe the pre-open is on, so maybe the Colgate stock should come up. So let's do that. Nothing very much, right? 0.75% higher. It's not so much about Prabha stepping away, or stepping up in that sense. So it's not a resignation. It's basically taking up a larger role and a new person from outside the company coming in. Let's just look at the other names before we... Siddharth, thank you very much for joining us. Good speaking with you, as always, and thank you for waiting. Just the Nifty and the Rupee, etc., we should just quickly put up what's happening there, guys. Let's just quickly have the rates come up. And on some of the stocks as well that we've highlighted from the morning. The Nifty is absolutely flat. The dollar rupee is kind of flattish as well. 95.64, 95.71 is the close yesterday. And, if you can have some of the stocks, right, which we've highlighted since the morning, and then perhaps we bring in our technical experts with the calls that they have. Do we have it? Yeah, on your screen. Tata Motors passenger vehicles. We've got HDFC Bank. Welspun Corp is starting about 2.5% higher. You heard from the management. It's a big order. But the stocks run big. Krishna Medical Devices, Satvik Green Energy is up 5.5%. Railtel is up about 2.9%. You've got Dhampur Sugar, which is down 5%. And by the way, we've got a sugar discussion lined up. Sri Renuka, Dalmia Bharat, etc. Some of the others which are coming through as well. Niva, Bupa, Amagi Media Labs is up 4%, by the way. So there was that block, but I think it's been all lapped up. So it's 4% higher, and Interglobe is kind of unchanged at this point in time. So there's a fair bit out there. But of course, it's more scattered, not really a sectoral move this way or that way. Sudeep Shah of SBI Securities and Shrikant Chauhan of Kotak are with us with some technical trading ideas. Gentlemen, good morning. Shrikant, what do you have? Quickly, Nifty and then your trades.
Good morning, Prashant. Good morning, everyone. So while looking at the entire market, I am of the view that the market is under some consolidation phase. It has tested important level at 24,000. Now 24,350 going to act as major resistance. And today, if we see the market is closing about 24,350, then we can expect some positive news flow and the market can move towards 24,500 or 600. But in case if it closes below 24,150, then in that case, we can expect further more weakness towards maybe 24,000 or 23,800. So today's day is quite crucial in terms of closing basis, how the market is closing. And Bank Nifty, I think there also the activity is completely muted, but it is completely depending upon the trend of the Nifty. So broadly, we need to focus more on Nifty today and its closing.
Okay. Sudeep, what would be the Nifty call, the Nifty Bank call for the day?
Good morning, Rima. Rima, what we feel is that post that 12 successive days of down move in Nifty, which we had seen until yesterday was a breather. But 24,300, 24,330 range will now be very important. This being the 20-day exponential moving average. And once we sustain above that, we expect the Nifty to once again head higher, closer to 24,500, 24,600. Moreover, we feel that it's a part of a large bottom formation process that we are into in the last several weeks now. So overall, any dip towards 24,000, 23,900 should be used as a buying opportunity. We don't see any significant downside from here on. But yes, there will be some consolidation. So 23,900, 23,400, 24,000 zone could act as a stronger base. But a breakout above 24,330, 24,350 and a closure above that would lead Nifty towards 24,600, 24,550, 24,600. Even in the bank Nifty, if you see, the bank Nifty seems better than Nifty because the fall was not sharper in the last 10-12 days. And here, the breakout zones are a bit nearer. So 57,900, 57,950 now will be a crucial resistance. Above that zone, we feel bank Nifty could head higher up to 58,600 and 59,200 on the upside.
Okay. And stocks?
The first stock that we like is from a mid-cap IT. Now, this is persistent system. We feel that IT would make a comeback in the next couple of weeks, and within that, the mid-cap side of the IT could take a lead, and persistent could outperform here. So the stock has been sustaining above its 200-day moving average since last 12 to 13 sessions. And we feel the stock could do 5800, 5850 on the upside in the coming few days. And on the downside, the stop loss would be at 5600. The second stock that we have is from the PSU banking space, that is PNB. Here also, it is on the cusp of a breakout, larger process, continuation processes going on. And from here on, the stock could make an up move up to 122, 123 on the upside, and this could be bought at the current levels, and on a slider dip closer to 116, the stop loss would be 115 on the downside.
Okay. And Shrikant, the stocks that you would recommend?
Yeah, Rima. I would like to go with stocks like Premier Energy, which is currently around 1040. There we are seeing some consolidation sort of formation, and yesterday it closed above its important resistance level at 1020. So from here the stock can move towards the levels of 1080, 1100. It's a high beta stock. We should look for adding this stock at current levels around 1040, 45 with a stop loss at 1000 on the downside. And the other stock on which we are bullish is Hindustan Copper. There also we are seeing some sideways sort of activity. It has been consolidating since last 4-5 days. Breakout. It is very close to its breakout level, and the next level to watch out for would be 580, 585. So at this level also, it's a buy with a stop loss close to 550.
Okay, 5 minutes left for pre-open. Let's quickly get in Sandeep Agarwal, fund manager, Sovilo Investment Managers on the show. Sandeep, CLSA, Kotak, these were pretty much the last bastions who were still bullish on large cap IT names. And their call was that stocks are trading below their intrinsic value and therefore valuations were inexpensive. But this week, we've seen both of them downgrade the large cap IT companies. What's the call now?
Hi, Rima. Good morning. Thanks for having me on the show. So, I reiterate that this will be probably a year of very good return in the IT index. Of course, the base size of the large cap is very big. So for them to report mid-teens or high-teens growth is little difficult. I will put them at 6-7% dollar growth, but the margin improvement and everything taken together. As I mentioned multiple times since March, I believe that the IT sector as a whole should give a cumulative EPS growth of 45 to 70% over next 3 years. And even if the multiples remain same, that is the kind of return you will see. And last month we saw in 1 month we got 20% return in the sector. I believe lot more return is yet to come. So I am very constructive on the whole sector, barring 1 or 2 companies where there are management issues for last 2 decades. I won't comment on them, but otherwise I am positive on the whole sector, barring ER&D companies because they are very expensive. And I think there is some disruption which is still not discounted in them. Otherwise, the typical services company, my preference small cap over mid cap and mid cap over large cap, but I'm positive across the board. And I love the hardware players the most, because I believe that hardware players have long way to go still from here.
Okay. So, Sandeep, you expect a 45, 50, 70% return, even if the top line growth remains in low to mid single digit? Because the other fear is that the competitive intensity in the market is intensifying. The deal market has not expanded enough to absorb everyone's growth ambitions. Plus, some of these companies like Accenture, Capgemini, Cognizant in the last quarter have grown faster than the Indian large cap IT companies. And then there is the risk of pricing. So do you think that even if the top line is, 3, 4, 5% for the next 3-4 years, you can still get very strong returns, share returns?
So I don't have this view that top line will be 3-4% growth. I believe that we will be 6-7% for large cap and 10-12% for mid cap and 15-16% for small cap in dollar terms. Now you add the rupee benefit and everything, then the numbers are phenomenal. And I'm very confident, because see, I've seen this sector for last 25 years. You see what guidance Infosys, for example, has given in 10 and 11, and what they actually did, what guidance these companies have given in 20, 21 and 22, and what they did. So, it is a B2B business, very tough even for the management to guide. And we are blessed that all the management in India in the IT sector has always been very conservative. And because of that, the data which comes to the analyst community generally is rephrased version of what the management is saying. And for them being into B2B business, it is very tough to give a call when the demand will come. But my belief is that the way, enterprise AI is getting adopted, you will see all this today's concern will go away. The way they had gone away from March to now, it will further go away from now to, next 3 months. And I believe that a lot of money will be made in this sector in coming few months. And we are very, very constructive, as mentioned earlier also. From zero weight before March, we are now almost like 15 to 20% weight, which includes hardware players also. And we are very constructive. We may even increase weight more from here also.
Okay, Sandeep, unfortunately, very little time today, but counting down to the opening bell, 4 seconds to go.
Okay, well, we'll see how those stocks are opening. We've got the first rates come up as we start things. So 24,260, 57,580. So this is better. I mean, actually slightly better. So 40 points on the Nifty is what you have. The mid-cap index is starting about 20-30 points higher. The small-cap index will also come up. The Sensex is up 100. The Nifty Bank is up about 0.12. So, I mean, slight upward kind of move, but not much. The Nifty heat map, let's quickly look at the 50 stocks and how they are starting before we go any further. We have Shriram Finance and BEL and iShares as some of the top gainers. And you got Grasim and TCS and Bajaj, Finserv, Cipla, etc., which are on the other side. I mean, there's no real big move, right, coming up in any of the, at least the 50 names, but I'm sure it's not the case as far as the broader space is concerned. Rima.
Well, Welspun Corp is clearly the big winner after winning an historic $1.8 billion deal from the US in the oil and gas space, the largest ever. Stock has zoomed nearly 8%. Amagi Media Labs, there was a 5% block deal, but after that, maybe the supply pressure is out of the way. The stock is trading strong. Order wins are boosting Satwik Green Energy and RailTel this morning, so both of them have opened up, with a positive bias. I think on the way down, we should watch for some of these sugar names because the government has allowed import of sugar because sugar prices are rising. They've gone up nearly 10% in the last 1 month. Festive season is approaching, and the government wants to rein in sugar prices, keep it in check. So we should keep your eye on sugar names. They had a double-digit up move yesterday, and today they are seeing a little bit of a correction or a retreat. Well, other than that, you can see gains coming through in names like JBM Auto, Shanti Gears. I think there was some news about Tube Investments buying a small stake in Shanti Gears. So that's got the stock a bit excited. Urban Company was under pressure yesterday. It's rebounded today. IIFL Finance, we chatted with the company yesterday. They were bullish on the outlook, holding on to the growth rates. So that's been another mover. Milky Mist corrected yesterday, bounced back today.
I think Shanti Gears is buzzing because Tube Investment has gone ahead and bought 2% of the company. That's the promoter entity. They had 70% stake, so I guess that goes to around 72% or thereabouts. Welspun Corp, a company that was doing an EBITDA of around 1,500 crores just around 2 years ago. Well, directionally, by 2030, the management says that it could probably go to around 5,000 crores. Remember, the stock has already seen a big rally, in this year itself. But the street is penciling in now an upgrade in terms of the earnings estimates for 2029. I'm looking at a Nuvama flash note that came out. They're talking about a 10 to 15% upgrade in their numbers because of this order win. So explains why that stock is up and about. On JBM Auto, the news is that there's a piece that's come out, unconfirmed news, that Bain Capital is mulling a 2,850 crore investment in their EV subsidiary. So we'll have to wait for confirmation on that front, but that's the reason why that stock is running away in today's trading session as well. Waterways Leisure, I recall, the IPO wasn't too great. It was rocky, in fact. But that one, in fact, has opened up with a good gain in this morning's trading session. So that seems to be bouncing back in trade today. A sharp up move is what you're seeing in on that particular counter. What else? CRM Silk Mills, not too high volumes, but that stock is under some pressure. The sugar space as well is seeing some selling pressure in today's trading session. Net, a flattish to a mildly positive start. I guess the bulls will be pretty okay with that sort of a start that we're seeing. But a lot of stocks doing a thing of their own. Silver has popped up overnight, so Hindustan Zinc as well is participating on the upside. And since gold has moved up, the financiers are continuing their good run. I think Muthu that opened up in the green. Manappuram was a little in the green as well.
Well, yeah, that's the one space which is sort of booming, right? I mean, lots of players. And we got you some opinion, by the way, from Piramal Finance and L&T, etc., as far as the gold finance business is concerned. At the margin, of course, I mean, the size has become very, very large. As I think the management of Piramal put it now. The AUM is now about 21 odd lakh crores. It was about 4 lakh crores about 3 years ago. IIFL Finance is also there at the bottom of the screen, and some of the others that we are highlighting. But I think it's a quieter day, and why not, right? At least as far as the Nifty is concerned. You're going into a weekend. Oil's once again uncomfortably at about 94. How will we come out of this on the other side on Monday with oil specifically? And of course, I mean, this entire US bond thing, all of that will be in focus as well. I just want to quickly put up the stock of Tilaknagar Industries as well. So that was the other management that we had yesterday with us. And stocks down slightly, 580, 581 or so as we open up this morning. So that's a picture with lots of sugar names, right? So Balrampur is down about, 4% or so. Dhampur and some of the others should also come up on your screen. Balrampur is down about 4%. Dhampur is down about 3.33%. Sri Renuka is starting about 1% lower as well. Triveni and a few more. So that's the picture at this point in time. Guys, anything else?
Well, I just want to quickly talk about that Kotak downgrade on IT sector. So they've downgraded an Infosys and TCS to an add from a buy rating, and on LTI Mindtree they've reduced it to a sell from reduce. And the key reason is the sharp rally in the stock prices from recent lows. For example, for TCS and Infi, from the recent 52-week lows, which wasn't too long back, maybe a month, 2 months back, stocks have recovered close to about 15%. They're saying the risk reward was attractive when the stocks were at lows. Now it's moved to balance following a 15% for the large cap, but some of the mid caps have moved up even 35% from the recent lows. So they like a Tech Mahindra, Coforge, Hexaware, Indegene. Those are the preferred picks. So they still prefer the mid caps, the challengers, rather than the incumbent players. Now they're saying the debate in AI has moved from whether there is an existential crisis, whether IT companies survive or no. That is out of the way. There is no existential crisis. But the question really is, who can capture the value chain in the IT pack? In terms of valuation, 11 to 12 times, according to them, is the floor. But because growth is going to be limited, the valuation upside also gets capped at 17 to 18%. And one thing they're watching very closely is the competitive pressure. They are saying competitive pressure is intensified because the pie is only so much and everyone's eyeing the same pie. So are they going to be aggressive in terms of their bidding? For now, you can't see it in their margins because of the rupee depreciation. But if that tailwind goes away, is there a risk to margins as well?
Okay, all right. That's IT for you. We have Vikas Khemani now joining us, founder Carnelian Asset Management. Vikas, great to have you with us here. Thank you very much for joining us. We'll talk about earnings and what you like, but I mean, I know what you like, which is one of the top holdings for you now, which is Biocon, right? Which you've spoken about publicly as well. And I just want to thought I'll start with that because you must have seen this recent news break, right? Moderna and Merck announcing that their cancer vaccine has shown promising results in trials, right? You know, if you read through the release, the key component is Merck's Keytruda, which is what I mean. I think Moderna is trying to do, Moderna is trying to make that work better to teach the immune system what to attack. And guess what? Biocon actually has a subsidiary called I think Bicara, which is essentially also trying to do exactly that with Merck's Keytruda. I mean, essentially, this is all immunology with regards to oncology. I mean, trying to manipulate the immune system to try and have more targeted therapies. I don't know if you have any thoughts on what we've seen in terms of breakthroughs. We know what happened with Moderna shares, right? I mean, 180%. Basically, Merck went up, of course, but Moderna was the big winner. And that's the power of innovation, isn't it, Vikas?
That innovative companies are very hard to build, and whenever they have a breakthrough, you get very, very good outcomes. So if you see, Biocon is one of the very rare company in India which has taken lead in biologics space, in biosimilar space, and much ahead of everybody's time. So I think this is only company which is only focused on it. Of course, everybody else has a focus, but this is the only company which is a full-time only focus on this. So I think that makes them special. But innovative companies go through their ups and downs of investment cycle, and when they come out of it, they go through different phases. As a Biocon has suffered from that phase in the last 6-7 years. Now I don't want to talk specific about a particular innovation or something, but generally we think that the inflection point is around, and there are many more triggers, not only one just you talked about, but there are many more which can kind of take this company forward, and that is our thesis.
Got that. What are you making of, Vikas, all the, and I'm sure you must have met a few of these companies which are making it to the market, right? With these very strong listings, Vikas. Some of them are unique businesses. I mean, actually unique, when I say unique, I mean like no comparables first in that segment to list, etc. So I guess that helps a lot. But generally, it's been a pretty favorable and bullish kind of environment, right? For at least the primary market action.
Yes, I think, so primary market action in the recent past has picked up, especially in the last 2-3 months, once the markets kind of saw some revival. I think last 2 years was kind of very, very, or especially 25 was very dry period from IPO perspective. See, in every market, there will be good companies, bad companies which will hit public, but early cycle, typically, company which are good business model go to public, right? And they are able to sort of find buyers. And then as you progress in the market, bull market cycle or a momentum, the quality of the company or business model gets deteriorated. So I've always believed that early part of the company cycle, the investments are good, but there's no general trend out there. I would always say that real thing is understanding the business model of the company and, management and valuation. We don't really fall prey to how sometimes unique company tend to get glamorized a lot more than they actually deserve, and which eventually gets them high valuation, and which leads to the de-rating. So I think one has to be very careful, whichever cycle, whenever you're investing into any company, whether what are you buying, and our perspective is always 3 to 5 years. So we really don't care whether it lists with a pop or not pop, but generally speaking, that's our philosophy.
Okay. Vikas, you've been very bullish on the manufacturing sector well before it even became a mainstream idea. I think you've been pitching this idea right when COVID struck way back in 2020, 21. I've been hearing you talk about manufacturing. But from here on, where is the opportunity? A lot of sectors have been discovered, like electronics manufacturing. For the last 1 year, stocks have gone sideways, haven't given any return. So in the manufacturing space, give us some ideas.
I think, as you rightly said, that we launched our manufacturing fund in 2020 October, and and we've been bullish since then. And every year I've been asked, because manufacturing stocks have done, our funds have done, is manufacturing story over? And I always said that it is a decadal trend and maybe longer. Very rarely happens in a country's GDP where the shift of currently where we are 15-16% of manufacturing GDP is expected to go to anywhere between 20 to 25%, depending on how we succeed over next 10 years. Now, this kind of shift creates massive opportunities, and manufacturing is just one as a broad theme, but there are many, many sectors within that. Right. So and in fact, in the recent past, we wrote a note about 2 months ago that there are two major silver lining which has come in last 1.5 years of crisis, which is giving further impetus to this manufacturing and what we call manufacturing 2.0. Number one, when recently, US tariff crisis happened, it forced India to explore FTAs with a lot of other markets. And as you know that today, in last 1.5 years, we have signed FTAs with additional market of $1.5 trillion. So to that extent, new window of opportunity opens up at a favorable terms. And second, post-West Asia War, we have seen 14 to 15% kind of depreciation in our currency vis-a-vis most trading partners. So these two combination is not only 1 + 1 = 2, it would have far more amplified effect in terms of giving a lot of edge to our exporters and also to local manufacturers which are fighting imports. So I think to that extent, we found that there's a new impetus. Now, within that space, there are many segments: chemicals, specialty chemicals, garments, capital goods, defense, aerospace, EMS. And I think when I say there's a 10-year trend, does not mean that all these companies will have a 10-year one perpetual bull run. Because we operate in market, there will be times to kind of go up and down, right? When we bought in 2020 chemicals, we sold most of our chemicals in 2022, where it peaked out. Does not mean that chemical the trend is over. But so market cycle and business cycle at times can kind of misalign. And that's the reason you have to constantly keep looking for, risk reward of a particular sub-segment and the sector and the stock in that. We've been buying, we think that chemicals is a space after 2-3 years of gap. Now, some very interesting plays are coming about, and demand is here, and I think you will find new auto component space. We've been quite positive within that manufacturing space. I mean, aerospace again is a very, very interesting opportunity which is coming. The real challenge is to identify the right risk reward ideas. So I'm saying at times you might find a lot of sub-theme sectors and all those things, but you might find difficult to find ideas. And we will, whatever theme we are playing in, our view is that we should stick to our discipline in terms of finding ideas. If it means we miss out something on a valuation bubble, so be it.
Okay, got that. In the auto ancillary space, there's considerable interest because many of them are diversifying from the traditional businesses and moving into other ancillary space like precision manufacturing, and that's got the streets fancy. Is that a very attractive opportunity? How much would you bet on it?
So precision manufacturing is a recent buzzword, and that's the reason I always say that be careful about the buzzwords. It's not manufacturing is always supposed to be precision manufacturing. Now we will find out some new nuance and try to some new thing. I mean, manufacturing, when people are making auto components over all these years, do you think it does not require precision manufacturing? It does require, and to a great extent, right? So manufacturing is manufacturing. When you call component manufacturing, some require different degrees of capability. Then that is where you're supposed to assess the TAM and the management quality, capability, and every sub-segment would require that kind of thing. So I would not fall prey to any such precision manufacturing buzzword and euphoria and start valuing company on a crazy basis. Manufacturing risk reward and has to see based on the financial matrices and total TAM and the growth potential of the company and sector.
Hi Vikas, good to see you. And some of these smaller names you've y'all have bought into, and it's done very, very well. I was looking at a smaller recycling company, I think JG Chemicals. That's a company that was totally ignored. Very small cap. You got in there. The other one, Caliber Mines as well. I think on listing day, I went ahead and picked up a good chunk. Tell us about some of these themes. These are not themes that a lot of people look at, but there's big value to be added in case you get in at the right price.
Trent from commenting and discussing company stock specific in detail, but generally speaking, on the mining space, we've been very bullish. I think there's a lot more investment will go into. The government is very clear in terms of investing into mines, making sure that our output goes up there, and a lot of liberalization happening. So we see this as a structural theme, and within that, then you will find many companies, including mining companies, to friction solvers companies, to there's a lot of wide area of. So the broad theme is around more the minerals, and then you have to understand. So I think that one should keep in mind that it's a India has a lot of potential, but we have not explored that. And we think there's a good policy shift which is happening in terms of pushing that. And companies can disproportionately scale up in this whenever there's a big push towards, making sure our resources come out. So that kind of, at least, mindset we have when we look at any such opportunities.
Okay, we'll leave the conversation here. Thank you, Vikas, for joining in. Let's invite KFin Tech on the show now. Yesterday, there was a large block deal of 100 deal with private equity major and the promoter of the company, General Atlantic Singapore, offloaded about 8.75% stake. Vivek Mathur, CFO of the company, is joining in. We'll talk to him about the GA stake sale, but we'll also talk about the international business growth opportunity, the mandate wins and the IPO pipeline. Mr. Mathur, thank you very much for joining in. So what is General Atlantic's stake now? Because they're also the promoter of the company.
Yeah, thank you for hosting me. General Atlantic now holds around 14% stake after the recent, the block deal that they did. So they continue to remain promoters of the company, and they are long-term players. They actually laid the foundation of the transformation of the company right from 2020. They invested in 2018, but became very active in 2020. And then from there on, there's been a journey where, 36 new products have been launched. The company is now known as a fintech innovation company in the BFSI sector. So General Atlantic has really played a role in terms of handholding the board and management in terms of partnering with them to growth. So this balance 14% that they are holding, it's up to them, being a private equity player, how the LPGPs want them to divest. But they have been a great support to the company in terms of their guidance and direction.
Selling stake in the company. They held more than 80%. They divested in the IPO. And after that, there have been subsequent stake sales. And now they're left with only 14%. And all these private equity players, they have the funds have their own life cycle and monetization associated with it. Is there a possibility, and a real possibility, that eventually KFin becomes a professionally managed non-promoter entity like your peer CAMS?
Yeah, it is actually, a company which is run by independent board of directors. There are only 2 directors of General Atlantic who are on the board, and they participate in committee meetings. The day-to-day affairs are run by the management. So it's already a company which is run by a professional board and professional management. There is no dependence on General Atlantic in terms of exit of any of the KMPs or the board members. It's a company which has been given the freedom to operate, and that is what professionals like us, like working and creating value for shareholders.
Have they told you that they may sell their balance 14% stake? Is there a lock-in period?
There is no lock-in period. They have evergreen funds. It's up to them when they want to divest it. Their stated position has been that they are long-term players and they continue to remain as promoters. It's a question that you should be asking General Atlantic, but in our discussion, they have been great support.
Okay, so that is the General Atlantic and, of course, the stake, etc. Good morning. Good to have you with us here, sir. Just talk to us a little bit about how the second quarter has been panning out. Have you, since we last spoke at after the first quarter numbers, what has been the progress on some of the deals and work that you were that you spoke about? I mean, I think there were a few things lined up. Have you closed anything? What can you tell us, sir?
The deals are already in pipeline. We have been growing in terms of the overall revenue, and our guidance remains that overall as a company, including the acquisition of Ascent that we did, we will continue to grow in the revenue growth in the CAGR of 18 to 20%. There have been new wins across businesses. Even if you look at Q1 non-domestic mutual fund business, which was 67 crores of revenue in Q1 FY25, actually doubled, more than doubled, 135 crores in Q1 FY27. So across businesses, especially the international business, the growth has been tremendous in the range of about 25 to 30%. Ascent itself is growing at 30%. And there are other businesses like AIF and, National Pension Scheme, although small, but they are growing at a rapid pace. So the other new line of business that we have developed is the platform business, where we have launched the global wealth platform, the global pension platform, besides the global fund administration platform of mFund. So these are new opportunities which will give us wins in times to come. We have been participating in international RFPs, but the real timing of that is between Jan to March. So Jan to March 27 is the period that we are looking at in terms of participating in the global RFPs. And that should give us segue in terms of large RFPs, although we have been winning RFPs, a pension mandate that we won in Philippines, last quarter, a small one, and wealth platforms that we have been winning in, both in India and outside India. So, this is basically a new opportunity that we are developing where we want to increase the value-added services revenue from current about 5.5% to take it to about 10 to 12% in 3 to 5 years.
Okay. So the stock price, your stock price, I know business is very different from, and it's not linked to what the stock does, but the stock is down 15% in the last 1 year. It's gone sideways, and so has the market. Do you think the overall RTA industry has slowed down compared to the hyper growth period and the velocity that we had in the prior years?
Yeah, you're right. There are two aspects I would like to talk about. One is mark to market in the domestic mutual fund business, where we have not seen the kind of the momentum that we have seen about a couple of years ago. And that is one reason is that the movement towards gold and silver or commodities ETF, where equity took a backseat in the last 6 to 9 months. Now, SIP inflows continue to be very strong, 31,000 crore plus monthly inflows, which is a very strong indication that equity is, intact in the minds of the people. The investment of the institutional investors moved towards Korea and Taiwan, and now they have tasted that, it's not really going to be a long-term sustainable. So they're coming back to India. So you will see equity market performing better in times to come, hopefully. And if you look at the number of demat account on the issuer solution or the number of IPOs that we witnessed a couple of years ago, that has slowed down a bit given the geopolitical situation, and many of them were deferred. But now it is back. We have now 2/3 market share in the main board IPOs, and 80% of the value of main board IPOs is what we have actually garnered in terms of supporting our clients. So the fundamentals remain intact. It's a business cycle where you may have sub 10% growth in some quarters, and then some quarters will pick up. But overall, we remain bullish that the overall market is coming back on track in terms of the growth in business. However, as you know, the impact of IT industries, corporate actions not being very solid, not many companies are declaring dividend or bonus or rights, which will impact the revenue from corporate actions in our issue solutions business. So we are expecting the domestic mutual fund business revenue to grow in the range of about 11-12%. Issuer solution revenue also to be in the range of 12 to 15%. And that is not mirroring what we have seen in the past. But hopefully India remains a growth story, a consumption story, and fundamentals are intact. It's a matter of time that the market will be back on track.
Okay, so your domestic growth, sir, for FY27, what do you anticipate? And you're not just a domestic capital market play because you have international operations, Ascent, etc. What is the contribution of the international business? How will that change? And therefore, combine the two, domestic and international, can you sustain a 30% kind of a growth run rate? So a lot of numbers here, but if you could help us with that.
Sure. Interestingly, international business has been growing at 30%, and that is both in the RTA space that we have the legacy business of supporting mutual funds and pension funds in Southeast Asia, which is also growing at 25-30%. So in terms of the overall revenue mix, today domestic mutual fund contributes about 55% fee-based revenue. 6% value-added service, 5.5 to 6% value-added services business. International business is currently contributing about 20%, which we believe will change to 30% in 3 to 5 years' time. And the domestic mutual fund contribution, although it will grow, as I mentioned, in the range of 11-12%, it will proportionately come down to about 45%. So the shift will be more towards international business. And why? Because international business is high margin business. The bips that we get on AUM that Ascent gets in the global fund administration business is in the range of about 6 to 7 bips, while in India it is just 3 bips. So in the AF industry you just get anywhere around 2 bips to 2.5 bips in India. While outside India, global fund administration is a business where clients pay much more than even 6 to 7 bips. So the opportunity to grow that business profitability is about scale. And that scale will come in the next, it will be visible in the next 2 years because we are now building synergies with Ascent, and that will take shape in terms of better profitability, higher growth, and therefore the contribution of international business will be value accretive to the shareholders, as we mentioned at the time of acquisition.
Okay.
Domestic business will continue to grow, and obviously not at 25-30%, but the proportion of that business, because international business will outgrow the pace of the growth of domestic. The growth in the domestic business will be in the range of about 10 to 12%.
All right, we'll leave it there, sir. Thank you very much. Appreciate your time here, and it's good getting that overall perspective. So the local RTA MF business will do well, but maybe early double digits, but the growth will come from Ascent and the global funds under management, where you're able to charge more as compared to what you're able to make here. Thank you. We'll take a quick commercial break. We are back with the sugar story in focus, and we get you a discussion around the government allowing duty-free sugar imports. Stay tuned, coming up.
Welcome back. Well, let's focus on the sugar space then. And to help us out with the news flow and the analysis on that, we're now joined by Prashant Biyani, the VP Institutional Equity at Elara Securities, as well as Kapil Nema, the Deputy Executive Director at Sugar and Ethanol Business of Dalmia Bharat Sugar, who joins in on the show. Hi, gentlemen. Good morning and good to see you all in. Kapil, let me come across to you first. How do you read the recent news flow for the industry as well as for a company like yours?
Hi, morning, and thank you for having me here. You've seen the domestic market being a little buoyant in last couple of months. And looking at the upcoming festival season, there was definitely tightness in the balance sheet. And accordingly, I think that's what has triggered government to take the action to propose sugar imports into the country to ensure that there is a sugar availability in the market. So, with the tightness, the availability through via imports makes definitely a lot of sense and a lot of comfort for the domestic market and for the continuity of the availability in the sugar market.
Kapil, the question is 1 million tons or 10 lakh tons enough to address the current tightness? What is expected to be the demand as we get into the festive season versus the stock which is available?
Well, we have, at the beginning of this month, we had roughly around 8 million tons of sugar which was available. We consume around between 2.4 to 2.5 million tons during the festive seasons. So, technically we would have been ending close to between 3.5 to 4 million tons at the end of the September. So 1 million tons actually definitely helps with the stocks, and it is actually, it's more than enough for the sugar market to float through the October month, after which we will see crushing to start and the regular supplies from the domestic market to start coming into the market.
So therefore, if it is enough, Kapil, sugar prices should come down. To what extent is your assumption?
Well, I will not comment about it should go up or should come down, but it should definitely stabilize. As the availability increase and as the imported sugar starts landing in the country, we should see more of a stability in the prices rather than the volatility which we have seen in last couple of months.
Okay, all right. Let's get in Prashant as well into the discussion. Hi, Prashant. Good to have you in. Help us out with your analysis, on the recent news flow, and which are the companies that are most impacted?
I think the biggest or one of the most important reason why the price increase has been so rapid are 2 to 3 fold. One, the mathematical inventory of sugar that we have in India and the physical inventory, I think there's some mismatch and there's lack of clarity around that. That is why we see certain spurt in price. And secondly, I think in the last week or so, there has been a lot of news around government intervention. So generally, traders are of the view that the more government intervenes, the more panic it creates. So I think those two are the primary reasons why the price increase has been so steep. And as far as the companies which will benefit, I think all kind of sugar mills will benefit from this. More so would be the mills which can produce maximum sugar. So I think UP-based mills are the ones which will benefit most. So could be the case with Maharashtra also. But I think in Karnataka, we are hearing some. We have seen that northern Karnataka region has seen some impact of below normal rainfall. So I think UP-based mills and followed by Maharashtra. These mills would benefit out of it.
Got that. But if sugar prices stay where they are right now, Prashant, what kind of a quarter will it be for sugar companies as things stand today?
Yesterday in North India, prices touched around 60 rupees per kg. I think that is clearly not sustainable. We are expecting prices to stabilize between 45 to 50. Depending on if it is at a lower range, then prices will be up 10% year on year. If it is near to 50, then prices will be up 20% year on year. That's a fair number to go about, and I think that is what we are expecting. So within our coverage universe, I think Balrampur generally sees around 100 crore EBITDA benefit with 1 rupee increase in sugar price. So we are looking at gains of between around 400 crore in terms of EBITDA for Balrampur for this year, just because of the sugar price increase.
Okay. Kapil, you said that, in October, crushing will anyway start, right? And then the situation should normalize. We were chatting with one of the sugar companies earlier this month, and he said that the government is actually, in a way, nudging the mills to start crushing earlier to bridge the deficit. Is that something that y'all are also doing at Dalmia Bharat Sugar? And is that even feasible, or there are operational hurdles?
If we talk about theoretical perspective, theoretically, yes, the sugar milling is possible to start around mid of October. However, there are a lot of practical things which we need to look into it, specifically weather related. Now, it's most of the harvesting which happens across the states are manually harvested, so you have to get into the fields where the harvesting happens. So depending on how the weather is and when the last rains are, because after the last rains, you need at least 10 days for the soil to cool down, and then the crushing can start. So theoretically, yes, it is possible to start early, but practically we'll only get to know in October. You have seen how the weather has been behaving. June was massive deficit. July was absolutely normal. August first 3 weeks have been again on a deficit side. So let's see how the rain goes. It's the weather patterns are changing almost on a daily basis, and it's getting a little on an unpredictable side. Though I can still say that on the most of the cane areas, except the North Karnataka ones, are getting decent rains. So overall, from the crop perspective, things are looking fine, but we still have a long way to go.
Prashant, you were just saying, right, the market starts panicking when the government starts intervening too much. And now in 24 hours, there have been two measures taken by the government. One is to prevent bulk consumers, so your soft drink companies, food processors, sweet milk sellers, from hoarding. So earlier they were allowed to hold inventory worth 30 days. Now it's brought down to 15 days. And now the recent measures about allowing 1 million tons of import. Do you think more measures are coming, or this should suffice for now?
The government certainly has leeway to bring more measures, but what these kind of prices also do is it will definitely restrain sugar mills from diverting sugarcane for ethanol blending. So this year, I think the assumption is just that from sugarcane, only C-heavy ethanol is what will be produced. So I think it is not just a regulatory angle; it is also because of the sectoral dynamics that things will be altered. But I think the base case remains that sugar prices will remain significantly higher than last year. It may correct on a week-on-week or a day-to-day basis, but prices should stabilize even with or without government interventions.
Okay, and one final word, your top picks in the sector if someone wants to play it?
In the short term, all sugar mills will benefit from the price increase. The more sugar you can sell, the more benefit you will have. For us, the top pick remains Balrampur because it will not only benefit from the recent price increase in sugar, but there is also a structural growth angle there with the commencement of PLA plant starting Q3 or Q4. So, on a structural basis, I think Balrampur is a good stock to own.
Okay, thank you. Both of you, both the gentlemen, for joining in, Prashant and Kapil. Appreciate your time this morning. All right, let's get into a very short break with the news. The markets are absolutely flat. The Nifty is hovering around 24,250. Before that, I think we've got Somil Mehta also joining us.
Well, that's right. Somil joins us on the show. Hi, Somil. Good morning. Happy Friday. What do you make of today's action? We've been in a very tight band. And that's been the case actually for the last few trading sessions. A broad 400-point band is what we are at. Going by the indications that you're looking at, earlier today as well, in the last few minutes, we went into the red. Now we're back up close to 20 points. Directionally, do you think it's up or down?
I think directionally, we definitely are up. We are definitely viewing a positive breakout on the upside from this range. There is a full range in the last 6 months, and this triangle pattern, I'm expecting it to break on the upside. Now, the most important part here is that in April 2026, we made a low of around 22,200. Then we made a low of around 23,100, 23,000. And then we made a low of around 23,600. So this means that we are making higher lows. Now, trend remains positive because we've had a higher lows. However, we are still in a very broad range. And my view is that this range will break on the upside. I'll be bullish on the markets. There are very crucial levels. 24,000 remains very crucial for the markets. There is a trend line as well, upward sloping trend line. I'm not expecting that trend line to break on the downside. So I'll be positive on that side as well. Now, the very short range which we are talking about, which is 24,000 and 24,400, 24,500 level range, I'll be expecting more sideways correction. However, there are a lot of opportunities. I'll be expecting defense to do good. Pharma to do good. Sugar has been doing good. So these are some sectors where I'll be aiming for. And overall, the bias still remains positive and I'll be expecting higher targets.
Got it. Okay. All right. So you're sounding reasonably optimistic. What about the Nifty Bank? That's showing greater traction actually in today's trading session. What are the levels you're looking at out there?
Nifty Bank, I'll be expecting Nifty Bank to outperform from here because there's a flag pattern formed, and today we have crossed the previous swing high, yesterday's high, trading about 20-40 daily moving average, trading about 200 daily exponential moving average. So I think Bank Nifty should outperform from here, and my targets would be around 58,700, and above that, I think I'll be aiming for 59,000, 59,500 levels. So I'm very positive on Bank Nifty rather than Nifty. So Nifty I'll keep aside. However, Bank Nifty definitely a buy from these levels.
And stocks?
Stocks, I'll be very positive on ICICI Bank. That is the first one I'll be expecting the markets to, this stock to, start moving on the upside. We've seen a little bit of correction. Keep a stop loss of around 1380. The stock has taken support at 40 daily moving average and the lower end of the Bollinger Band on the daily charts. So I'll be expecting a target of around 1470, 1500 levels in the short to medium term outlook. So ICICI Bank would be one of my stocks. And the other one which I'm looking at is Premier Energy. Premier Energy has also, broken the previous swing high on the weekly charts, which is a very good sign. I'll keep a stop loss here at around 1020 and a target of around 1120, 1150 levels in the short to medium term outlook.
Okay.
Got it. Okay. All right. Thanks a lot for that, Somil. Well, let's focus on the broader markets though. Quite a few stocks are moving around. Let's start off with Urban Company. There's a UBS note, and that's what's got the stock excited. Sudarshan joins us to detail that. Sudarshan?
So today it's another new age company which has got the coverage of brokerage firms, and it's the Urban Company. UBS has initiated coverage, and it's a buy, call and target price is 180 rupees per share, and the stock has been 5% higher as well in the first hour of the trade. What is UBS saying? It says India's online home services market is entering its Blinkit moment, and this company, that is Urban Company, is at forefront of this evolution, and it has mentioned some of the factors. First, there is a right product market fit by Urban Company. There is strong balance sheet that the company has been providing over the last few years, and third, that's the most important factor, is the execution track record with a clear focus on unit economics that company has been focusing not only since the listing but over the last 5 to 6 years. And there are some of the factors why UBS is positive, and the stock is reacting to that as well.
Oh, okay. Thank you. Nigel, Welspun Corp, that's the big one today.
Welspun Corp, what a star that stock has been, right? Overnight, we had news that came in that, in fact, they've gone ahead and bagged their largest ever order, which was at around 17,000 crores or thereabouts. And that's what takes the order book to around 42,000 crores. So massive, order book is what they're sitting on. And this just adds their case. What it helps out is, it gives them visibility for the next few years. And that's why, Nuvama, they've been bullish on the stock. But they are saying because of this last order that's coming in, and since it's for the United States business, they'll have to upgrade their estimates by around 10 to around 15%, which explains why the street is quite bullish on the prospects. We spoke to the management earlier today, and they said that this order is pertaining to the Permian pipes, and that's for LNG exports as well. So some details coming in on that front. If you look at it in terms of valuations, the market capitalization is around 55,000 crores approximately, on an EBITDA that is headed towards 5,000 crores as per the management. That's the aspiration out there. So it's still trading at around 10 times approximately. So thumbs up coming in for Welspun Corp. The stock has already seen a big rally. But this size of the order coming in from the United States, which is a accretive business in terms of margins, the street likes it, explains why the stock is up close to around 12%. In fact, we here at CNBC TV 18 around 16 months ago, we had explained that in fact the US part of the business is something that could actually come to the party, because there were many quarters when we didn't get orders with that, and suddenly that started coming about, and clearly that's played out as well. So big move is what you're seeing on that name. Time to slip into a short break. On the other side though, Manish Gupta will join in to help us out with the commodities space. Stay tuned.
Some properties are not just homes. They are statements, achievements, legacies. At India Sotheby's International Realty, we represent the country's most exceptional properties with unmatched expertise. Unique homes, uniquely for you.
वाह सेंचुरी प्लाई क्लब प्राइम फिर भी कुछ हुई तो हुई तो फुल कॉस्ट वापस सिर्फ प्लाईवुड का ना पूरे फर्नीचर का इडियट है क्या कौन देगी सेंचुरी प्लाई टोटल कवर
10 साल तक प्लाई, लैमिनेट, लेबर, ग्लू, ट्रांसपोर्ट सबका फुल कॉस्ट वापस इंडिया में पहली बार।
तू ना सिर्फ नाम का चतुर है।
Welcome back. As promised, let's talk commodities. Manisha is joining in and she's talking about the surge seen in food prices.
Oh yes, food prices it is, because we've been talking about crude and precious metals and the base metal prices rising as well. But if you look at the food prices, they have been constantly rising, especially in the last couple of months. One, it has been about the West Asia conflict that has directly threatened critical shipping lines. And we've seen fertilizer actually take a bit of a hit because of that as well. And then it has been about ongoing disruptions that you also have seen in Black Sea. Now, this is exactly where you see grain exports coming in from Russia and Ukraine, with both of those countries still at war in the last 3 years, and the Black Sea disruptions as well. This is yet another thing that has kept the prices elevated for last year or so. The higher natural gas prices have had a direct impact also on the fertilizers, which is the major source in sense of yield for various global economies there. And then markets also are looking at the higher crude oil prices itself. I mean, that has led its way into fuel prices hiking, and that has pretty much led to gains across sector therein. And then the markets have been keeping a keen eye on the strengthening El Nino, which is expected to go from a strong to severe strong in the month of September, and is expected to continue to develop until the month of January and February as well. And we also are looking at a below normal 2026 monsoon that in turn has directly impacted yield, and that is what the markets are fearing going forward as well. And then it also has been about various governments pushing in for the green energy, whether it has been about ethanol in some countries or biofuel, which by the way comes in from edible oil. Remember, nearly 27% of global edible oil right now is used as biofuel, and that really is a bit of a concern going forward therein. I want to take you through some certain commodities as well. I'll start with sugar first, and we've been talking about that. The Indian sugar prices near all-time highs, the US sugar prices at 13-month highs, London sugar prices at 15-month highs, and with India now back into the markets, which is going to be buying from international markets, even if it is 1 million ton, has clearly led to sentiment gains for the international markets, which have been working with a global deficit for this year and the next as well. Cocoa futures, or rather cotton futures, should come in on your screen, because we are looking at a 2-year highs onto this one as well. There are crop concerns not just in US but in Brazil as well. The El Nino conditions in September perhaps could impact the temperatures and the yields in India, and that is keeping cotton prices at a 2-year highs. Palm oil prices are trading at a 20-month highs. Indonesia, Malaysia, Argentina are all looking to use palm oil as a biofuel. And then there are growing concerns in sense of production. Demand has been increasing. That is keeping those prices higher. Rubber is trading at a 2-month highs. You have elevated oil prices and anticipated seasonal reduction in supply in these current months, and that is keeping that prices higher. You have grains trading higher as well. Wheat is trading at a 2-month highs. 4-week highs rather. Corn is trading at a 3-month high. You have cocoa futures, which are trading at a 1-month high as well. The major two producers, Ghana, is looking at production declining by 13%. And Ivory Coast has put out a report saying they are also looking at a decline in production by nearly 10%. My final chart should show you on what we've done in sense of food prices till time in 2026. And there you have it, multi-month, multi-year highs for many of these commodities. Soybeans have gained up by 18%. It's a strong 35% gain in wheat futures in the US markets. These are all future prices, by the way. We're looking at palm, rubber, cotton gaining anywhere between 25 to 35% as well. And that's pretty much the case when you look at various other essential commodities around the world as well. You are looking at sugar prices gaining up by 17%. It's a 17% of gain for sunflower oil as well. And then 20% up for rapeseed. Rice is gained up by 47% in the international markets. So everywhere that you look in food, whether it is about pulses, grains, edible oils, everything has been surging in current year till time.
Okay, thank you very much for that. Market's very, very flat. It's a 1-point move on the Nifty now. But let's go across to Hormuz now, because SEBI's latest study tells a different story. Or it tells a story that the retail rush into India's equity derivatives market may be slowing. This is as per this year's data. Individual traders have lost nearly 92,000 crore rupees in FY26 versus 1.12 lakh in FY25. Hormuz is now joining in to put this data and numbers into perspective.
Well, compared to last year's study, the first takeaway is the fact that, yes, retail participation in the futures and options market is slowing down. You take a look at the number of traders, active traders, which were at 98.1 lakh in FY25, have slowed down to 78.6 lakh in FY26. And the number of new entrants also entering the futures and options space is down by 40%, is what a SEBI study is suggesting as well. Now, if you take a look at the aggregate loss of individual traders, that has gone down. But of course, that also needs to be taken into consideration that the number of traders traders has also gone down. So average net loss from 1.12 lakh crore has now reduced to 91,685 crore in FY26. And the only similar trend is that even today, 9 out of 10 traders are still losing money in the futures and options space. The retail traders is what I'm talking about. Although the number from 90.9% in FY25 has come down to 87.7%. Now take a look at the fact that even though the aggregate net loss for individual traders has gone down, the average loss for an individual trader has still gone up compared to last year. So from 1.32 lakh in FY25, that number now stands at 1.5 lakh for FY26. But who's the one that's making money here? Everybody else other than the individual retail trader. Because look at proprietary traders, FPIs, corporates, mutual funds, all of them have gross trading profits of anywhere between 2,600 crore to as high as 45,000 crore rupees for the proprietary traders. Of course, this gross trading profit is before taking into account the transaction costs. But look at the individual traders, 72,243 crore. That's a loss figure, not a profit figure for the F&O space. Now the institutions, take a look at the institutions here. 99% of the FPI and proprietary trader profits came from algo entities. 75% of their profits were just earned by the top 10 firms, and 98% of the proprietary trader profits came from the options market. Now this expiry day, the concentration on the expiry day is also very evident, because 59% of the options turnover has come on the options expiring on the same day, 75% on the day before, and 97% in the options a week before the expiry that has taken place. Of course, there is a comparison that has been made in the study between the futures traders and the options trader as well. An average options trader, 87.7% of the option traders are loss making, while that number comes down to around 66% for the futures traders. Although the futures traders have a much greater loss considering the higher ticket size compared to the options traders. That's almost 2 lakh rupees versus 1.5 lakh for the options traders. Now take a look at the segment wise. If you take a look at the comparison age wise, the average trader below the age of 30 has increased. That number has increased to 43% now from 31% in FY22, and around 90% of those traders are also making losses. The interesting trend in this plate is the fact that women traders, which is 17.1% of the overall traders, have a loss ratio of 84.7%, and that is lower in comparison to the men. That's the interesting one here. Now, the fact that the startling figure here is the fact that 35% of the equity derivative traders have zero equity holdings. 78% of those have a portfolio of less than 1 lakh rupees. Half of those losses that have been, the turnover has been generated by small traders, and 70% of the losses has also been borne by these small portfolio traders whose portfolio size is 1 lakh rupees or less. Now, if you take a look at the transaction costs as well, the transaction cost in FY26 stood at 25,000 crore rupees, taking that total number from FY22 to 26 to 1 lakh crore, and the share of STT, which was 13% in FY22, has gone up to 27% in FY26. Now the option losses as well, the option buyers accounted for majority of the traders, and they were the ones who were loss making. 97% of the traders were option buyers, and only 2% of those were option sellers. And the average loss made by an option seller is 51.7 lakh rupees compared to a loss made by a major options buyer, which was 4.5 lakh, and a pure options buyer, which is only 1 lakh rupees. So a pure options seller makes a significantly higher loss compared to an options buyer. Of course, they say experience teaches you a lot of things, but that does not necessarily translate into profits in the F&O space, because a first year trader, 91% of the first year traders made losses, and 95% of traders who have operated for 4 consecutive years or more have also made losses. And the trend also shows that 90 to 92% of the traders who lost money for 2 consecutive years, they go into a third year and they lose money there as well. So that's the interesting study. The trend is that although the number of traders has come down, the losses have remained consistent, yet 9 out of 10 retail traders in the F&O space still losing money.
Well, you get hooked right to it. Thank you, Hormis, for joining in and explaining that data. Get into a break. On the other side, Lata speaks to agri expert Ramesh Chand on whether the use of ethanol as fuel may hurt farmers and the environment.
The Trump रिन्यू बदल रहा है इंडिया की क्लीन एनर्जी की कहानी और इसके साथ है सूरज, हवा और पानी। रिन्यू क्लीन एनर्जी हमसे है।
Symbiotech Pharma Lab Limited proposes an initial public offering of its equity shares. The 100% book build offer is being issued at a price band of rupees 938 to rupees 988 per equity share of face value of rupees 2 each. Offer opens on Monday, August 24th, 2026. Offer closes on Thursday, August 27th, 2026. For risk involved and other details, please refer to the red herring prospectus and addendum, which is available on the websites of the company, the SEBI, the BRLMs, and the stock exchanges.
Welcome to a very important discussion on It's the Economy on ethanol blending. This was favoured to reduce India's crude import bill, but it is creating its own problems, according to agri experts and the chief economic advisor who wrote a piece in the Mint. They argue that Indian agriculture is shifting from food to fuel, and that's creating problems. Rice and cane are huge water-sapping crops, and they deplete the groundwater. Experts like Dr. Ramesh Chand and Ashok Gulati have long advised replacing rice cultivation with maize, but that's not happening. Instead, India is importing maize. So there is really much less foreign exchange saving. Instead of importing crude, you're importing maize. Also, maize grain, after distillation, becomes an animal feed, and this is pushing down the prices of soya meal and other oil meals, which may lead to farmers moving away from oilseed cultivation, and hence we end up importing more edible oils. That can happen. To discuss this many-sided problem, I have with me Dr. Ramesh Chand from the ICRIER. He's a former Niti Aayog member and, of course, one of the best agri-experts, former Agricultural Prices Commission chairman as well. Dr. Chand, good morning, and thank you very much for joining us. So, at the moment, maize is meeting a large part of our ethanol problems. Is it creating problems for oilseed farmers? Are they shifting to, are they getting lower profits in oil meals? Are they a kind of an injured category here? So I think you're on mute.
Lataji, my answer is not at all.
Okay.
For India, there is a big window available for export of oil cake and oil meals. European country and many other countries, they prefer to buy oil cake, oil meal from India because our oil seeds are not GM. So if we are, say, producing more maize feed, and just saying that it is causing adverse effect on demand for oil cake, oil meal from soybean, I think it is stretching the imagination. There is, as I just said, India has a big window available for export of these kind of things. This is one thing. And okay, then you can raise
What is the other? You also spoke against ethanol blending too much at a recent conference in Delhi. What was your worry about this whole ethanol blending trend?
I was more concerned about E20 from demand side. As you know that 70% of our four-wheeler, 80% of our two-wheelers, they were produced before 2023. So they are not compliant with, say, BS6 and those kind of things. So there are issues of some damage happening to plastic part, some corrosion, those kind of things. So they are the concerns. So that's why
They are not agri concerns. That is a different kind of.
They are not agri concerns.
Yeah.
They are not
What was the agri concern, sir? You have written about rice because it is available. It is getting used for ethanol, and rice is a water sapping crop. You had mentioned that in the past.
You see, effect on agri, effect on food will depend upon where we grow the feedstock, where we grow maize. If we are producing maize for feedstock in the areas where high concentration of rice is there, where it is doing damage to soil, where it is doing damage to water, where it is creating environment problem, where we are talking of diversification. I feel for that, those areas, this corn and its use for ethanol is a great hope. And the productivity, etc., will also be very high in that region. So it make economic sense, it make environment sense, it makes sustainability sense to replace some area under rice with corn in northwest India, where rice is creating all sort of problems. And I have done fine calculation that for rice produced on 15% of area, we are neither able to absorb it in domestic market, nor we are able to sell it in the international market. So, and then you know that whether it is broken rice or normal rice, it costs to government 4,100. And for producing ethanol, it is given at 2,300. And then we do calculation based on 2,300, which is totally misleading and erroneous. So I think maize, among the three feedstock which we are trying right now, maize is the best choice if you considered all kind of cost involved in production of feedstock.
But we are ending up even importing maize, isn't it?
No, we are importing maize because now we have created capacity for ethanols. If we are not having adequate feedstock, and we import it because we have created a capacity for that thing. So in that kind of situation, if the import is happening. But I just find that I would say that if you produce maize in three kind of situation, it become a win-win situation. One is which I have already replaced, that where rice concentration is very, very heavy, and replacing some of the area under rice, that is one area. The second area is a state like Bihar, where maize is spreading in rice fallow. So if some land is remaining fallow otherwise, and we are producing maize there, again, I would say that it is not causing any damage to any crop, nor it is causing damage to environment.
That would be a very good thing. Yeah.
Yeah, which we are taking. But if you just pick up that maize is replacing soybean in Madhya Pradesh, Lataji, that story need to be taken differently. Productivity of maize is 4 times the productivity of soybean. Productivity of maize has increased in last 10 years by 60%. And soybean productivity has not increased even by 6% in last 50 years.
Then, sir, the worry that if we go down this path, we may end up having to import more oil, edible oils. Is that a fair argument?
if we are going to import more edible oil, whether maize is there or not, there are other reasons for it. If we do not have technological change in soybean, we cannot reduce import dependence. We have talked about it repeatedly that unless we increase productivity of soybean, productivity of other oil seeds, India will not be able to improve its Atmanirbharta in the case of oil seed. The roadmap for that is increase productivity. Without increasing productivity, these are all blames that it is.
Fair point, sir. Fair point. I have heard you at length about how this excessive rice production in Punjab has become profitable because urea is cheap, water is, electricity is free, and procurement is at above market price. So there is that excessive rice production which you have spoken about. Have Punjab farmers been able to be convinced to come to maize? Are you seeing any evidence of that problem getting reduced at all?
No, it is very easy. I have spoken to those farmers. In Chandigarh, we presented a study of ICRIER where we call for crop neutral support. So Punjab has been talking of diversification since 1984. But they are not looking that we are giving support to those crops under which we want to reduce area. Our policy and support is exactly opposite of what we want to achieve. I would say that, okay, you do not give any special subsidy on input to maize. You just ensure MSP for maize the way you are ensuring MSP for rice. That first step itself will trigger the change there. And in the case of maize, as I said, that big technological change are happening. Yield is further going to improve. The main issue with Punjab farmer not replacing some of the area under rice with corn is that if the MSP for maize is 2,400, farmer will get less than 2,000 rupees. That is the main reason. So I will say that this first step, that if we are giving 100% MSP for paddy, ensuring even if paddy is of damaged quality, discolored, it will in any case be purchased. Let us give MSP at least for a normal, fair quality maize. You will find that some change will start happening.
So 1 minute. So who is this let us? Is it the Punjab government that is creating this problem?
No, you see, I would say that both center and state need to work out a mechanism. Maize is not purchased the way rice and wheat are purchased. But central government has been giving option to the state under PM Asha to buy oilseed and pulses. I think that kind of mechanism should be extended to maize also. Once this MSP for maize is ensured, price risk is not there, price realized is 25% more than what is market price, you will find the change will start happening.
Okay, and will that be true of Western UP also?
Of this entire belt. You see, barter crisis is much more severe in Haryana.
Yes.
They are giving 15,000 rupee, you just diversify all those things. Unless they do something to MSP, that kind of support will not matter.
Fair point. Thank you, sir. Thank you very much for explaining this to us. So perhaps the aim now is, if ethanol has to succeed as a policy, it is important that other subsidiary problems are not created, and perhaps that could be solved by incentivizing rice farmers to convert to maize farming, at least in Punjab and West Uttar Pradesh. Government policy should abet that. Thank you very much for joining us. With that message, we have to wrap up on Bazaar. Chartbusters after the break.
Linked Far's news agency.
वाह सेंचुरी प्लाई क्लब प्राइम फिर भी कुछ हुई तो
हुई तो फुल कॉस्ट वापस
सिर्फ प्लाईवुड का ना
पूरे फर्नीचर का
इडियट है क्या कौन देगी
सेंचुरी प्लाई
टोटल कवर।
10 साल तक प्लाई, लैमिनेट, लेबर, ग्लू, ट्रांसपोर्ट सबका फुल कॉस्ट वापस इंडिया में पहली बार।
तू ना सिर्फ नाम का चतुर है।
Kotak downgrades IT bellwethers TCS and Infosys to an add rating from a buy earlier. LTM is downgraded to a sell rating from reduce earlier. And TCS is the top loser on the Nifty today. Infosys slips about 1%, while LTM is down about 3%.
Well-spun Corp wins a record $1.8 billion pipe order from the United States. The management tells CNBC TV 18 that the strong order inflows are expected later this year. The stock rallies as this could lead to earnings upgrades for the next couple of years.
UBS initiates coverage on Urban Company with a buy rating and a target price of 180 rupees per share, expecting revenue to grow a 32% CAGR till FY29. The stock surges 5%.
Sugar companies under pressure as the government allows duty-free import of 1 million tons of sugar till the 31st of October as sugar prices spike. The management of Dalmia Bharat Sugar also tells CNBC TV 18 that the sugar prices are expected to stabilize following the government's intervention.
Precious metals rally overnight on safe haven buying as currency and bond markets remain volatile. Gold financiers rally. Hindustan Zinc is also higher as silver prices hit a 2-month high.
Well, hello and welcome to Chartbusters. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel and with me is Ekta. Hey Ekta, markets trading with a mild positive bias this morning.
Hi, Nigel. Yes, overall, quiet day, you'd have to say, for the markets. We're just waiting and watching at this point in time in terms of any kind of firm cues. We do have Brent crude, which is still trading above $90 per barrel. So if you look at it just in the past 2 weeks, it's inched up from levels of around $85.
all the way to close to around $93, $94. So let's see what happens with Brent crude. As of now, the Nifty is just about consolidating with a little bit of a positive bias, up around 19 odd points. We have the mid caps, which are absolutely flat. Good time then to talk about the technicals of the market. Dharmesh Shah is here with us to tell us what he's strategizing at the end of the week. Dharmesh, hi, welcome to the show. Well, for the Nifty, it's just about higher by around 0.08% at this point in time. So quiet day. What would you tell your clients today?
So good morning, Ekta. Absolutely. If you look at the Nifty two-day trading session, I think so it's more for lackluster trading in this range of 24, 230 to 260, 270. But what important is, I think so the Nifty seems to be defending the 4 month of rising trend line. Again, this time also we find a support at around 24,000 and making higher bottoms. I think so. That is important to be watched out for. So we expect, I think, the 23,900, 24,000 range to the very strong support for the Nifty, which in current corrective phase should hold. And eventually, I think so we expect Nifty to head towards 24,600 in the coming week. So yes, things looks more contracting in terms of time. If you look at the Nifty, the range is getting contract. And whenever we see such type of contracting happening, I think so the Nifty seems to be on the verge of a very big move. So we believe, I think so maybe in a couple of weeks, we should look for a target around 25,000 for the Nifty. So any decline towards 23,800, 24,000 should be as a buying opportunity.
Okay, got it. You're sounding optimistic on higher levels. Let's get a few more details then. Give us some stocks.
Yeah, Nigel, if you look at from the medium term perspective, I think so the defense sector as a whole looks to be more positive. I think so it seems to be gaining up the momentum. And where inside the defense space, HL, I think so remains to be a top pick. Again, if you look at the chart, I think so for HL, the stock almost have seen a good correction for last 2 years. Have corrected almost 40 to 45% from the top. But it looks to be, I think so the stock has witnessed a falling trend line breakout of last 2 years, indicating the end of the corrective phase. And we expect, I think, the stock to head towards 5350, 5400, giving a stop loss of 4870. So HL is one which we like inside the defense space. Apart from that, again, textile space, I think, so the one which seems to be gaining momentum in this current week. If you look at the volumes of most of these textile stocks, they seems to be gaining the momentum. So yes, inside the textile space, Gokuldas export is something one which we like. Again, a falling trend line breakout again, and the stock seems to be defending the 200-day exponential moving average. It looks to be, I think, so for target from 868, keeping a stop loss of 770. So HL and Gokuldas export remains to be a top two.
Okay, all right, Dharmesh, we're going to let you go on that note. Thanks very much for joining in and taking us through all of those strategies. Well, let's shift focus to our special segment where we will get you a few ideas for profit from Money Control Pro. Anubhav Sahu of moneycontrol.com joins in now to talk about the stock that he's tracking closely today. Anubhav, over to you.
Well, talking about PCBL Chemical, which garnered investors' attention post ECMS approval for its acetylene black project, which is gaining relevance in energy storage applications. In addition, company has set up a 1,000-ton superconductor specialty black facility at Palej, and its silicon-based anode material plant is also work in progress. Overall, this initiatives position company for higher margin segments benefiting from adoption of electrification. Coming to legacy business of carbon black, recent trade agreements of India provide competitive market access to regions like Europe. Further, shrinkage of carbon black supply from Russia provides an export opportunity to Asia, Europe and Middle East. In addition, company sees good traction for US customers post reduced tariffs. While we are positive about medium to long-term opportunities, stock has run up by nearly 40% from March lows. It is trading at a valuation of 12 times CE by EBITDA for fiscal year 28, which is not cheap, and given the leverage in the balance sheet, it warrants caution. In addition, Q2 could possibly see some softness in volume growth due to cautious procurement from clients. Also, there could be some inventory benefit reversal in Q2. Hence, we believe investors can take some profit from the counter.
Got it. Thanks a lot for that. We'll keep an eye out on that particular name. For the time being, though, we slip into a short break. On the other side, precious metals value chain player Augment Enterprises is joining in to talk about their 825 crore issue. We'll get the management on the other side. Stay tuned.
Republicans back.
Some properties are not just homes. They are statements, achievements, legacies. At India Sotheby's International Realty, we represent the country's most exceptional properties with unmatched expertise. Unique homes, uniquely for you.
रिन्यू बदल रहा है इंडिया की क्लीन एनर्जी की कहानी और इसके साथ है सूरज, हवा और पानी। रिन्यू क्लीन एनर्जी हमसे है।
Welcome back. You're still watching Chartbusters on CNBC TV 18. Well, Augment Enterprises, its 825 crore IPO has opened for subscription today. The company operates across the precious metals value chain and services customers across India as well as international markets. The offer consists of around 620 crores via fresh issue and an offer for sale was around 200 odd crores. The promoter and the whole-time director, Ketan Kothari and Sachin Kothari, the non-executive director at Augment Enterprises, are joining in the studio to discuss this issue and the business. Ketan as well as Sachin, thank you very much for taking the time out.
Thank you so much, Ekta and Nigel.
Well, you know, Ketan, I'm going to start by asking you to just simplify the business because you're across the value chain when it comes to gold and silver. If you look at your revenues, it looks mind-bogglingly high with low margins. Just explain to us which is the one segment that you get majority of your revenues from, and just simplify why the margins are so low and the revenues are so high.
Sure. So, Ekta, let me explain the business model. This company was incorporated in 2012. The idea was to solve gold-related problems using technology. Before that, you know, what used to happen is every transaction used to happen on the phone. It was very tedious and not scalable. Right. For every 10 calls, like one call would convert into a transaction. Before that, the derivatives exchanges which are there in the country, they tried on the spot exchange. But the very nature of this industry is such, not only in India but globally, where an exchange with a matching engine technology does not really work well, in the sense that the counterparty or the jewelers are not okay with the standardized contracts when it comes to delivery. Not only in India but globally, you see in the London local market also. So then we took a call that, we need to use technology to solve this particular problem. Obviously here, the difference between an exchange technology and our technology on the spot platform is that we have a counterparty, which is Augment always. So Augment is a counterparty to every buyer. Augment is a counterparty to every seller. So on the platform, we have like 5,223 jewelers all across India. These are national chains, regional chains, small jewelers in like smaller towns like Jalgaon and Ichalkaranji, all those places also. And they need the physical requirement on a day-to-day basis. So they book as little as 100 gram of gold bars or 1 kilo bars, and we deliver them through our delivery centers across India, which is 20 delivery centers. On the back end, obviously, because of the scale that we have, we are able to source from all the sources, whether it is our own refinery, whether it's a competing refinery. Because the platform is independent, we source from competing refineries also, from banks, international banks, IIBX, local markets, scrap market, ETFs, whichever is the best source. So the platform identifies which is the best way to source and determines the price, and we are able to make the market and give the delivery. So that's the B2B spot business, which is like a platform where jewelers are able to procure the gold and silver. Obviously, the revenues will look high if you go to see, because everything goes through our balance sheet. It's not like a marketplace where the buyer and seller, they do the invoicing directly. But if you go to see in further details, if you see on a console level, although our business was 94,000 crore, when you remove the cost of gold and silver, our spread income or overall income was 580 crores. So that's where we make the money between the spreads. And profit after tax was 348 crores, which is 60% of the net revenue. So that's how we see our business overall. Our working capital cycle is just 1.76 days, because that's the time taken for us to make the payments to the supplier before we receive the payment from the jeweler. And we deliver only after receiving the payments from the jeweler. Okay. So that's the B2B model. And then we have the consumer business as well.
All right. Welcome, Ketan, as well as Sachin. I like to look at interesting businesses, and you all have come with a bit of a, something different you're offering to the investors. So it's going to be interesting to see how things pan out. If I look at the valuations, it's at around 18 to around 20 times on a PE or an EV upon a EBITDA basis, going by what you're saying. Give us a few more details. The part of it is going to be an OFS, part of it is going to be a fresh issue. So the OFS, you all can have a blast with it. But what about the fresh issue? What is that money going to be used for? Because the investors that will be giving all that money, they want to know that, right?
So as Ketan mentioned, our working capital cycle is 1.76 days. And when the jeweler is actually buying on the spot platform, he is supposed to make the payments within 2 days, after which he can take the delivery. Meanwhile, on the supply side, we have to make the entire payment and procure the gold, make sure that it is in transit. And for that, this 2 days, approximately 2 days of working capital is required.
Yes.
Now you see, because of the increasing gold prices, my tonnage has gone down for FY26. We did 61 tons in FY25, which has gone down to 53 tons in FY26. We need more capital to start addressing all the jewelers that are there on the spot platform and maintain the tonnage. And that is why almost 75% of the proceeds, the IPO proceeds, are going to be utilized towards working capital.
Got it. Okay. Perfect. Got it. All right. Give us a little bit more detail. As you said, I think 86% is going to be B2B. Yeah. Retail will be a smaller part of that business. Profitability will be the same in both the verticals?
So the profitability for the B2C business is obviously better as compared to B2B. The profitability for B2C business is better than the B2B business.
That's normally the case, but I just thought in your kind of business.
But one interesting thing I would like to share here is the B2C business was 3% of the overall revenue for FY24. It has gone up to 7% in FY26. So the B2C business is also growing, and that is evident from my PAT margin for the console basis. My PAT margin has gone up from 0.2% to 0.35%.
How much better are the margins on B2C versus B2B?
So various product mixes, the profit margins range from 1% to 3% for the B2C products. On the B2B side, the profit margins are around 0.25 to 0.45%.
So currently B2C is around 7% of your total revenue. Yes. Yeah. What is your target? What do you want to build it up to, say, in the next 1 to 2 years?
Sure. So if you go to see the RHP, the reason why we are raising capital is that, although as Sachin said, the tonnage has gone down, it's not that the jewelers are not demanding more gold from us. It's just that we don't have the capability with the limited capital, and we can't leverage our balance sheet as per the rules. So that is the reason why our strategies are threefold. One is on the spot platform, we want to onboard more jewelers. We want to have more delivery centers. We've been stuck with 20 delivery centers since a while now.
Sure.
On the B2C front, if you go to see, we want to continue with more and more partnerships. Today, we have 4.9 crore customers on the Gold for All platform. We have 218 fintech partners where there is an API integration, and those fintech partners cross-sell the gold product that we have on the Gold for All platform. We have 4,691 touch points through which customers are able to do various things, including EMI jewelry, which is an investable product. They're able to do loan against gold and selling of old gold through the Gold for All stores, which is like 106. So the idea is to increase that business. Obviously, that's a strategy which we have pointed out in the RHP.
But to what level? What would be the percentage that you would want the business to go to for B2B and B2C?
So we want to continue the way we have grown on the B2C side, because retail business is something.
Sub 10%, would it be sub 20%? What would it
so
be?
unfortunately, I'll not be able to give you a number in terms of what is it that we are looking for.
It becomes a forward-looking.
Yeah,
Alright.
but yes, we intend to grow, as you've mentioned it in the strategy,
Right.
both the B2B and the B2C business.
I think one of the questions that the investors would also want to know is that what happens to your margins going forward? Because while you have a stupendous revenue, that's obviously not reflecting in terms of margins because of your business model. So what can you guide for when it comes to, say, increasing margins, and what is a sustainable rate that investors should expect, and by when?
Ekta, as I said, in terms of our business, because we have to book the entire transaction on the balance sheet, obviously the net margin seem much lower. But when you see the overall matrix, which is the net revenue that we earn of 580 crores, of which we made a PAT of 348 crores, which is 60% of the net revenue. Those are the metrics, plus the fact that we don't have literally no debt. We have a 2-day working capital cycle. So that's the kind of velocity business that we are in. As far as our margins are concerned, you can see historically that we have improved upon our margins because of the leverage that we have because of the platform. On our refinery front, again, we have mentioned that refinery is just an extension or backward integration. Our strength is these platform businesses. But on the refinery front also, when, say, for example, if we are able to get more accreditations, the supply chain improvement will happen. And this is also as part of our strategy.
Okay, all right. What about international business? As a percentage of your mix, that as well is relatively small. You see a potential of that increasing? If you could help us out on that front.
So on the export side, we have an SEZ facility in Jaipur where we manufacture basic jewelry and export to countries like Hong Kong, UAE and Turkey. That contributes to about 6% of the overall revenue. And this is more of an order-based system where if there are any orders, we manufacture the jewelry and give with the orders to the customers. And we intend we'll keep it at the same level. We don't have any visibility as such that how we are growing the exports business. But it's because it is order-based, we continue with the same set of customers and continue.
There's a profitability difference in international and domestic business?
The margins on the international side, export businesses are more than 2%, 2 to 3%.
And that compares with around less than 0.5% on domestic business. Is that correct?
Yes.
But the export business is relatively a newer business.
Correct.
So obviously that's something that we are still working on.
Yeah, I know. I think you'll have launched even lab grown as well, going by the demand. Very, very small right now, but probably there'll be potential. I'll tell you what, gentlemen, we thank you all for coming down to the studio, explaining the business to us. Tell us, how do you all see things evolve? Your banker is going to be okay because you haven't given us any forward-looking numbers. But when you join on listing day, we'll push you for that. Thanks a lot
Thank
for
you
joining.
so much.
Well, we'll slip
Thank
into a
you.
short break, come back, and we'll continue to focus on markets and stocks that are moving around. Stay tuned.
Bluntly.
Symbiotech Pharma Lab Limited proposes an initial public offering of its equity shares. The 100% book-built offer is being issued at a price band of rupees 938 to rupees 988 per equity share of face value of rupees 2 each. Offer opens on Monday, August 24th, 2026. Offer closes on Thursday, August 27th, 2026. For risk involved and other details, please refer to the red herring prospectus and addendum, which is available on the websites of the company, the SEBI, the BRLMs, and the stock exchanges.
वाह सेंचुरी प्लाई क्लब प्राइम फिर भी कुछ हुई तो
हुई तो फुल कॉस्ट वापस
सिर्फ प्लाईवुड का ना
पूरे फर्नीचर का
इडियट है क्या कौन देगी
सेंचुरी प्लाई
टोटल कवर।
10 साल तक प्लाई, लैमिनेट, लेबर, ग्लू, ट्रांसपोर्ट सबका फुल कॉस्ट वापस। इंडिया में पहली बार।
तू ना सिर्फ नाम का चतुर।
Welcome back. We'll just focus on the broader markets. As a stock like Kilburn, the stock has come down drastically. I think it corrected close to 30% from the top. The numbers were not very, very good. But on the con call, the management sounded optimistic. So Kilburn suddenly has seen a bit of a volume spike. And I'm looking at the exchange. It appears the promoter entity has bought 50,000 shares to around 1 lakh shares in this week itself. Big correction from the top, but popped up today. It appears the promoter creeping in has given it some kind of hope. But otherwise, I think it's a 550 rupee stock that came down all the way to around 350 rupees. So keep that in mind. Well, let's listen into an exclusive interview to CNBC where US Treasury Secretary Scott Bessent said that a debt buyback program announced Wednesday could be larger than the $4 billion upper limit. He added that there's a very good chance that the United States budget deficit under President Donald Trump has peaked out. Let's hope.
We're trying to signal that we think that this is a thinly traded area of the market, that we're in August, and there's been a lot of corporate issuance that's influenced the market. And we believe that there are many underlying factors that the market is not looking at. And we are going to make a market in these. We routinely do buybacks, and we're going to increase the size of the buyback. And Sarah, I would note that it could be more than the $4 billion per issue. I think that there's been a lot of misinformation in terms of what's going on with the deficit, what's going on with the deficit to GDP. We actually had a fiscal consolidation for the calendar year 2025. We were at about 5.7% of GDP. And one of the things that's temporary here that's influencing the deficit has been these tariff refunds. And we won't have to do that again. And the Ambassador Greer, through the 301 process, is re-implementing the same level of tariffs. And I would expect that our 2026 tariff income is going to be roughly what it was in 25. And we're going to be able to keep that in terms of the budget consolidation.
So do you think we've seen peak deficit during this administration?
I think a very, very good chance we have.
Okay, important takeaways coming in there. The tariff revenue will be similar as 2025 and 2026 for the US government. Well, on that note, it's a wrap on Chartbusters, but stay tuned. Trading hour just after a short break.
Facing some of these challenges.
Good morning, you're watching Trading Hour. We are coming to you live from the CNBC TV18 Motilal Oswal studio on the final trading day of the week. I'm Hormuz Fatakia. With me is Ritu Singh. Ritu, good morning to you. Markets have gone into snooze mode and expected lines ahead of the weekend, I guess. But that's been the state. But we are still down for the week. But the bulls will take the fact that we are not down at least.
Yeah, we're not down, but yeah, down for the week. Hopefully we reverse that trend in the coming one. But the market breadth is looking strong though. I mean, you have about 1,800 stocks that are rising for about 1,321 stocks that are on the decline. But before we get you more on the markets, quickly look at the flashes at the bottom of your screen. You have ICICI Bank's board, which has approved overseas borrowing of up to, and the keyword is up to $5 billion. Remember, just this morning, we reported how HDFC Bank is the one that has tapped these overseas borrowing markets to raise $1.75 billion. And with its previous raise, the total raise was about $2.5 billion. And now you have this large one, up to $5 billion from ICICI Bank. We'll have to see how much the bank actually goes out to raise. But, this is a very much along expected lines, a rush of banks coming to raise this money before the window closes. Remember, banks are able to raise this money overseas at a cheaper rate because RBI is absorbing a part of the cost when they do this dollar borrowing. And this is all part of the RBI special scheme, to bring in more dollars into India. The FCNR window, of course, as we've been reporting here, is closing a month earlier, end of August, end of September. So, as banks, rush to raise deposits and they're also looking to offer leverage, you will see more and more of them tapping the overseas bond markets to raise money in this concessional window. This seems to be the largest one by far that we've seen, up to $5 billion. But again, let me repeat, probably the bank may not raise the entire amount, but this is an enabling resolution that the board has now approved a higher limit of raising up to $5 billion as and when it does tap the market. The bank, in fact, had recently raised some money. I think it was about $750 million or so from ICICI Bank, which was at a good 100-odd basis points above the US Treasury rate. So, it's pretty attractive right now for the banks out there, a rush of them going to raise money, and ICICI Bank is the latest one joining this list. But let's go across to Hormuz. He's putting the spotlight on individual movers and shakers in the market as always. Over to you, Hormuz.
Paisa hi paisa hoga is what comes to mind when you read that line at the bottom of your screens. But, well, it's been a very ho-hum week for the market, if you would like to call it that. After 7 days of losses, we bucked the trend yesterday. We are looking to continue bucking that trend today as well. Around 30 points higher on the index and not much action you're seeing on the benchmark. The divergence between the spot and the futures price is less than 50 points as of now. So, the market has gone into a bit of a pause mode with no directional trigger as such to take the index higher. Take a look at the Nifty Bank as well. Yesterday, the Bank Nifty tried crossing the 57,500 mark, could not sustain above it, and yet again it is back at 57,700, around about yesterday's high yet again, which is where supply had started to emerge in yesterday's session. So it'll be interesting to see if it manages to hold on to these levels as we close out for the week. Here too, the spot futures divergence is less than 100 points, which has not been the case for a major part of this week, but it remains to be seen whether these gains sustain or not. Two important levels that you need to watch out for. The Nifty Bank with this move has turned positive for the week. It needs to close above 57,491 to have a positive weekly close. The Nifty though is still some distance away. 24,366 is the level that it needs to close above for a weekly gain. Last week's this Monday's high is 24,360, which also happens to be the high for the week. Metals as a sector has been doing well. Of course, a lot of the other base metals in the global markets have done well, but the dollar weakness is also adding to that strength. Hindustan Zinc, Hindustan Copper, Vedanta, Nalco, all of them seeing gains of anywhere between 1 to 3%. A slew of brokerage reports have come in earlier in the day, and Urban Company had an initiation today. The stock is up 7%. IIFL Finance had an initiation today from JP Morgan. That is up 7.5%. SBI Card is down. The Bernstein rating, which is the lowest on the street now, the Bernstein target, 430 rupees. That's a 33% downside from current levels. And LTM, yet another IT sector downgrade coming in this morning from Kotak. A lot of companies reacting to order wins. Welspun Corp is now up 14%. It's at a record high, and on a year-to-date basis, the stock is up 180%. That's the kind of moves that we've seen on Welspun Corp. Data Patterns has done well after an order win, and RailTel too is reacting to another order that it has won. Look at the newsmakers. JBM Auto is reacting to a newspaper report of some capital infusion from Bain. 6% higher on that stock. Of course, CNBC TV18 has not independently confirmed this story. Moltech Packaging has recovered from the lows of the day after the board is going to consider a bonus issue on the 26th, and Shanti Gears is now up 20% after its parent company, that is Tube Investments, has increased its stake in the company to well over 73%. And lastly, stocks at 52-week highs. Look at Welspun Enterprises. That one is another one that's doing well. Jindal Saw is up 4%, Jana Small Finance Bank is up 5%, and Man Industries too 7.5% higher at record high levels today. All of these stocks doing well in the broader markets, Ritu.
All right, Hormaz, thanks very much as always for putting the spotlight on individual names we must keep our eye out on. But let's get back to the big story. We just heard from ICICI Bank that it is looking to raise up to $5 billion through overseas borrowing. So we'll have to see to what extent that materializes. But look at HDFC Bank. That's the one that's already tapped the markets. And so far, it's been the largest such bond issuance since the global financial crisis. $1.7 billion fundraise in 2 tranches, that the bank is now doing at pretty attractive rates, about 88 to 100 basis points above the US Treasury rate. So let's hear out from Arup Rakshit, who is the Group Head of Treasury at HDFC Bank, on this raise and the kind of rates they were able to raise it at.
We go up across and raise money when we see a customer interest in whatever form and shape. So we have always been doing these kind of transactions based on customers' demands and interest. So yes, we have raised about $2.5 billion already through the public bonds in this window so far. And it's too preemptive to say whether this is the last or there will be further issuances. As I said, it will be client-dependent, customer interest-dependent. Never say never. The demand from the investors was very, very strong this time. At its peak, the order book was $7 billion, which was quite a significant one, and just shows the strength of both the Indian banking sector and obviously the investors' belief in the HDFC Bank itself. Yes, the pricing, you are right. It was for 3 year, we got a T plus 88 basis, and for a 5 year, it was T plus 100 basis. And in July, we had raised the Reg S bond at T plus 90. But since then, the spreads had widened with so much issuance out of India. But I mean, from a comparative perspective, if you see the other players where they have been raising, T plus 100 was well within what some of the people have raised in the last 7 to 10 days.
Another big fundraising story coming from 2 of the largest private sector banks in the country. HDFC Bank, of course, raising the funds. ICICI Bank, of course, on an enabling resolution. $5 billion is that enabling resolution for. At the highs of the day now are both of these stocks. Take a short break. On the other side, we get you a chat that Manisha Gupta had with Preeti Chheda, the CFO of Mindspace REIT K. Raheja Corp Investment Managers. Stay tuned.
Uranium.
Symbiotech Pharma Lab Limited proposes an initial public offering of its equity shares. The 100% book build offer is being issued at a price band of rupees 938 to rupees 988 per equity share of face value of rupees 2 each. Offer opens on Monday, August 24th, 2026. Offer closes on Thursday, August 27th, 2026. For risk involved and other details, please refer to the red herring prospectus and addendum, which is available on the websites of the company, the SEBI, the BRLMs, and the stock exchanges.
Welcome to Bond Street. Joining us now on the show is Preeti Chheda. She's CFO, Mindspace Business Parks REIT, K. Raheja Corporate Investment Managers. Preeti, hi, thank you so much for joining in. And the viewers who are still new to the idea, what really is REIT all about and what does Mindspace Business Parks let an ordinary investor own that they simply couldn't before?
Perfect. Firstly, thank you for having me here. So REIT, if you look at, it's a vehicle which is actually housing largely completed real estate. And from an investor standpoint, they can actually own a piece of that real estate. So today, if any common man has to just go around and buy a real estate, it's not that easy for anyone to actually own real estate, especially in the larger cities. But REIT gives an option for you to actually own even a piece of it by actually just investing in these instruments, because all these instruments are backed by large property owners who are having huge portfolios which are diversified across cities. So you actually get to own that real estate by not actually investing so much more. So I think that's the gap which was there in the country, where you had physical real estate, and Indians generally like to own real estate. So this instrument actually helps investors own real estate without committing much capital.
All right. So a bond pays a coupon while a REIT pays a regular distribution. For an income-seeking investor, how should they think about REITs payout next to bonds?
So I'll tell REITs are bridging the gap between equity and debt.
Okay.
So they have two streams of earnings, I would say. So one is your regular income, which comes every quarter. Though SEBI requires half-yearly distribution, but most of the REITs are doing quarter. And the other one is stock price appreciation. So when you were to compare with a bond, what you're getting here is, of course, the regular stream of income, very similar to a bond. But of course, the difference is we don't guarantee that, because it's all backed by business income.
Sure.
So till the time you have the income, you obviously have these cash flows coming in. And the other thing which the REITs give is the appreciation in the stock price, which obviously in the case of a bond, it just remains the same set of coupon for the tenure which you've signed up to. But here, with every going year, because the portfolio grows, the rentals grow, so your yields also keep growing, and then plus you're getting the stock price appreciation. So that's a distinction. So two different set of products, I would say, but this has the beauty of both the debt instrument as well as equity.
Of course, absolutely. When you talk about the retail investors, and now they can buy a bond as little as 10,000 rupees
Yes.
as well. What would you say has the online bond platforms done in sense of getting it to the retailers who couldn't earlier participate into this, now being part of it?
So I think that's a very big development by making the ticket size affordable to everyone. So today, I think it's a digital age. The young investors who are even actually during their school, college days also, young talent has actually taken to investing. So for them, this makes things so much more simpler. All that they have to go is just log on to any account and just buy the way you buy any equity stock, or for that matter, with REIT also it's similar. So I think that's a revolutionary thing which has happened, and this will go a long way in creating, we any which way say that Indian debt market has to still get the depth, and these are things which will actually enable that happen in future.
As a CFO, when you look at REIT, what are the 2 or 3 numbers that you watch out for as real signals of health?
2, 3 things. First and foremost, because we are looked at as yield plus growth. So when we look at yield, then our NDCF, which we call the net distributable cash flows, which is a distribution we make every quarter, that I think becomes a very important metric, because that's how a lot of income investors measure us, because they are expecting a regular yield. I think other 2 parameters, because at the end of it, the underlying asset classes, an office or a mall or any other real estate asset, occupancy, the NOI, which is net operating income, these are parameters which make a very big impact, because the better your occupancy, the better are your earnings, and therefore better the distribution. So these are 2, 3 parameters which we very closely watch and deliver.
Also, SEBI caps how much debt a REIT can carry, so you can't simply borrow your way into the growth. How would you balance this? What would you advise?
So we actually strike a balance between our growth and the debt. The only 2 ways for us, because we distribute almost 90% plus, all of us do very close to 100%. So we are not really left with money to grow. So the only way for us to grow is either raise equity or we raise debt. But obviously, this is I would say, medium risk, medium return instrument. So we have to watch the risk which we take in a REIT. So we generally try to see, if you look at the history which we have for the last 6-7 years, most of us try to be in the 30-35 range. And as and when we believe that we are getting closer to that, people are coming back and again raising equity. So we are maintaining a balance so that we don't get to almost 49%, which is allowed under the reg.
Sure.
But at the same time, some debt is healthy also. Because if you really want to better the returns for your equity investors, then I think some level of leverage also becomes critical. So I think 30-35% is somewhere most of us land up with. And then if we go beyond that, then obviously you have the option to go ahead and raise more equity.
Oh, absolutely. When you talk about Mindspace itself, and it's a AAA rated issuer in the bond market with a long series of entities, that is, from issuer's chair, what role does the bond market play when it comes to funding a REIT?
I think very critical role. Because if you see, after a very long period, the first REIT happened in 2019. It is today that RBI has allowed banks to lend to REITs. Otherwise, all this time, we didn't really have banks which are lending at the REIT level. So the only source for us to raise debt was to go to capital market. And therefore, capital market for REITs are extremely critical, because most of the funding, which was all these years that has happened, it's all happened at the REIT level through capital markets. I would say capital market will continue to play a very important role. And also, I think the beauty of debt capital market is we have the flexibility of doing different tenors, 3 years, 5 years. Of course, the appetite for 10 years is still very limited. But over a period, we've seen different set of investors. We have right from mutual funds to insurance companies, pensions, NBFCs, all of them participating, and hopefully now banks also should. So it just widens the avenues of fundraise for us.
What would you really advise for somebody who's investing money, whether it's REITs or it's bonds therein? What tells businesses on what genuinely is underneath that?
So I think whether it is bond or whether it is REIT, at the end of it, the stability of the income that a particular REIT or a company generates, that's very critical. Now, of course, in case of a bond, because you have the obligation to give a particular coupon. So, but at the end of it, the risk which is associated with every bond, it's at the end of it backed by the financial performance of that entity. So I think one important is the stability and the robust balance sheet that each of these issuers have. So I think that is something which I would definitely watch for.
Potential of AI for
Some properties are not just homes. They are statements, achievements, legacies. At India Sotheby's International Realty, we represent the country's most exceptional properties with unmatched expertise. Unique homes, uniquely for you.
रिन्यू बदल रहा है इंडिया की क्लीन एनर्जी की कहानी, और इसके साथ है सूरज, हवा और पानी। रिन्यू क्लीन एनर्जी हमसे है।
Symbiotech Pharma Lab Limited proposes an initial public offering of its equity shares. The 100% book build offer is being issued at a price band of rupees 938 to rupees 988 per equity share of face value of rupees 2 each. Offer opens on Monday, August 24th, 2026. Offer closes on Thursday, August 27th, 2026. For risk involved and other details, please refer to the red herring prospectus and addendum, which is available on the websites of the company, the SEBI, the BRLMs, and the stock exchanges.
वाह, सेंचुरी प्लाई, क्लब प्राइम। फिर भी कुछ हुई तो हुई तो फुल कॉस्ट वापस। सिर्फ प्लाईवुड का ना? पूरे फर्नीचर का। इडियट है क्या? कौन देगी? सेंचुरी प्लाई, टोटल कवर।
10 साल तक प्लाई, लैमिनेट, लेबर, ग्लू, ट्रांसपोर्ट, सबका फुल कॉस्ट वापस। इंडिया में पहली बार।
तू ना सिर्फ नाम का चतुर।
CNBC TV 18 tracks the pulse of markets and business in real time, bringing you the stories that shape the economy.
From breaking news to sharp analysis, we deliver insights that help you navigate businesses, markets, and investment opportunities.
Novama presents CNBC TV 18 Market Central.
Providing sharp market intelligence for wealth creation with a commitment to doing it right.
Welcome back. You're watching Trading Hour. Now, SEBI's latest study shows that the retail rush into India's equity derivatives market could be slowing down. Now, this is according to this year's data. Individual traders have lost about 91,600 crores in FY26 versus about 1.12 lakh crores in FY25, even as participation dropped by about 40%. Let's go across to Hormas, who will help put all of this data into perspective.
Well, SEBI's latest study has two messages. One, change is the only constant, but there are certain things that don't change. Now, the first one that has changed is the fact that the new entrance into the F&O market for retail traders has come down from 98 lakhs in FY25 to 79 lakh in FY26, and even the new participants too are down 40% on a year-on-year basis. Now take a look at the losses made by the aggregate individual traders as well. While participation has come down, so have the losses from 1.1 lakh crore to 91,000 odd crore rupees in FY26. But take a look at the traders who lost money. Last year it was 9 out of 10. Even today it's 9 out of 10, although the number from 90.9 has gone down to 87.7%. But the losses made per trader has gone up from around 1.32 lakh in FY25. That average loss per trader has gone up to 1.47 lakh crore in the F&O space. But who's making money here? Everybody other than the retail participant. Look at proprietary traders, FPIs, corporates, mutual funds. All of them have made anywhere between 3,000 crore to as high as 45,000 crore rupees. That's the gross traded profit, of course. That is not before accounting for the transaction costs. But look at the individual figure, 72,243 crore. That's a net loss in FY26. The expiry day obsession too, and that has also contributed to the majority of the turnover in the F&O space. But the index options turnover, 59% of it comes on the same day, 75% of it comes the day before, and 97% of it comes the week before the expiry takes place. Of course, there are two segments as well, futures traders and the options traders. The options trader, although futures traders have made a significantly higher loss compared to the options trader, but the number of the segments making a loss as well, that has come down. But take a look at the age-wise gap as well. The interesting trend here is there are two of them. Age less than 30 from 31% odd in FY22, that number has gone up to 43% in FY26. And the women traders, 17% of the overall percentage. The loss-making ratio here is 84.7%. That is lesser compared to the men. Now take a look at the trading versus the speculation activity. 35% of the equity derivatives traders have zero holdings in the equity. The equity portfolio, 78% of those have an equity portfolio of less than 1 lakh rupees. The small traders as well, they are the ones who contribute to 51% of the turnover, but they are 70% of them are also bearing the majority of the losses as well. So that is the loss-making trend you see among the smaller traders. The transaction costs in FY26, 25,000 crore rupees. Over FY22 to 26, that figure has gone up to 1 lakh crore, and that STT share, which stood at 13% in FY22, has gone up to 27% at the end of FY26. Look at the option buyers as well. They accounted for majority of the traders, and they accounted for majority of the loss making as well. But there is a significant risk in being an option seller. Take a look at the next plate. That shows you why. 51.7 lakh is the average loss for an option seller. Compare that to a major options buyer and a pure options buyer, that is anywhere between 1.5 lakh to 4.5 lakh rupees. The experience may teach you a lot of things. It may not necessarily bring you profits. The first year traders have 91% of those making losses, but look at the participants who have been in the market for 4 years or more. 95% of those are still making losses, and 2/3 of those who participated in all 5 years have still lost money. And the last one, of course, 90 to 92% of the traders who lost money in the first 2 years went into the third one and lost money there as well. So of course, the interesting bit is the fact that women traders are making lesser losses than men, but the one thing remains constant, that 9 out of 10 retail traders are still losing money in the F&O space.
Well, Hormaz, you may have gained some money because you won that bet just about 3:30. Thanks very much for filling us in with great speed on this very interesting report. But let's move on and get you the next cues. This one coming from the F&O space. Sudarshan has the latest.
The same segment for which Hormaz was talking, that 9 out of 10 people make losses. So talking about today's market has come off lows and now it's in the congestion zone. For Nifty, 24,200 to 24,300 has emerged as a congestion zone. Both aggressive put writing and aggressive call writing we are seeing. At 24,200, put writers are very aggressive, and at 24,300, call writers are very aggressive. But if you can talk about the bias towards, it's about the upside. The reason, it's reflecting the Nifty PSU, which has moved a bit higher from previous day's level of 1.12. Now we are at 1.15. Now coming to the options data, 24,200 and 24,250 specifically on the put side are seeing maximum change in the open interest, while on the call side, 24,300 is seeing maximum change. Support for Nifty, 24,150, and resistance would be 24,350. Buying will return only when we cross the level of 24,350 comfortably. As far as Nifty Bank is concerned, 50 DMA of 57,550 can be the support. As far as the resistance is concerned, it would be 58,000. Some of the stocks that are in the focus, Bharat Dynamics, yesterday it had seen a sharp fall. Today is seeing short covering. AB Capital for second straight day, it's seeing addition on the long side. Premier Energies 2 for the second straight day addition on the long side. And lastly, Power Grid in the last 1 to 2 hours has seen aggressive addition on the long side.
Interesting moves on Power Grid, 3% higher on the stock. Is not a nifty name that we speak about very often, but Sudarshan, thank you for highlighting that to us, as you always do, bringing out nuggets that nobody really talks about. But thank you for that update from the F&O desk. Jay Thakkar from ICICI Securities now joins in for a quick chart check. Jay, good morning. Thank you for taking out time. Well, the index has finally managed to defend 24,000. The question is, for how long will it manage to do so? What's the trend on the charts right now, and your trading ideas for the morning?
Hi, very good morning to you, Hormaz and Ritu. Well, see, 24,000 levels, Hormaz, I would say is very critical for this August series. Cumulative put base is at 24,000. And in fact, not only for the August series, even for that September series, if you look, 24,000 has been acting as a very critical support since past couple of trading sessions, despite weak global cues, despite no market participants are able to defend these levels. Hence, this becomes very critical, Hormaz. Until these levels are held, I think, on the upside, we can see Nifty testing the upper end of the range, that is 24,500 to 600 again. And what could be the reason? I think that Bank Nifty or the financials could be the reason. BFSI has relatively outperformed Hormaz, and I think that Bank Nifty above the levels of 58,000 would see that breakout. And above that, it would be a good breakout which can take Bank Nifty to all-time highs, probably 259 to 60,000 levels as well. So we are hopeful that we would be seeing that short covering happening on the banking and financial space overall, because there is where the shorts have got added recently in this current fall. But then, a few of the stocks within that space, particularly I would say PSU banks and few of the private sector banks could hold well, and Bank Nifty could trade within that very tight range of 57,000 to 58,500. That's a very tight range of 1,500 only, where Nifty almost corrected by 600 points. So I'm hopeful for a breakout on Bank Nifty, and I think that could help Nifty to inch towards the upper end of the range.
And what about specific stocks, Jay?
Sure, Thomas. Now, see, overall within the capital market space, we have seen the AMC stocks doing quite well, and I have got a buy recommendation on Nippon Life AMC, trading around the levels of 1250, 1260 zone. Thomas, I think that it's heading towards the levels of 1350 positionally. One can place a stop loss below 1220 and go long on Nippon Life AMC. That's the first buy recommendation. Second is on HDFC Bank. Now, that's a contra bet, I would say, at the current levels, but then we have seen good shorts addition out here, and today we have seen a good reversal also happening. It's an early sign of a short covering, and I'm anticipating further shorts, which can take the stock to 765, 785 in the near term, at least then in the first week of the September. And on the downside, I believe that 700 levels would now act as a very, very critical support. Homas, I think that out here the risk reward is quite favorable on the long side, and this is one of the reason I think that Bank Nifty may take of the levels of 58,000 going forward. And the third buy recommendation would be from Nifty Realty, and this is one space apart from Nifty Pharma, and this is one space I would say which have been outperforming the overall markets. And within that, I've got buy recommendation on Prestige, which is trading around the levels of 1616 on the spot on the futures, I would say. This stock is likely to see further up until the levels of 1670 to 1700. One can place a stop loss below 1580 and go long on Prestige as well.
All right, Jay, we'll leave it at that. Thanks very much for joining us here with those takeaways. Quickly take a short break, but when we return, we'll get you more on market fundamentals with Christy Mathai from Quantum AMC. Stay tuned.
Is
Welcome back. Well, continuing our conversation on the markets, then Christy Mathai from Quantum AMC is now joining in to talk markets and, of course, his top sectoral preferences as well. Christy, good morning. Thank you for taking out time. Well, the earnings season turned out to be a lot better than what was anticipated. What stood out for you this time around in this earnings season?
Great. Thanks for having me. So clearly, the earnings trends, at least the quarter gone by, has been pretty resilient, and in fact, resilient from a margin standpoint also. Some bit what we see is that inflation in some of the input has sort of translated in sort of revenue growth, as a lot of companies across sectors have gone on taken the price hike. And the margin expansion came primarily because they were sitting with some of the low cost inventory that was built up earlier. Now the key is sort of to see how this sort of trends going ahead. In terms of key sectors that if you were to just look at it, we were a bit surprised by how the banks sort of moved, especially the cost of deposit pressure sort of still lingering on for the banks. This was supposed to be a year where you possibly saw that spread expansion, but so far it has not come about. And possibly going ahead also, there is some pressure on that front unless the FCNR and the ECB money really helps in driving that growth. If you were to look at the consumer discretionary, the auto, that sort of sector has sort of, the volume growth has been pretty good. The GST sort of cut that we saw the last year has continued to ramp the volumes for the sector. Second half, because you will have this base impact, so the volumes may slow down. And the margin so far has held for the two wheelers. For the passenger vehicles was a bit difficult. So these two would be certain things that really stood out if you just were to look at the quarterly results gone by.
Got that. Christy, hi, good morning. That deposit lag you were talking about, you don't think, if you just saw the news, ICICI Bank has an enabling resolution to raise up to $5 billion. HDFC has already done about $2.5 billion. A bevy of other banks have also been raising $500, $600 odd million each. You don't think that helps solve for this, in the near term, at least on the cost front as well? They're able to shed some of their bulk deposits thanks to this raise overseas.
Yeah, I think that would be the key endeavor by most of the banks. The only caveat is, compared to the earlier time, let's say 2013, the rates across the globe is on the higher side. So that sort of, has a bearing on, the amount we raise and also the cost at which it comes. But barring that, clearly, bulk of the proceeds possibly could be used to retire some of the wholesale deposits that, have come in for the banks in the recent past. And to that effect, the absolute NII growth could be better. The margins may take a hit. So that's where we think, this would help.
What about autos, Christy? The numbers were a mixed bag when it comes to passenger vehicles and the commercial vehicle players. The monsoons, the distribution of it is still a little worrisome. The fact that the fears of drought are still persisting. What are you betting on in a segment like this amidst plenty of headwinds that are lying ahead for this sector? You prefer the two-wheelers, the four-wheelers, the tractor manufacturers, or the commercial vehicle players?
Yeah, so this particular sector has reasonably done well for us, but we have over the past, let's say 6 months, we have been trimming our positions across this board because primarily, the volume uptick has already come through. And, possibly you may see some bit of moderation going ahead because you have, if you were to just see the price hikes that have been taken and, and compare it with the GST benefits, a lot of that is already sort of baked in terms of what you can pass through. So there will be that impact that will come through, but we are still positive on, some two-wheeler names, which sort of caters to probably the mass segment. There could be some uptick there because the past so many years growth is been weak and there is still some catch up. We have recently trimmed one auto anchs player more on the the battery play. There also we have seen a sizable increase in the valuations, and primarily to do with the fact that the auto OEM sales numbers have been pretty good. So that sort of helped, but you cannot extrapolate that trend much longer in future. And true to your point, CV and tractor, we would possibly see some moderation. There is no immediate signs of that happening, but given where the valuations are, there could be some moderation that can come, especially given the El Nino effects and the the monsoon thereof.
All right, Christy, thanks very much for that conversation. Out of time, but always appreciate your time here on CNBC TV 18. Slip into a short break, but when we return, we'll get you more on the markets, so stay tuned.
Headwinds. I'd note.
Welcome back. You're watching Trading Hour, and let's focus on the conversations we had at the CNBC TV 18 Banking Summit recently, and this one is on India's digital payment ecosystem. Now, I had the opportunity to quiz NPCI Sohini Rajola and PayU's Anirban Mukherjee to talk about, what kind of MDR on UPI could come in and the impact that they could have on the ecosystem. Take a look.
While I won't comment on exactly how this is going to shape up because there is time and there's a process for that, but I think the important thing is to first take a look at how far we've reached, right? Like in July alone, there were about
24 billion,
23.66.
Yeah.
So we will not round that off since it's in billions. Transactions and nearly 30 lakh crores, again 29 1.8 lakh crores. Roughly 1 lakh crore is what is being transferred using UPI on a daily basis, right? We are at that scale, one would think that you actually just reach saturation, but it's not true. We have a really long way to go. Like UPI, though it seems ubiquitous to us sitting in this room, we're only about 240 odd daily active customers, 240 million, about 500 million monthly active customers. That is still a very, I would say, much lower than the number of people who have bank accounts, number of people who have access to internet, and number of people who have mobile phones. All the three things that are needed for a digital payment.
But for all of those that seem to have a bit of a resistance to the idea of a fee coming on to UPI, just give the audience a sense of what the cost of running an ecosystem that is supporting those kind of transactions is, and whether, let us assume that transactions above 2,000 only are charged this fee. Is that enough, being just 2 to 4%, I think, of overall transaction volumes? Is that enough to keep the system alive?
There's a time period for everything. There was a time when you needed to get to... UPI is only about 10 years old. By the way, it's exactly 10 years old. So if you were in 2015, there was no UPI. And 2015 is not that long ago, right? So there's the scale that we have reached. The investments have not come from any single constituent or one part, right? There's fintechs, there's banks, there's technology providers, there's obviously NPCI. The regulators played a big part. So there's this whole ecosystem, and the people and the merchants have trusted.
Anirban, let me quickly come to you, since you look at this from a payments point of view as well. I mean, for someone like you, does this create an interesting paradox? You can simply choose to shift the customer away from UPI, or the merchant in this case, to maybe card, if there's a fee and there's some hesitation to it? Or do you think merchants would think of it as, the cost of doing business and move on?
Look, there is always an adoption curve. There's always a conversation to be had. But even if you take the largest of e-commerce merchants, and we serve them, take a guess at what is cash on delivery today.
The bulk of your transactions? The bulk of the payments go into cash on delivery, yes. I know, but I don't know what the number is.
Yes, it's about 30%. In many cases, it's north of 30%. After all of our efforts, that costs a lot of money. In some cases, it costs a merchant 400 basis points, right? Because with COD comes higher returns, higher frauds, lots of things. So when you just think of even a large merchant who will end up, paying for this, there is benefit, first order direct benefit for them. And then there is massive second order benefits for the whole system, right? I think India is 30%, 35% digitized, much more to go, especially when you think of B2B payments. If you think of all kinds of payments, as Sohini said, we are year 10 of a very long journey. It's a very long test series. We are in innings 2, maybe, right? So from that perspective, some amount of, revenues in the system that helps make up for the charges, that helps make up for the costs, for the significant more investments, I think it goes around in everybody's case. And if the whole country is digitized, we'll actually grow much faster as an economy.
We'll take a short break. Back with more on the other side. Stay tuned.
Enriched.
Welcome back. The markets continue to remain quiet as we head into the second half of today's trading session. But what are the macros indicating? Ritu, tell us more on that one.
Well, as always, let's start with the oil prices. They've edged a tad lower this morning, but they're pretty much on track for a second consecutive week of gain because of what's happening in the West Asia crisis, and that's complicated some concerns as far as supply constraints are concerned. Brent crude futures, they dipped about to $93.39 a barrel as we speak. WTI crude slipped as well, but Brent is headed for its second straight weekly advance, while WTI is also poised to post a weekly gain. And this rally has pushed oil prices down to their highest levels that we've seen since late July. The rupee opened a tad stronger this morning than yesterday, but it quickly paired those gains. It's now trading at about 95.74 against the dollar. What's happening with the oil prices, the consistent importer hedging demand, all of that has impacted sentiment, despite some kind of intervention, but it's a small amount coming in from RBI this morning. The 10-year benchmark GSEC yields, meanwhile, they've spiked in the last few days. They've hit about an 8-week high. They've been hovering around 6.85, 6.87, currently at 6.86 as we speak. So that's the macro setup for you. But completely run out of time here on this edition of Trading Hour. Harmize and I take your leave. Halftime report will be up next.
Stocks trade steady with the market breadth remaining positive even as firm oil prices cast a shadow. Utilities, industrials and financials eke out gains while FMCG and auto drag.
HDFC Bank ties up the biggest Indian overseas bond raise, mopping up $1.75 billion in 3- and 5-year tenures at a fine rate. ICICI Bank's board chimes in with approval for $5 billion in terms of overseas fundraise.
The government is pulling out all stops to rein in the price of sugar ahead of the festive season, with zero duty import of up to 1 million tons being permitted till October 31st. Stocks of sugar mills slip.
Individual traders remain at the losing end of F&O trades, with 88% losing money in FY26 as per a SEBI sample survey. Proprietary traders using algos are the ones raking in the money. Hello and welcome to Halftime Report live from the CNBC TV 18 Motilal Oswal studio. I'm Ekta Batra and with me Sonal Putra. Well, it is turning out to be a very quiet Friday for us at this point. We have the Nifty, which is just about higher by around 10 odd points, and we have the mid-cap index, which is absolutely flat as well. Not to mention that the Bank Nifty is managing to outperform a tad bit, up around 0.3%. On a week-to-date basis, the Nifty is down around 0.5%, with the mid-cap index, which is just about lower by around 0.2%. So for today, it's a bit of a wait-and-watch session, you'd have to say, for the markets going into the weekend, as well as, maybe looking out for cues such as where exactly Brent crude is headed, considering that it's at around $93 to $94 per barrel. Hi, Sonal.
Hi, Ekta. You know what I heard? It's Friday. I think that's what everyone's looking forward to as well.
That's why the markets are also so quiet, Maybe.
They're tired from all the moves this week. But nevertheless, Nifty still is seeing some green on the screen. Whether that sustains or not is the big question that we have. If we talk about sectoral performance, it's the metals index which is doing really well, 0.6% higher. Realty index is giving it some company as well. Of course, we've been talking about financials doing well, but there is a slip from the highs of the day. So we have to track whether we're able to sustain some gains that we're seeing on the Nifty as well. FMCG seeing some cuts, pharma to giving it some company, and auto index is also not doing so well. But a lot of stocks in the broader markets which continue to be on our radar. Before we do that, let's tell you what we do have on the show today. Spotlight on some big movers, namely Colgate, Welspun Corp, sugar stocks. Vivek will take us through the top buzzing stocks in trade today. A recent Julius Baer and EY India report projects Indian family office assets to grow 1.5 times over the next 3 years. We'll discuss the key drivers and the rationale behind this growth with Ashwin Patni of Julius Baer India and Surbhi Marwa of EY India. We'll also focus on the latest trends in the cryptocurrency space with Seth Gins of Franklin Crypto. And let's go ahead and go to Vivek. He's here to take us through all the stocks that are moving around in trade. Vivek.
Well, thank you so much for that. Quite soft, especially in terms of volumes when you're seeing the broader end of the markets. Individual names, individual sectors are the ones that are taking all of the limelight. Have a look at some of the power and capital goods stocks. So have a look at Power Grid, Hitachi Energy, also known as Power India, as well as GV, TND. All of these stocks up anywhere between 2 to 4% today. Important to see what is the kind of bidding that's happening as far as the select HVDC projects are concerned. Select capital market stocks too. We'll speak about that a little later on the show as well. Names like CDSL, NSDL, KF Intech, all of these names doing quite well in the session, all of them seeing buying activity. Welspun Corp, after the largest ever order bin that the company has received on very strong volumes, are almost near the upper circuit. Shanti Gears here, the parent, which is Tube Investments, has actually gone ahead and upped its stake. That stock, perched at the upper circuit today. And JBM Auto, some of the newspapers have reported that there could be a likely fundraise as far as its electric vehicle subsidy is concerned. That stock higher by 6%. On the other hand, quite a few laggards as well, mainly on the back of negative news. So have a look at Colgate, clearly underperforming, and the underperformance continues this after the churn as far as top leadership is concerned. The entire FMCG back under quite a bit of pressure today as well. Britannia, GCPL, Imami, all of these stocks are, Britannia in fact down over 3% today. SBI Cards, that was languishing in trade this after Bernstein went ahead and cut the target price very sharply for this particular name. Has recovered a little bit, but still this too has been an underperformer. And Balrampur Chini, after all of the news flow regarding the import of sugar, that particular stock on very high volumes down over 5% today.
Okay, a lot of stocks buzzing in today's trading session. Vivek, thanks very much for bringing us all of those details. We'll do one thing. We'll take a short break. But up next, we will be speaking with Ashwin Patni of Julius Baer and Surbhi Marva of EY India on their recent interesting report, which projects that the Indian family office assets are expected to grow 1.5 times over the next 3 years. We'll discuss the key drivers, investment trends, and the rationale behind this interesting statistic.
Symbiotech Pharma Lab Limited proposes an initial public offering of its equity shares. The 100% book build offer is being issued at a price band of rupees 938 to rupees 988 per equity share of face value of rupees 2 each. Offer opens on Monday, August 24th, 2026. Offer closes on Thursday, August 27th, 2026. For risk involved and other details, please refer to the red herring prospectus and addendum, which is available on the websites of the company, the SEBI, the BRLMs, and the stock exchanges.
Welcome back. You're still tuned into Halftime Report. Let's talk about an interesting report. A recent Julius Baer and EVA India report projects Indian family office assets to grow 1.5 times over the next 3 years. In fact, family offices are expanding exposure to sectors such as artificial intelligence, climate technology, renewable energy, and more. To discuss this and understand this report in depth, we have with us Ashwin Patni, who is the head Wealth Management Solutions at Julius Baer India. And we also have with us Subhi Marwa, tax partner and leader, family office advisory services, EVA India. Lady and gentlemen, thank you so much for joining us today. Subhi, let me start with you first. This 1.5 times growth that you're projecting from 70,000 crore rupees in 2024, what is the biggest assumption behind this growth? Is it the asset returns becoming better? Is it more investments? Or is it migration of more assets from one asset class to family offices?
It's all three of them, but the major part is that with the amount of capital available, you see the number of IPO exits, see the number of OFS, you see the number of promoter exits. There's a lot of wealth that's now available for the first generation as also the second generation for investments. That's the first thing. Second, a lot of family offices and a lot of the patriarchs have now got their second generation in. A second generation that is more worldly wise, that is aware of the new sectors, that is aware of the growth stories, that is aware of global hubs, etc. So the investment patterns are getting very institutionalized as well. So that's higher returns as well. The third part, which is reallocation, will also play a big role. But I'll say it's an amalgam of all three. The capital available is, I think, is one of the largest bets that's leading to this growth. And the number of, if you see our report, the ultra HNIs are set to grow from 19,000 to 25 odd thousand in the next couple of years. All of this money is now going to get reinvested or invested and get invested responsibly with greater risk-averse returns and a lot more knowledge and availability of information. So that's really...
Okay, well, absolutely. That point is taken, Surbhi, as well as Ashwin. Welcome to the show. Well, Ashwin, just wanted to understand that where exactly is this capital allocation now going? Is it going into more riskier bets from the generations, from the second generation?
So I think that's one of the big themes of this report, that it is becoming more structured and institutionalized. So it's not about, ad hoc decisions that let's invest in this product or that opportunity. But what we are seeing is that people are approaching in a very holistic manner in terms of what their investment policies should be, what their long-term objectives should be. So to answer your question, yes, people are very comfortable, especially with their long-term money, to take a meaningful risk or a calculated risk. Of course, the mainstream asset classes will always be popular. So listed equity, etc., continue to be very, very core and large part of the portfolios. But what we are seeing at the margin is a very strategic exposure that is being taken towards alternate assets. Whether it is in the form of private markets, whether in the form of real assets like REIT InvITs and other real asset opportunities. That's a clear shift in the last 2 years that we have seen systematically families taking.
Okay, all right. Ashwin, you spoke about, yes, listed equities, the traditional asset classes do remain in focus, but the report also suggests there are newer sectors which family offices are focusing on. We talk about renewables, maybe climate technologies, there's AI. What about returns here? Are they ahead of time and maybe the return cycle will take some time for them to generate returns? Or are they ahead of the curve and already seeing some of these gains coming by quickly for them?
It's a bit of both. The main thing to note is that they are approaching these themes in a strategic manner. Families, the good thing with the way the economy is growing and the way these opportunity sets are expanding is that there is the stage is wide enough for a lot of participants to come in and a lot of new things to get tried out, whether it is technology, whether it is some of these other themes that you mentioned that are there in the report. So what we are seeing is a very strategic way of approaching it. As we said earlier, listed market, of course, has its own set of sectors and themes that you can get exposure through a diversified listed market portfolio. Where these themes become very interesting is if families are looking for new areas to invest in, get exposure on, maybe strategically think about making a presence in. Those are all factors that go into deciding, allocations into these spaces. Yes, returns are probably, we are very early in the cycle for some of these themes. So yes, some of the returns are probably in the future. But the whole thing is, if you're approaching it strategically, then you have the ability to also influence how that journey goes. Rather than being a passive investor, you can also be an active participant in how the themes play out.
Okay. Well, Surbhi, just wanted to understand that how exactly are these family, wealth offices now considering opportunities into artificial intelligence? How are they using that, their funds, in order to capitalize on that opportunity?
So there are two aspects to this. There's one is artificial intelligence as a sectoral theme for investments, and that's growing. The numbers are available with you, and it's world over. The second theme is how are family offices really using AI and technology for operationalizing what they do. On the first side, Ashwin spoke about new sectors, thematic investments, AI being a very large sector where both the first and the second and the third generations are looking to put their money. It's a very, very big bet. The second part is that as they're growing and as the checks are growing, the investment decisions are no longer with one person or at the whims and fancies of someone's personal likes or dislikes. It's very rigor driven. It's very institutionalized, and people at every level are looking at, do I have AI and technology to look at what kind of deals I'm going into? Do I have AI and technology to see what kind of MIS I'm getting? What kind of returns my investments are generating later? Am I looking at cyber and other risks? The DPDP Act and rules have come in. So AI is no longer just a sector to invest in and a big bet. It's also that technology is very important and is being embraced to make sure that they are expanding at scale for governance, for investment decisions, for MIS, for reporting, to make sure that there is real-time information available. With the size of the checks and the kind of numbers that are being talked about, it's very important to make sure that it's also run as a business. So I think AI in both sides is going to become bigger and better, and you're going to see a lot of platforms and a lot of focus on MIS and reporting as things go along.
Take that point. Ashwin, if you had to point out one mistake that family offices are making right now that can be corrected, there is course for that, but it is not being done right now. Is there anything that you have identified?
I think what most families still haven't done well is to bring a more global thought process or approach to how they think about their portfolios. Today, we are in a very globally connected world. Whether we like it or not, what happens in other markets, other geographies, other portfolios. And that's where I think both from an opportunities and a risk perspective, families need to start approaching their portfolios in a very globalized manner. And this, I'm not saying this just as a way that they should allocate globally, but also in terms of how they approach. I mean, a very simple example is when we think about Indian market valuations, we typically tend to be very local in our approach, saying this sector is expensive, this sector is cheap. But are we benchmarking sectors to global valuations? Are we looking at themes and opportunities in India and benchmarking them to best-in-class comparable themes elsewhere, and saying whether they're worth investing or not? The risk comes to us from global sources. We've all seen that in the last 12, 18 months in a big way, and that will continue to happen. So the risk is there whether we like it or not. But how do we approach it? How do we structure it in our portfolio is probably the biggest gap, I feel. And the way the best-in-class families run it, they're able to capture this into their thought process.
Okay, Surbhi, just before we let you go, and if you could just be brief in terms of your answer, if hypothetically it was 100 rupees in terms of a family wealth office, how much of it is going into equities? How much of it is going into new age investments? How much of it is private equity, VC? And how much of it is possibly into real brick and mortar? If you could just quickly break that up for us.
So it's not one size fit all. It depends on the investment decisions. But I would say about 40-45% is now they're going into alternatives. So that's what I would say as a split. and with a little bit of focus still on the traditional equities, but it's not no one size fit all. It depends on their investment decisions.
Okay, all right. Ashwin as well as Surbhi, it's been a pleasure. Interesting conversation there. Thank you very much for joining in and speaking with us. We'll take a short break, but full tilt back on the markets then. Sachitana Notekar will join in to discuss what he's tracking in what is quite a quiet market today. Stay tuned.
Some properties are not just homes. They are statements, achievements, legacies. At India Sotheby's International Realty, we represent the country's most exceptional properties with unmatched expertise. Unique homes, uniquely for you.
रिन्यू बदल रहा है इंडिया की क्लीन एनर्जी की कहानी और इसके साथ है सूरज, हवा और पानी। रिन्यू क्लीन एनर्जी हमसे है।
Symbiotech Pharma Lab Limited proposes an initial public offering of its equity shares. The 100% book build offer is being issued at a price band of rupees 938 to rupees 988 per equity share of face value of rupees 2 each. Offer opens on Monday, August 24th, 2026. Offer closes on Thursday, August 27th, 2026. For risk involved and other details, please refer to the red herring prospectus and addendum, which is available on the websites of the company, the SEBI, the BRLMs, and the stock exchanges.
Wow. Century play. Club play. फिर भी कुछ हुई तो? हुई तो full cost वापस. सिर्फ प्लाईवुड का ना? पूरे फर्नीचर का. Idiot है क्या? कौन देगी? Century play. टोटल कवर।
10 साल तक प्लाई, लैमिनेट, लेबर, ग्लू, ट्रांसपोर्ट सबका फुल कॉस्ट वापस। इंडिया में पहली बार।
तू ना सिर्फ नाम का चतुर।
Welcome back. Well, let's get talking technicals. But before that, just wanted to point out one particular stock. Cipla is the top loser on the Nifty this afternoon. So that stock is down around 1.7%, pressured in today's trading session. It's lost 6.5% this year. There is some buzz that maybe there could be a US FTA inspection, but it's completely unverified at this point in time. But as of now, that stock is in focus. But we do have Sachidanand Untekar of Trade Bulls joining in with some trading calls. Sachidanand, welcome to the show. Well, it's a very quiet day for the markets at this point. We have the Bank Nifty, which is managing to hold up. What is the next level that you're watching out for in terms of the Nifty, and what would your calls be today?
Good afternoon, Ekta. Clearly, the Nifty is showing some signs of improvement, but it has to surpass that hurdle at 24,350, where its 50-week exponential moving average resistance is placed. So as of now, if you look at the oscillators, they are not indicating any signs of a breakout. But on the lower side, there is a good, decent support which has been built up at around 24,200 mark. So we are expecting that even today, the movement could be more range bound, and eventually going forward in the coming week, we may see some more positive traction, which will help the index, surpass that hurdle at 24,350, 400. When we look at the Nifty Bank, I think it is, showing better signs of trend. When we look at the absolute data, the index has started trending above its 5 and 20 day exponential moving averages. In fact, there is a positive crossover that we have seen in the averages, which is a good sign of momentum. Even the daily RSI has started moving above 50 levels. So we are expecting that this rally could extend towards 58,000 and eventually help the Nifty as well to surpass that 24,400 mark. So the bias remains positive when it comes to Nifty Bank. One can keep a stop loss at 57,480 on closing basis and carry forward their longs for a breakout of 58,000. When we look at these stocks, HDFC Bank is something that we discussed during this particular week. It had been trending lower, but if you look at the overall construct, there was a good sign of a positive divergence on its RSI. We have seen a good positive price action in today's session, and we expect this particular movement to continue on the upside. So we are still, expecting a move towards 745, and hence we are recommending building long positions. One can keep a stop loss at 728 on closing basis and review the positions at around 745. Disclosure would be that we have also recommended this trade setup to our clients. The other trade setup that we have recommended to our clients is BDL, wherein there is a clean consolidation contraction on the weekly scale. It's a triangle pattern formation. We've already seen a good pullback in the last couple of trading sessions, and the rebound has shaped up from its 20-day exponential moving average support. Hence, we're expecting further rally to be extended in the coming week, and hence we are recommending building fresh long positions here. One can keep a stop loss at 1322 on closing basis, build fresh long positions for an immediate target of around 1420, followed by a pattern target around 1490.
Okay, all right, Sachidanand, thank you so much for joining us. So those are some stock picks and levels on the index as well. So 24,350 is the next important level on the Nifty. We'll do one thing. We'll slip into a short break now. When we come back, we'll get Manisha Gupta, who will join in with MJ Khan of Indian Chambers of Food and Agriculture to decode the surge in food prices. Stay tuned.
ये बॉन्ड्स अब सबके लिए क्या है? अरे तुझे नहीं पता, इंडिया बॉन्ड्स पर अब सिर्फ 1,000 रुपए से बॉन्ड्स में इन्वेस्ट कर सकते हो.
Fixed returns do not constitute guaranteed or assured returns. Investments in debt securities are subject to credit risks, market risks and default risks including delay and/or default in payment. Read all the offer related documents carefully.
When the market moves, we don't just report, we decode. From the boardroom to the trading floor, we track what's driving business and impacting investor sentiment.
With insight that empowers and guidance that builds wealth.
Nuvama presents CNBC TV 18 Market Central,
for your daily source of market intelligence and wealth creation with a commitment to doing it right.
Welcome back. Joining us now is Mr. MJ Khan with his sense on the global agricultural commodities therein. Mr. Khan, hi, thank you so much for joining in. If you look at the year 2026, almost everything, whether it has been about pulses, edible oil, sugar, of course, has been a buzzing thing. Grains, for that matter, wheat and rice, everything seems to be posting a double-digit percentage gain in this year. Whether it has been about West Asia, fertilizer concerns, freight, containers, Red Sea issues, almost everything seems to have added to higher agri prices. From where we stand right now, what's your sense on what the next season really could bring in?
Thank you, Manisha ji. My understanding is that more than the realities that are prevailing, it is the sentiments related, market prices push. So if disturbances continue, it is less because of the disturbances, more because of the sentiments that get affected. More nations start acting more defensively. So as a result, the trade gets affected, the prices go up. So it is more to do with that. My understanding is that in the months to come, if things get better on the Hormuz front, surely it will have a stabilizing effect on the overall commodity prices. As such, there is no shortage in production. There is no global drop in any of the commodities. Major impact is not on account of any drought or flood or whatever. But it is more to do with the policies of the government, more to do with the market sentiments, and little to do with the disruption causing these two.
Point taken. The other thing that I want to talk about is about biofuels, really, because whether it is about ethanol in India or Brazil, for that matter, which is pushing the sugar prices on the higher side, all the overall biofuel mandates which the Asian countries like Malaysia, Indonesia seem to be pulling in, the report suggesting that nearly 27% of vegetable oil currently is used as biofuels. How are you looking at this, food versus fuel? I mean, it's not a narrative or it's not a debate right now, but it does seem to be fueling food prices in some sense, would you say?
See, Brazil has been into it for quite some years. India is now opening up. So actual impact in India will be known in the months or the years to come. Some of the Asian countries are also opening up, but it is not something that happened in the last few months. Substantial impact on the procurement or the consumption related to biofuel. It is more that the economies are opening up, new lines are, new directions are there. So possibly market sentiments are responding more to that than the actual diversion.
Mr. Khan, you talked about the government policies, especially when it comes to India as a country. What is it that's more desirable going forward? Because it is an El Nino year. We don't know whether it's a concern or a threat right now. But would you say this is perhaps the time to start working on it?
See, as of now, the decision is taken, so country is moving in that direction. So small protests or objections or reservations or concerns being expressed by consumers and some activists, that is one part of it. But importantly, that since there is no discussion in the government about review of this decision or reconsideration, therefore, we can be confident that the direction that the country has chosen to take, good or not so good, will be moving ahead on that only.
Mr. Khan, you actually track a lot of agriculture commodities. Would you say there are perhaps concerns when we are looking at more towards pulses, not so much perhaps towards edible oil? Do you see inflation concerns at all for the country?
See, edible oil has been a concern for a long time and it will continue to be a concern because there is no substantial developments that can significantly impact the availability or increase the availability in the country. So for the time being or in the foreseeable future, we'll continue to import that. So that is less driven by the market sentiment, more the actual reality that are prevailing. So possibly other than the oil seeds and partly the pulses, rest of the things will be more in context of our country, driven by the sentiments and the global changes in realities, less because of the internal policy. Of course, the ethanol thing has come up as an internal government policy change. We are on that direction, so I don't think as of now there is a very substantial diversion of that, and because of that it is impacted.
Well, ethanol is the other thing that I want to speak about. Not exactly ethanol, but sugar. From banning exports to importing sugar, we seem to have come a full circle, would you say?
Actually, we have been driving this understanding in the government and consensus for a long time that the export commitments that must be met, even if this same amount of quantities or the higher price has to be imported. So possibly the context that the Indian exporter entered into, so that are to be respected. While I don't think there is a crisis-like situation because stocks and production both are sufficient. So why the imports are being done now is not something for me to fully understand it.
A final question then, Mr. Khan, as we move forward from here, and till time all seems fine in sense of sowing and yield, etc. But if there is an El Nino that is developing in the month of September until Feb next year, would you say Rabi is something that we should watch out for, or perhaps next Kharif is something we can start planning now?
Surely, I think overall national leverage may be good, maybe near to the long-term average, but surely that El Nino effect is there. The disruptions are there. There are heavy rains, so that may improve the long-term average. But long dry spell that we are witnessing now, or skewed distribution that we are again witnessing now, so surely it is likely to impact the overall production. So the targets possibly for this season may not be met, but next season will be, Rabi season will be further to watch out what is going to be the impact of El Nino on that.
Point taken, Mr. Khan, and as always, thank you so much for joining in and making sense of what really is happening in the global and Indian agriculture commodity prices therein. Well, more sentiment-driven. Availability is not so much of an issue right now, but we really need to watch out for on sense of weather and, of course, government policies in various countries on where we drive from here. But with that, we'll go for a short break. Up next, we will be joined in cryptocurrency segment by Seth Jins of Franklin Crypto.
Leading the war against Iran without...
CNBC TV 18 presents Crypto Corner, powered by Binance.
Welcome back to Crypto Corner, and joining us now on the show is Seth Jins with his sense from Franklin Crypto on what the markets are looking like going forward there. And Seth, hi, thank you so much for joining in. Your first sense really on how are you looking at the overall markets right now, the kind of M&A transformation that we're looking at in sense of corporate finance, and will Franklin Crypto be pioneering more of these on-chain corporate transactions?
Well, thanks for having me, Manisha. What I can say on that front, obviously, I've recently joined Franklin Templeton as the Chief Investment Officer of Franklin Crypto, and I joined through an acquisition. So my business, 250 Digital, was acquired, and I think it's really important that as a signal that Franklin Templeton, one of the largest asset managers in the world, almost $2 trillion in assets under management, $2 trillion US dollars, is investing in crypto asset management businesses as it looks like we're at the bottom of the market or nearing the bottom of the market. We have an administration that's very positive. We have fundamentals that are looking increasingly positive as well. We can talk about a lot that's happened in the last day and a half or so, but I think it's such a strong signal that we at Franklin have been investing in this space, building out a business in the crypto investment management space after what's been 12 to 18 months of a drawdown.
Seth, also, how does Franklin Crypto now plan to capture the massive shift that we're looking at towards tokenized real-world commodities like gold on public blockchains?
So we've been looking at tokenizing assets for a number of the years. I think Franklin Templeton, we've been one of the earliest traditional finance players at the intersection of our traditional suite of products and tokenized markets. We have a tokenization technology stack that we've initially applied to our money market funds, and we're seeing a really good amount of adoption there. If you look at the trajectory of tokenized money market funds, we're up to about $15 billion in tokenized money market funds. Our suite of technologies and products are the leader in that set, and we're very excited to expand that from money markets to a broader set of products. This allows for investors to engage not just in the US, but in a broader sense. And it allows for much more nuanced and active engagement with these assets, bringing them eventually into on-chain markets like DeFi.
Said we've been watching out for that Clarity Act to be cleared for a very, very long time right now. How heavily do delays or these breakthroughs in the US crypto legislations dictate your fund's deployment roadmap?
I think there are a number of things that dictate the way we think about the regime that we're in, how bullish we are on the market. You know, Manisha, I'd say Bitcoin overnight went to over 70,000 US dollars. That puts it above the 200-day moving average for the first time since October of 25. So that's a pretty meaningful move. This was in the context of the big ETF inflows that I was talking about that happened overnight. This was in the context of very large short liquidations. In fact, the largest $3 billion worth of short liquidations we've ever seen in the crypto markets. And a big part of that was a press conference that President Trump held yesterday, where he outlined his focus on the Clarity Act. Now, you know, Clarity is going to be coming up for a cloture vote. So that's a vote to proceed on the debate around passage of Clarity. That vote is going to happen September 15th. So very good progress getting that cloture vote on the Senate calendar. But when we look at what President Trump also spoke about, he spoke about a desire to explore adding to a Bitcoin reserve. So he said he was open to that. He wanted recommendations. And then really interestingly, he said the CFTC, so the regulator that focuses on derivatives and commodities, is focused on bringing Hyperliquid onshore. And as you know, Hyperliquid has been one of the breakout crypto protocols of the last few years. It's a futures and spot trading protocol. It has a lot of liquidity. And the fact that the president is talking about finding a regulatory path to bring Hyperliquid onshore, very, very significant news. And that came on the same day that Coinbase noted that they were allowing users in the Base app to trade with Hyperliquid as well.
Oh, well, absolutely. 15th September is going to be a date to watch out for that Clarity Act closure vote, as you said. But said also emerging tech hubs like India face heavy tax environment, as high as 30% taxes on virtual digital assets, which are pushing volumes offshore, by the way. How can global funds like Franklin Crypto engage with markets that have massive retail adoption but restrictive tax laws?
Well, I'd say India is in a very special place with regard to crypto this year because the largest Ethereum developer conference is happening in Mumbai in November. So India has always had a very strong, I'd say among the strongest developer communities within crypto, and that's going to be recognized on the national stage with Ethereum DevCon in November. So I think the tax regime is one element. I think things like that work themselves out as you see commercial adoption. Commercial adoption is one of our mantras at Franklin Crypto for the next few years. And what we're seeing is very nice tailwinds on that front. And I think for India in particular, having all of the world's top developers, the ones that are most focused on decentralization and Ethereum and the ecosystems around Ethereum, coming to India is going to be such a remarkable event and tailwind for the Indian crypto community.
Seth, thank you so much for joining us with your insights. Manisha, thank you for taking us through this conversation. That's all about cryptos, but it's time to slip into a short break. When we come back, we'll talk about stock markets and stock-specific action as well. Stay tuned for that.
CNBC TV 18 presents Crypto Corner, powered by Binance.
Welcome back. You're still tuned in to Halftime Report. Well, Nifty continues to be consolidating at these levels. No big move that we've seen since the start of the show at the 24,230 mark. But in the broader markets, a lot of action. Welspun Corp, we've been talking about that stock. It is up around 16% as we speak. Car Trade, the up move continues there. Car Trade is the one which is up 9% in trade right now. Jindal Saw is the other ones. And Urban Company, of course, that is the another name that we are seeing big gains on. For now, there are a couple of stocks which are at the day's low. We do have Polycab, which has come off from the highs, is at the day's low. We do have Aurobindo Pharma as well, which is at the day's low as we speak. But HDFC Life, Tata Elxsi, these are two names which are at the day's high as we speak. So keep an eye out on some of these names. They are surging from the lows of the day, but markets continue to consolidate. So we'll keep tracking that story for you. For now, it's a wrap on this edition of Halftime Report. Stay tuned. Business Lunch will take all the action ahead.
when it appeared likely to pass.
Stocks are steady. The market breadth is positive even as oil prices continue to cast a shadow. Utilities, industrials and financials eke out gains while FMCG and auto stocks drag.
HDFC Bank ties up the biggest Indian overseas bond raise, mopping up $1.75 billion in 3- and 5-year tenures at a fine rate. ICICI Bank's board chimes in with approval for a $5 billion overseas fundraise.
The government is pulling out all stops to rein in the prices of sugar ahead of the festive season, with zero-duty import of up to 1 million tons being permitted until the 31st of October. The stocks of sugar mills slip.
Individual traders remain at the losing end of F&O trades, with 88% losing money in FY26. As per a SEBI sample study, proprietary traders using algos are the ones raking in the money.
Good afternoon, Yabitaz here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I am Hormus Patakia. With me, as always, Arundhati Ramanan. Arundhati, good afternoon and a happy Friday to you.
Hi, Hormuz. Good afternoon. A happy Friday to you, and the market's also feeling that. But a day of consolidation, Nifty and Sensex coming off those highs a little bit, absolutely fat. But the banks managing to outperform by a slight margin.
The banks and the broader markets are certainly doing well for themselves in today's session, even though they have come off slightly from the highs of the day. The index, though, most likely will end lower for the week unless there is some dramatic move in the last couple of hours or so. 24,369 is the level at which it needs to close higher for a weekly gain. Still about 140 odd points away from those levels. So some distance away for the index, but the Nifty Bank has turned positive for the week. That is something that the bulls will take some heart from. So back above 57,600 is where the Nifty Bank is, closing in on that 57,700 mark as well. And it was that same level yesterday as well, around about that 57,700, 57,70, where supply started to emerge and the Nifty Bank could not hold on to those levels. And today as well, seeing some resistance at those levels closer to that 57,800 mark. But the index has turned positive. 57,491 is the level at which it needs to close, above which it can result in a weekly gain. The broader markets are doing well. There is a lot of stock-specific activity that is taking place. The advanced decline is also fairly in the positive territory as well. So overall, it may have been a ho-hum week for the markets, but the banks is something that the bulls will take some heart from.
Absolutely. And if you take a look at the sectoral performance, we've got the metal pack that's in the green. That's leading the up move, right? Hind Zinc, Hind Copper, both of them up over 2.3%. We've got that Nifty Metal Index 0.7% higher. And then we've got Nalco that's also seeing gains of over 2% in trade. Real estate names, those are also doing well in trade. We've got Prestige, we've got Brigade, both of them up over 1% in trade. As we speak, Prestige is actually 2% higher in trade. And we've got DLF that's managing to stay near the 1% mark. On the downside, FMCG names are leading that decline. The index is down nearly 1%. We've got Britannia, that's down over 3% in trade. Varun Beverages, that's down 1.3%, while ITC is down about 0.7%. Healthcare stocks also seeing cuts. Cipla, Torrent Pharma, Loris Labs, all of them down over 1.5% in trade, Hormuz.
Indeed, and that's how the markets are set up right now. But the headline grabbers today are two of India's largest private lenders. HDFC Bank is doing well today, following a $1.75 billion fundraise via dollar bond issuance, marking his largest overseas fundraise since the global financial crisis. Group Treasury head at HDFC Bank, Arup Rakshit, believes that it is premature to comment on whether this will be their final fundraise. Listen to what he had to say.
We go up across and raise money when we see a customer interest in whatever form and shape. So we have always been doing these kind of transactions based on customers' demands and interest. So yes, we have raised about $2.5 billion already through the public bonds in this window so far. And it's too preemptive to say whether this is the last or there will be further issuances. As I said, it will be client-dependent, customer interest-dependent. Never say never. The demand from the investors was very, very strong this time. At its peak, the order book was $7 billion, which was quite a significant one, and just shows the strength of both the Indian banking sector and obviously the investors' belief in the HDFC Bank itself. Yes, the pricing, you are right. It was for 3 years, we got a T plus 88 basis, and for a 5 year, it was T plus 100 basis. In July, we had raised the Reges bond at T plus 90, but since then the spreads had widened with so much issuance out of India. But I mean, from a comparative perspective, if you see the other players where they have been raising, T plus 100 was well within what some of the people have raised in the last 7 to 10 days.
ICICI Bank's board has also approved a $5 billion in overseas borrowing via issue of bonds or offshore certificates of deposits. Now, the bank has also recently raised $750 million in overseas funding at a cost of capital of 108 basis points in excess of the Treasury yield.
Now, the government, in a move to cap rising prices of sugar ahead of the festive season, has allowed duty-free imports of up to 1 million tons of sugar. Ria is here with more details on this. Ria.
Well, sugar stocks have been in focus today as the government has allowed 1 million tons of raw sugar to be imported at zero duty until the 31st of October this year. And this is because the government is trying to bring down the recent record high sugar prices that we've seen in the domestic market of late. And as per this notification, sugar mills and refiners with functional capacity to convert raw sugar into white sugar should apply between the 21st to 28th of August this year for the tariff rate quota that will allow imports at zero duty, and preference will be given to importers that will undertake to complete these imports by the 15th of October. And after this announcement came through, the benchmark white sugar futures in London and the raw sugar futures in New York jumped by as much as 4% after this announcement had come through. And some reports have also suggested that India is likely to import a large part of this sugar from Brazil, which can take nearly 2 months, and domestic supplies will then be boosted from October onwards rather than an immediate impact that most people were expecting earlier. And in terms of the impact, this can cap the domestic sugar rally to an extent, and sugar mills will also see a slight hit to their margins in the near term. Today we are seeing some profit booking taking place across the entire sugar pack, and stocks like Balrampur Chini, Triveni Engineering, DCM Shriram, Dalmia Bharat Sugar, even EID Parry, all of these stocks trading with cuts today, down as much as 4 to 4.5% today.
All right, Ria, many thanks for taking us through those details. But on that note, it is time for us to head into a short break. But more news and updates on the other side. Stay tuned.
Retain.
Symbiotech Pharma Lab Limited proposes an initial public offering of its equity shares. The 100% book build offer is being issued at a price band of rupees 938 to rupees 988 per equity share of face value of rupees 2 each. Offer opens on Monday, August 24th, 2026. Offer closes on Thursday, August 27th, 2026. For risk involved and other details, please refer to the red herring prospectus and addendum, which is available on the websites of the company, the SEBI, the BRLMs, and the stock exchanges.
Sorry, I'm late.
No worries.
So our daughter, she's starting university in a few years. How do I safeguard against these dollar fluctuations?
So factoring in LRS, the root, and the currency hedge, here's your best move.
Ionic Wealth is your co-founder in your journey of wealth creation.
What's the rush? Let them get a second opinion first.
Yeah, this works.
Great. Please, continue.
Ionic Wealth is putting the power of institutional grade AI in your pocket, so you can get your second opinion first. Ionic Wealth AI.
Wow. Century ply. Club pry. फिर भी कुछ हुई तो हुई तो full cost वापस सिर्फ प्लाईवुड का ना पूरे फर्नीचर का इडियट है क्या कौन देगी सेंचुरी प्लाई टोटल कवर
10 साल तक प्लाई, लैमिनेट, लेबर, ग्लू, ट्रांसपोर्ट सबका फुल कॉस्ट वापस इंडिया में पहली बार।
तू ना सिर्फ नाम का चतुर है।
Welcome back. You're still with us on Business Lunch. SEBI's latest study tells a story. The retail rush into India's equity derivatives market may be slowing. As per this year's data, individual traders have lost 91,600 crore rupees in FY26 versus 1.12 lakh crore rupees in FY25. This even as participation dropped 40%. Let's go across to Hormaz, who's at the wall to help put all of this data into perspective. Hormaz?
You know, SEBI study has two messages. One, change is the only constant, and the other one, there are certain things that do not change. The first thing that has changed is the number of active individual traders that has declined in FY26 from 98 lakhs to 78.6 lakh in FY26. This is, of course, the retail participation in the futures and options segment. Even the new entrants in the F&O space has declined by 40% on a year-on-year basis. Now, if you take a look at the aggregate net loss that individual traders made, that has seen a decline from 1.12 lakh crore in FY25 to just under 92,000 crores in FY26. That, of course, needs to be taken into account for the fact that the participation too has come down from last year. This one thing that has not changed, the number of traders who lose money. 9 out of 10 last year, 9 out of 10 this year as well, although the number from 90.9 has gone down to 87.7. But the individual traders making a net loss has also increased from last year, from 1.32 lakh to 1.47 lakh is the average sum that an individual trader has lost in the F&O segment in FY26. So who's making money? Everybody but the individual trader. Proprietary, FPIs, corporates, mutual funds, all of them have made anywhere between 3,000 to as high as 45,000 crore rupees in FY26. But take a look at the individual number. That 72,243 crore is a net loss number, not a net profit, even before you include the transaction costs in this. Now take a look at the expiry concentration as well. Majority of the index options turnover comes on the expiry day, on the same day expiry, that's 59%, a day before the expiry 75, and a week before the expiry is where majority of the 97% of the index options turnover comes from. Who is the bigger loss maker between an options trader and a futures trader? The answer is a futures trader. This is the amount of money, of course, that's 2 lakh rupees compared to 1.5 lakh for an options trader. Now take a look at the interesting trends that have emerged here. Two of them stand out. The age below 30 participants have increased to 43% from 31% in FY22. The standout one is the women traders, 17.1% of the total sum. The loss ratio here is 84.7%, and that is lesser compared to the men. That's the standout here. Now take a look at the traders versus the speculators one. The 35% of the total equity derivatives participants have zero equity holdings, and 78% of those have equity portfolios less than 1 lakh rupees. Now these small portfolio traders are contributing to 51% of the turnover, and 70% of the losses are also borne by these traders. So they are the ones that are doing the majority of the heavy lifting. Take a look at the transaction costs. In FY26, that stood at 25,000 crore, taking the 4-year sum to 1 lakh crore rupees, and that share of securities transaction tax, which stood at 13% in FY22, has gone up to 27% at the end of last year. Option buyers accounted for a majority of the traders. Yes, they also accounted for a majority of the losses as well. Only 2% of the option sellers, but take a look at the risk of being an option seller. The average loss made by an option seller is 51.5 lakh rupees. Compare that to a major options buyer and a pure options buyer, and that figure ranges anywhere from 1.5 lakh to 4.5 lakh rupees. Experience teaches you a lot of things but may not necessarily lead you to profits. Traders participating in their first year, 91% of them are loss makers. Participants who have participated for 4 years at a stretch, 95% of those are loss making, and who have participated for 5 years at a stretch, even 2/3 of those are still losing money. And 90 to 92% of those traders who lost money in 2 consecutive years participated in the 3rd year, and they lost money there, it's there as well. So that's the standout part of this SEBI study. Although participation has come down, but the losses remain constant. 9 out of 10 retail traders still lose money in the F&O space.
All right, Hormaz, thank you so much for putting that into perspective for us. Moving on, FTSE has released an update on the BSE indicating that it meets criteria to be eligible for FTSE Russell indices. What does this mean for the index and the stocks listed on it? Vivek has all of those details. Vivek?
Well, that's right. A very interesting development or an update coming in as far as BSE is concerned. The Bombay Stock Exchange itself, and we're talking about the exchange as a whole, from FTSE very early today morning. What FTSE is saying is that BSE India now has gone ahead and met all of the requirements for classification as an eligible exchange within the FTSE Russell equity indices. So what this essentially means is that stocks that are listed on the main board of the BSE can now be evaluated for index inclusion. BSE listed stocks will be assessed for index eligibility, and in case they are eligible, given the fact that they may not be listed on any other exchange like the NSE, they can still make the cut and be included into the FTSE Russell indices. Now, along with that, there is also another update as far as IPOs are concerned. They're saying that the fast entry assessment for IPO stocks that will list only on the main board of the BSE will be eligible for fast-track screening effective immediately. We spoke to a couple of analysts about what exactly this means, and this essentially means that this could pave the way for a fast-track entry of NSE into the FTSE indices once it does list onto the BSE, assuming that it currently lists only on the BSE. Now, along with that, only BSE listed stocks become eligible for entry into the FTSE indices. There are a whole host of stocks, on account of various ownership structures that are listed only on the BSE. One example that analysts have given is that NSDL could, which so far is not part of the FTSE index, could actually make its entry into the FTSE index in the upcoming review. So positive development for stocks that are listed only on the BSE and also for a few upcoming IPOs.
Vivek, thank you for that update there. Take a short break. Back with more news and updates on the other side. Stay tuned.
Tom.
Some properties are not just homes. They are statements, achievements, legacies. At India Sotheby's International Realty, we represent the country's most exceptional properties with unmatched expertise. Unique homes, uniquely for you.
रिन्यू बदल रहा है इंडिया की क्लीन एनर्जी की कहानी और इसके साथ है सूरज, हवा और पानी। रिन्यू क्लीन एनर्जी हमसे है।
Symbiotech Pharma Lab Limited proposes an initial public offering of its equity shares. The 100% book build offer is being issued at a price band of rupees 938 to rupees 988 per equity share of face value of rupees 2 each. Offer opens on Monday, August 24th, 2026. Offer closes on Thursday, August 27th, 2026. For risk involved and other details, please refer to the red herring prospectus and addendum, which is available on the websites of the company, the SEBI, the BRLMs, and the stock exchanges.
वाह, सेंचुरी प्लाई, क्लब प्राइम। फिर भी कुछ हुई तो? हुई तो फुल कॉस्ट वापस। सिर्फ प्लाईवुड का ना? पूरे फर्नीचर का। इडियट है क्या? कौन देगी? सेंचुरी प्लाई, टोटल कवर।
10 साल तक प्लाई, लैमिनेट, लेबर, ग्लू, ट्रांसपोर्ट सबका फुल कॉस्ट वापस। इंडिया में पहली बार।
तू ना सिर्फ नाम का चतुर।
Well done on that ESOP sale. Thank you. Now that you have this extra money to invest, let's build a staggered deployment approach and balance things out between aggressive and safe bets.
Ionic Wealth is your co-founder in your journey of wealth creation.
Hold up. Let him get a second opinion first.
Sounds good.
You can continue.
Ionic Wealth is putting the power of institutional grade AI in your pocket, so you can get your second opinion first. Ionic Wealth AI.
Sorry, I'm late.
No worries.
So our daughter, she's starting university in a few years. How do I safeguard against these dollar fluctuations?
So factoring in LRS, the root, and the currency hedge, here's your best move.
Ionic Wealth is your co-founder in your journey of wealth creation.
What's the rush? Let them get a second opinion first.
Yeah, this works.
Great. Please continue.
Ionic Wealth is putting the power of institutional grade AI in your pocket, so you can get your second opinion first. Ionic Wealth AI.
Welcome back. Now, India has eased rupee trade rules, allowing for export contracts and invoices in any currency. Abhimanyu has more on this. Abhimanyu.
India has eased rupee trade rules which will allow export contracts and invoices in different currencies. Now, the move is expected to support wider internationalization of the rupee and is possibly going to aid trade with different countries, particularly the ones which are facing a shortage of dollars. Now, the GTRI has welcomed the move. It has indicated that this is going to ease trade overall and is going to possibly support wider use of the rupee as far as currency settlement is concerned. However, the think tank pointed out that rupee settlement may reduce conversion costs and exchange risks for exporters, while it called for wider adoption through affordable hedging, rupee export credit and ECGC protection, which is key for wider adoption. Now, it remains to be seen how this move is going to be seen moving ahead and what kind of ease it's going to possibly bring in for exporters. More importantly, it remains to be seen what further suggestions would be given by stakeholders, including exporters, as far as further easing of the current rules is concerned.
All right, Abhimanyu, many thanks for those details. On to the latest updates from West Asia. U.S. Treasury Secretary Scott Bessent told CNBC that Washington will impose the toughest sanctions in history to collapse the Iranian government, calling on other nations, including China, to join the effort. CNBC's Dan Murphy with all of those latest updates. Dan?
The Trump administration now spelling out how it plans to try and break Iran's economy, and Treasury Secretary Scott Bessent there telling CNBC the goal is to avoid a large-scale return to military operations. Bessent told CNBC that if maximum economic pressure works, a major kinetic restart may not be necessary. So the plan is a combination of the U.S. naval blockade in Hormuz and what Bessent says will be the toughest sanctions ever imposed, with foreign countries, banks and companies warned that they will have to choose between doing business with Iran or access to the US system. Bessent says Treasury is going to lay out the details on Monday. Take a listen.
We have a combination. It is a 1-2 punch. We have the blockade, and we are going to have the toughest sanctions in history. And I will tell you, this will work. It worked in Venezuela once we put up the blockade. It is working in Cuba right now, and it is going to work in Iran, and we are going to collapse this regime.
So this is the clearest statement yet of the administration's objective here, not just to pressure Tehran back to the table, but in Bessent's own words there, to collapse this regime. Of course, important to point out, though, that Iran has spent many years building its own way around these Western sanctions, from Chinese oil buyers to shadow shipping networks to alternative payment channels. So the question now is whether Washington can actually close some of those escape routes to China and elsewhere, and also whether its allies are willing to help it, step in to help out to enforce this. And then finally, inside Iran, what does the new economic pivot mean for the duration of this war, which is going to cross the 6-month mark on Friday next week? How much economic pain can the people of Tehran really tolerate before the regime itself faces serious social and fiscal stress that could force the reopening of Hormuz or a restart of nuclear talks? And of course, all of that is very unclear still at this point.
Dan Murphy there with the latest. That we take a leave on this edition of Business Lunch from Arundhati and me. Thank you for watching. Midcap Radar on the other side.
did.
Good afternoon. Welcome to Midcap Radar. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, Vivek Iyer. And it is turning out to be a very quiet session today. Nifty is not in the Friday mode, just taking some rest after what's been a hectic week for the Nifty. Quite volatile. But right now, it's a green-looking screen. So far, Nifty did slip into the red, but has recovered. But we can't really call it a recovery. It's just been consolidating at those levels, Vivek.
Absolutely right. Absolutely flat market. Just 14 points higher for the Nifty. Broader market doing slightly better. Breadth is positive, but still volumes are quite thin across the market. A lot lined up on the show, an important corporate conversation as well. So let's start off with the top headlines. Stocks trade flat with market breadth remaining positive despite firm oil prices. Nifty holds around the 24,250 mark, led by metals and private banks, while FMCG and pharma lag. Broader markets trade in line.
Wellspun Corp wins a record $1.8 billion pipe order from the United States. The management also tells CNBC TV 18 that more strong order inflows are expected later this year. The stock rallies 11%.
Shanti Gears fires up after parent company Tube Investments acquires an additional 2.7% stake in the company via block deals worth 77 crores, the gear and gearbox maker.
Colgate-Palmolive India underperforms on leadership churn. MD and CEO Prabha Narasimhan to move to a global role, with former Colgate executive Manish Anandani set to take over as MD and CEO for 5 years.
The government is pulling out all stops to rein in the price of sugar ahead of the festive season, with zero duty import of up to 1 million tons being permitted till October 31st. Stocks of sugar mills slip.
Okay, all right. Those are the top headlines that we are tracking for you. As we've been pointing out, markets are absolutely flat, but the breadth continues to be in favor of the advances. Mid-cap index is also, again, quite flat. So we'll do one thing. We'll talk about individual names and go across to Sudarshan. He's joining us with our special segment, Mid-Cap Movers. Sudarshan?
So market breadth is in favor of advance, and that's the reason we are talking about the major mid-cap gainers. On top of the list is Bharat Dynamics. Yesterday, the stock had seen a huge fall. Now today, it's seeing short covering, and that's the reason currently up more than 3%. CDSL, because of over the last few weeks, we have seen several IPOs coming in the market, and so many new companies are getting listed. That's the reason CDSL has been focused up almost 3%, and gold and silver prices have moved high over the last few days. And that's the Hindustan Zinc, IIFL Finance, both these stocks are trading with gains of almost 3 to 7%. Lastly, Kins Technologies has been gaining over the last few days. Today also, it's up more than 2%. Some of the other top gainers with healthy volumes are Allcargo Logistics, up more than 14% with huge volumes, and similar moves seen in Cartrade Technologies. JBM Auto, remember, there is a positive report regarding this company that they might get an investment from a PE firm. That's the reason up more than 6%. Bharat Coking Coal too has been moving higher over the last few days, and today also up more than 5%. And Med Plus 2 amongst top mid-cap gainers with healthy volume. Some of the mid-cap losers, till yesterday, all these sugar companies had seen a big move, but today it's profit booking, and on the back of government report, Balrampur Chini currently down 6%, and some of the other top losers, Happy Forgings, Cohance Life and Indo MIM, all these three names had seen a huge move over the last few weeks, but today all these names are seeing profit booking.
Well, thank you so much, Sudarshan, for joining us, giving us a sense of all of the top movers and shakers as far as the broader end of the markets are concerned. But moving on, it's a good time to get a quick technical check on the market. Vinay Rajani of HDFC Securities joins us for a quick technical check. Good afternoon, Vinay, and thank you so much for joining us. Well, what are you making of the markets at current levels? Nifty, flat as flat can be.
Yeah. So after 700 points of correction, Nifty has bounced back by 100 points. Still, Nifty is placed below its 20 and 200 days. So 20 days exponential average is placed at 24,300 and 24,380 happens to be the 2 days EMA. So these are the strong resistances for the Nifty. So we are suggesting our clients that if somebody is a Nifty trader, then one should wait for this 24,400 to be taken out on the upside to get a bullish confirmation, and on the downside 24,000 is a very strong support. So currently Nifty is oscillating between this range of 24,000 to 24,400. Wait for that that taken out of the other side, then we will get a signal of momentum. But the way markets are performing, the way the small cap index is behaving, today small cap 100 has hit a new all-time high. My 50 index is also about to hit the all-time high. So that way markets are very stock specific. Nifty is consolidating. So right now there is no momentum or alpha can be generated significantly in the index. But yes, there are many opportunities in the sectors and stocks which are giving good returns for the short term. So definitely one can, as a trader, one can concentrate there rather than look at the index trades.
Okay, all right. Take that point. What about individual names in that case, Vinay?
Yeah. So from the real estate space, Prestige Estate has resumed the uptrend, which is trading at 1620. It is looking quite good, and real estate as a sector has been performing well for last couple of months. So I think 1620 Prestige Estate is looking 150 should be the trading stop loss. On the upside, I'm expecting an immediate target. The second stock is from the mid-cap private sector bank, that is IDFC First Bank. This is looking quite good after some consolidation. It has resumed the up. So around 86.40 one can go long. 85 should be the trading stop loss. On the upsetting an immediate target of 88.50.
Well, thank you so much, Vinay, for a view as far as markets as well as individual trading calls are concerned. Well, we'll now slip into a short break. On the other side, we'll be joined by the management of Nitin Spinners. Stay tuned.
Welcome back. You're still tuned in to Mid-Cap Radar. A lot of action in the broader markets. Augment Enterprises is a new addition to the IPO space. Let's go across to our colleague Ria, who's here to tell us more about this one. Ria, what does the company do?
Well, the IPO of Augment Enterprises has opened for subscription today, and the listing will be on the 31st of August with a price band of 750 to 788 rupees per share. The total issue size is 825 crores, with the fresh issue being 620 crores and the OFS portion being nearly 205 crores. The company will have an implied market cap of 7,200 rupees and a price to earnings ratio of nearly 21 times at this price. Now, let's also first take a look at what the company does exactly. They are an integrated gold and silver platform which serves businesses and consumers across India and international markets as well. And the company operates across multiple segments of the gold and silver value chain. And in terms of the platforms, the company has two key business platforms through which they operate. The first one is Augment Spot, which provides electronic bullion trading and physical delivery of services to jewelers and bullion traders as well. And the second platform that they operate through is Augment Gold. Gold for All, which enables consumers to buy and sell gold and silver digitally and also invest through systematic plans. Now, in terms of the financials of the company, the revenue growth has been quite strong, growing by over 40% in FY26. However, EBITDA margins remain quite thin for the company, just about 0.4% of EBITDA margins that they have seen in the last 3 years. And out of this issue, the company is going to use nearly 465 crores for working capital. The rest will be used for their general corporate purposes. And today in an interview, the company did tell us that the FY26 tonnage for gold went down due to the rising gold prices. We saw a volume decline of nearly 21% compared to the previous year in FY26. And they have said that they will be needing additional capital to maintain this tonnage to help their suppliers.
Well, thank you so much, Ria, for joining us, giving us all of the details about the upcoming Augment IPO. But remember, earlier today, we also spoke to the management and asked about their working capital cycle as well as profitability. Let's listen in.
Our working capital cycle is 1.76 days. And when the jeweler is actually buying on the spot platform, he is supposed to make the payments within 2 days, after which he can take the delivery. Meanwhile, on the supply side, we have to make the entire payment and procure the gold, make sure that it is in transit. And for that, this 2 days, approximately 2 days of working capital is required.
Yes.
Now you see, because of the increasing gold prices, my tonnage has gone down for FY26. We did 61 tons in FY25, which has gone down to 53 tons in FY26. We need more capital to start addressing all the jewelers that are there on the spot platform and maintain the tonnage. The profitability for B2C business is better than the B2B business.
All right, that's all about Augment Enterprises. We'll slip into a short break now. On the other side, we'll be joined by the management of Nitin Spinners. Stay tuned.
Meanwhile,
Welcome back to Mid Cap Radar. Well, as promised, important corporate conversation. Nitin Spinners is the management joining us on the show now. The company recently bought stake in a hybrid energy, renewable energy company. We will focus on three key focal points to discuss with the management. First, of course, will be the outlook on yarn spreads, the company's cost savings as well as capacity ramp-up plans, and growth opportunities in FY27 and beyond. Joining us now is Mr. Dinesh Nolka, Chairman and Managing Director of Nitin Spinners. Good afternoon, Mr. Nolka, and thank you so much for joining us. Well, like we just said in the lead-in, what exactly, how exactly are the current yarn spreads at? Q1, you saw a significant improvement from 110 rupees a kg to 130. How sustainable are this, and what is the outlook for FY27?
Thank you for having me on the show. Margins at this point of time are more or less similar to what was there in the last quarter and looks quite sustainable at this point of time. The major reason why this improvement is there since the raw cotton prices in India are more or less comparable with the international prices. This was a disadvantage in last 1.5 to 2 years to us. So that is changed for the good for the industry as a whole. And so the margins looks quite sustainable at this point.
Okay, so margins look sustainable from here on. Mr. Nolka, if you can give us a brief of what's happening in the industry. Recently, textile stocks have been buzzing. The US tariff headwind is out of the way. Of course, that did not impact you so much. But how are prices trending generally, and how is demand internationally and in the domestic markets as well?
Demand at this point of time, especially for the yarn segment, looks okay. If you see in last 1.5 to 2 years, there is no major capacity addition in this business. Also, in fact, some of the smaller capacities have gone out of business because of the tough times we had because of higher cotton prices in India and other factors. So at this point of time, there is a very demand and supply of yarns looks finely balanced. As far as downstream is concerned, we have a large opportunity coming our way in way of the EU FTA, which we have already done with UK, and the EU FTA, which is going to happen. So this will open up much larger market size, and it looks that the demand for the yarn as well as is going to improve from here on. Considering that, I think the textile industries overall, that is the reason why the textile industries are doing well, especially from last 1 or 2 quarters.
Okay, Mr. Nolka, when we look at Q1, actually there was a bit of a volume decline, especially as far as yarn was concerned. So majority of the growth came in from revenue realization gains. So number one, with new capacities coming in, what will be the volume growth that we can expect as far as FY27 is concerned? And also, if you could guide us to the revenue, EBITDA margin, as well as PAT for FY27.
Actually, if you see in the first quarter, there is no degrowth as far as volume is concerned. Only the more quantity has gone towards our fabric productions. So the fabric, our production, we are producing around 27,000 tons of yarn every quarter, and that is what we had produced in that quarter as well. But fabric production is consumed more, so we had to lesser quantity to sell. Yes, there has been also improvement in the realizations, which is still continuing, and according to that, we feel that we should be able to clock, I think, around 3,800 crores around the revenue this year. We also are expecting around 300 to 400 crores of revenue from our new capex, which is going to be starting in the next 3-4 months. So all put together, we should be looking at around 3,000.
Okay, all right. What is the capex amount that you'll be starting with, and how are you funding it?
The total capex which we are spending, including our renewable energy and our textile space, is about 1,350 crores. Most of this, out of this, is being done through internal accruals and the debt.
Okay, Mr. Nolka, if I could nudge you again to give us, quantify the guidance as far as FY27 is concerned. And also, while there was a sharp improvement as far as EBITDA margins are concerned in Q1, going forward, given that there will be new capacity coming in, will there be slight margin dilution Q2 onwards?
We expect to maintain at least in Q2. And going forward, since we are during the ramp up of the production, generally the costs are slightly higher. Looking into that, maybe we can have a slight decline, but at this point of time, margin looks quite sustainable. Also, we have to look at the part that our renewable energy production is going to also start in the next quarter. That should be a margin accretive thing. Our cost of production, cost of energy will come down. So again, that will help us in improving the margin. So plus also the fabric production, which is again value accretive in comparison to yarn business. So our share of fabric will increase also going forward. So looking into all this, we expect that the company should be able to maintain the margins which we have already done in the first quarter, maybe plus minus slightly.
No, I was going to ask you actually, Mr. Nolka, of course, there will be a margin expansion and the guidance that you've given as well. This renewable energy cost savings that you're talking about, how much would be on an annual basis?
Put everything together, we have 3 phases here in this energy, where we have something on our rooftops. We have also having direct capex on the books of our company, and then we have also taken the stakes in the renewable power in one of the plants, hybrid renewable energy. So all put together, we should be having advantage of around 65 to 70 crores at the EBITDA levels.
Okay. Mr. Nolka, when we look at the exports, it contributed close to 65% of the revenue, went up almost 16% on a year-on-year basis. Give us the ideal mix for you going forward, especially as far as the US market is concerned, the EU market is concerned. We understand that, margins there are typically higher. So going forward, ideal mix for you, and what kind of growth can you end FY27 with?
So actually, we normally look at 60% of exports and 40% of the domestic market. So that is the ideal mix we normally target. Last quarter, there was a very good demand in the market after this tariff reduction in US. So that contributed towards more exports as such. Going forward, as I told, the top line, we are expecting to maintain around 3,800 crores plus. That is what we are targeting at this point.
Okay. Mr. Nolka, the other question is the current capacity utilization, where is it currently running at? We understand that, very soon you will have new capacity on board, but what is the current capacity utilization? And, after the new capacity comes on stream, where do you expect it to drop down to or moderate to?
Yeah, basically our spinning capacity is operating at about 97.5 to 98%. And our fabric capacities are operating at about 92%. So from here on, when we add our spinning, it takes about 4-5 months to ramp it up. So that will take if we start somewhere around December, January, we should be able to ramp it up by the end of this financial year. Then again, we should be in the same range of utilization. Fabric capacity takes a bit more time, and it may take about 8 to 10 months to ramp up the whole capacity. So during that period, definitely the additional capacity will be running at maybe around 55 to 60%.
Okay, all right, Mr. Nolka, thank you so much for joining us. Always a pleasure speaking with you. So that's the word coming in from Nitin. Spinners, capex in place, demand, the supply gap is also balanced. So that's a bullish commentary coming in. The stock, though, absolutely flat with some negative bias. As we wrap on this edition of Midcap Radar, the Nifty is again absolutely flat. Now, not much move there. That's the case across the market today, except for Bank Nifty, which is up around 0.3%. A lot of stocks which are in focus. If we quickly take a look at Bharat Forge, which has moved to the day's high. We do have IIFL Finance Limited, which is doing well in trade right now. JBM Autos, the other one, which is surging in trade. We do have Tech Mahindra, which is at the day's low as we speak. So some of these stocks which are making lower lows and higher highs. So we'll keep tracking the stock specific action for you. For now, it's a wrap on this edition of Midcap Radar. Your stocks when we return.
Cleared an initial
to your stocks. I'm Arundhati Ramanan. The markets today in consolidation mode. We've got the Nifty and Sensex. They're absolutely flat. And if you take a look at that Nifty, managing to hover around that 24,233 mark and thereabouts, absolutely flat. We've got the Nifty Bank that's sort of helping the Nifty stay in the green. It's outperforming the blue chips. That index is up about 0.3%. The mid-cap index gaining in line with the blue chips, absolutely flat in trade as we speak. The indices that are doing well in trade today, we've got the metal pack and we've got that realty pack. Both of those indices batting for the bulls, but on the downside, we've got those FMCG names that are not doing very well and is a top losing index today and a whole host of other stocks that are in the red. So that's how the markets are shaping up this afternoon. But joining us today to answer all of your stock queries is Shivangi Sarda from Motilal Oswal Financial Services and Shaina Mukadam to answer all of your stock queries. Shaina, thank you so much for joining us on the show today. And Shivangi will join us in just a bit, but we can get down to answering the first query that's there. We've got Sunil Kumar Geddam, who writes to us from Visakhapatnam. He holds 100 shares of Anantraj at 650 rupees. So he has 100 shares of Anantraj and he is making a loss on that counter. And he wants to know whether to hold or sell. So Shaina, what's the fundamental view for Anantraj? And should the viewer continue to hold the stock at current prices or do you think he should sell?
Hi, good afternoon. See, basically, Arundhati, what I believe is that it's better that he continues to hold it for now. There are two main businesses, as we're aware. One is the real estate business, and one is you have their data centers business. Now, the real estate business is doing pretty well for them, and it is the cash cow. For the current year, I think they should, do pretty well, over about 3,000 crores of revenues. And if you look at valuations, even if you look at the pure real estate business, I think there is a 10% upside from here because on EV by EBITDA basis, about 20 times. Now, coming to their cloud business, data center business, it's a very small percentage of revenues as of now. And why I say that one should continue to hold Anantraj for now is basically that there is some bit of realignment of businesses that is happening. The management is likely to set off or hive off this data center business into its own subsidiary, and the shareholders of Anantraj will get one share for that business in the new subsidiary. That subsidiary is actually being funded by the cash flow of the real estate business and is likely to be the growth driver for the overall group going forward over the next 2 to 3 years. So I would suggest that the current investor or the shareholders continue to hold, let the restructuring happen, get the shares in the data center business, and then review, whether you want to hold the current real estate business or not. But at least as of now, valuations are attractive, continue to hold.
So valuations are attractive and continue to hold. That's the view coming in there for that particular counter, which is Anantraj. The next query coming in from Prasad, who's writing to us from Hyderabad. He holds 10,000 shares of Hindalco for 1,070 rupees. That's what he holds Hindalco at. And he wants to know whether he should hold or sell the counter. He's currently making a loss on it. Shaina, what's your view on Hindalco? The earnings have been good. What's the outlook for Hindalco?
Yeah, so I would say Hindalco is, it's a good investment if you're holding it for the long term. I mean, everything is going for it. If you look at aluminium prices, while they have softened, if you look at it over a couple of months, but I think they will remain pretty steady around the $3,200 per ton over the coming year. And even if you saw the overall numbers for Hindalco for the first quarter were very strong. Of course, this was supported by the very strong performance of Novalis also. And for the full year also, I believe this good performance will continue. And I think in terms of valuation also pretty attractive. If you look at it 1 year forward, it's just about 6 times EV by EBITDA. So while the stock has given you a very good return, if you're looking at it the last couple of quarters, I still think that for a long-term investor, it makes sense to continue to hold this non-ferrous stock, and it gives you a good exposure in the overall metal segment. So I would say continue to hold.
All right, so continue to hold there for Hindalco as well. The next query, Shaina, is coming in from Sriram Raghuraman, who's writing to us from Chennai. He holds 25 shares of Idea Forge at 480 rupees, and he wants to know a fundamental view on the stock from a one-year perspective. And he is making a profit on this counter. Margins did disappoint slightly, but, the order book looking strong. It's in that defense drone area, which is also, getting a fillip from the government at this current point. So what's your view on Idea Forge?
Yeah, so Arundhati, the order book position is very strong. It's about 310 crores. Now, as you said, and the first quarter numbers were a bit disappointing. But I believe that, one needs to not look at it on a quarter by quarter basis, because not only will the orders be lumpy, but the execution also for Idea Forge will be lumpy. Having said that, I think, for the shorter term, it's a small cap with about 4,000 crores of market cap. And for the shorter term, I think, yes, despite all the positives and the good sector it is in defense and the order book position that they have in the aerial UV segment, drones basically, still I think for the shorter term investor, valuations are still expensive, So if you're an investor for the longer term and you want to be in an interesting defense segment, which has good opportunity for the long term, you can continue to hold. On a shorter term basis, it could consolidate in my view because of the expensive valuations. Still, I would recommend the investor continues to hold. He's gotten at a very good price, about 480 rupees and odds. So I don't see any reason why he needs to exit as of now.
Okay, no reason to exit as of now. That's the view coming in there for Idea Forge. The next query is coming to us from Shekhar, who writes to us. He holds 500 shares of City Union Bank that he bought at 220 rupees. He is making a loss on that particular counter. It's now at 217 rupees. And he wants to know whether he can add more shares at the current price. So, Shaina, what's the fundamental view? Do you think he should add more shares at the current price to his portfolio?
Yeah, so the investor would have got the bonus issue, which actually was there in June, 1 share for every 3 shares held. And City Union Bank, I would believe one can add, because it is one of the small banks which actually is doing very well in terms of growth. If you saw the first quarter numbers, they did around 25% of loan growth and over 21% of of their deposit growth. Even if you look at the balance sheet quality, if you compare FY26 to FY25, there were a substantial improvement. Net NPAs were down to, I think, almost almost 0.68% versus 1.25% in FY25. So I think there is an all-round improvement in the balance sheet quality. Growth is good. I think despite some softness that is possible in the overall NIMs going forward, some softness, but still I believe that not only the growth of 20% plus, which is what the management has guided in terms of overall book, as well as good performance, good balance sheet, valuations just about 2 times price to book. I think, the investor can add at current levels.
So the investor can add at current levels. Shivangi, welcome to the show. Thank you so much for joining us. The query is actually coming in for City Union Bank, and the viewer has 500 shares that he bought at 220 rupees. And he wants to know at the current levels, 217, he wants to know if he can add some more. What's the technical view on City Union Bank at this current point in time?
A very good afternoon, Arundhati. Thank you for having me. Banking space has, of course, kind of outperformed from the last 2 odd weeks. If we look at City Union Bank, this stock has done exceptionally good in the last 1 week. The losses have been recouped of the previous week as well. And we're seeing some bit of laggard move from the last 2 sessions, but overall, this stock is headed towards a consolidative phase. Now, if someone has got it for a portfolio view, then I would suggest that we could continue holding this stock long-term. Key levels are still being respected, and slightly positional. One can wait for another 235 odd levels for CUB with a support base of 210.
All right, so that's the view coming in there for City Union Bank. But Shivangi and Shaina, please wait. We've got to take a quick break on that note, but we will answer more stock queries on the other side. Stay tuned.
majority.
वाह सेंचुरी प्लाई क्लब प्राइम फिर भी कुछ हुई तो हुई तो फुल कॉस्ट वापस सिर्फ प्लाईवुड का ना पूरे फर्नीचर का इडियट है क्या कौन देगी सेंचुरी प्लाई टोटल कवर
10 साल तक प्लाई, लैमिनेट, लेबर, ग्लू, ट्रांसपोर्ट सबका फुल कॉस्ट वापस इंडिया में पहली बार।
तू ना सिर्फ नाम का चतुर
Hey. Well done on that ESOP sale. Thank you. Now that you have this extra money to invest, let's build a staggered deployment approach and balance things out between aggressive and safe bets.
Ionic Wealth is your co-founder in your journey of wealth creation.
Hold up. Let him get a second opinion first.
Sounds good.
You can continue.
Ionic Wealth is putting the power of institutional grade AI in your pocket, so you can get your second opinion first. Ionic Wealth AI.
Symbiotech Pharma Lab Limited proposes an initial public offering of its equity shares. The 100% book build offer is being issued at a price band of rupees 938 to rupees 988 per equity share of face value of rupees 2 each. Offer opens on Monday, August 24th, 2026. Offer closes on Thursday, August 27th, 2026. For risk involved and other details, please refer to the red herring prospectus and addendum, which is available on the websites of the company, the SEBI, the BRLMs, and the stock exchanges.
Welcome back. You're still with us on Your Stocks, and you can see all of those stocks on your screen. The Metal Pack doing well, Nifty Bank also doing well. But still with us on the show, Shivangi Sarda, Motilal Oswal Financial Services, and Shaina Mukaddam to answer all of your stock queries. The next query is coming in from Sriram, who's writing to us from Chennai. He holds 90 shares of Petronet LNG at 347 rupees, and he wants to know whether he can average the cost at this current point in time. So the query is on Petronet LNG, and he's got this at 347 rupees. He is making a loss. So Shaina, what's the fundamental view on the stock in the long term? What do you make of the stock, and can he average the cost at this point?
So Petronet LNG is one stock where the valuations are attractive, but at the same, and even first quarter numbers were good. At the same time, I would say do not average. The main reason being is the volatile nature of the overall business and the issues that we are having, the problem, the war in the Middle East and the Strait of Hormuz being closed. In fact, Qatar had declared a force majeure, and actually because of which not only was the volume low for Petronet LNG in the first quarter, but they were able to sustain their EBITDA because of higher inventory price. So they had that profit which actually boosted the EBITDA. Now, going forward, I believe this is going to be an issue. So not only we will have to factor in what is going to happen to the war, the supplies of gas, as well on the impact on prices, as well as, what will be the changes in the price of inventory and what will be the impact on the EBITDA. I think there are too many complications. I would classify it as a high risk stock, and I would say do not average as of now. Wait for some settlement and what happens in the Middle East, and then you can add.
All right, so do not average right now. You can add once we see what comes out of the West Asia war. Shivangi, what's your view on Petronet LNG from a technical perspective? Should he continue? Can he average at this point?
Now, solely talking about the charts, I'm sure, of course, there's a lot of volatility around the crude oil, which is affecting the stock as well. But of course, looking at the monthly chart, the stock has just started to make higher lows formation from the last 5 odd months. And we're seeing that it is slowly and gradually picking up strength, although momentum is slightly missing at the higher levels. Of course, we're seeing good amount of buying in the last 6 to 7 trading session, but we're still hovering near the previous resistance zones. 300 would be an important level to cross and hold to again regain strength in this one. So I would suggest, one could, put a stop loss at these levels, and 280 would be an important level positionally to watch out, and slowly and steadily, of course, trail the stop loss ahead, but not to average more at these levels as the stock is lacking momentum.
All right, so no averaging at these levels since the stock is lacking momentum. That's the view coming in there for that stock. The next query is coming in from Bikash Saha, who's writing to us from Kolkata. He holds BHEL shares at 400 rupees. And he wants to know the prospects in the near term for that stock. So he holds shares of BHEL. Shaina, what's your view on BHEL? What should he do with the stock? He wants to know what the view is in the near term at this current point in time.
Well, in the near term, I think, it is expensive fundamentally. If you look at it like a year back, it was attractive valuation, but the stock, in my view, having run up, the valuations have become quite expensive if you look at the shorter term. Even if you look at it 1 year forward, in terms of EV by EBITDA, it's almost about 25 times. So in my view, for a company like BHEL, I think that is expensive. Having said that, I think if you're a long-term investor and you're looking at like the order book position, they've got order book position close to about 2,60,000 crores. So it is not like, that they will not have orders on hand and then, the stock will do very badly. So I'm not saying that. I'm just saying that if you compare like the performance in terms of EBITDA to the EV, I think it is expensive. So, having said that, I think that it is expensive for the shorter term, and in my view, at least part booking of profits is called for as of now.
Okay, booking of profits is what you are saying at this current point in time. Shivangi, what's your view on BHEL near-term outlook? What are the targets he should watch out for?
Now, of course, when you look at a BHEL, this stock has done exceptionally well in the last 6 months. We've seen around about 44% up move till now. And, this stock is one of the stronger names in the entire pack. And definitely, I would suggest to keep holding this one. It's, making a pole and flag pattern formation on the weekly basis, getting ready for a breakout. But before that, we'll be expecting some bit of more consolidation at these levels. But the good part is that support-based buying is quite strong, and any declines are being absorbed pretty quickly. So this one's definitely a hold. Next levels, what we can look out for is around about 435 and then 440 levels, with a support base of 395.
All right, so those are the key levels to watch out for. Now, the next query is coming in from Shiva, who's writing to us from Hyderabad. He has 100 shares of JSW Cement at 125 rupees, and he wants to know whether he can hold or sell for another year. He is making a profit on the stock, a small profit on the stock right now. Shaina, what's the fundamental view on JSW Cement? Should he, continue to hold or for another year, or should he sell it?
I would recommend continue to hold. The investor is lucky he didn't get it in the IPO. So the stock is below the IPO price of 147, which was a year back, just about a year back in August last year. So at current levels, I would believe that it is quite fairly valued. Not too expensive. If you look at it, on an EV by per ton basis, it's less than $100, per ton, which in my view is quite reasonable valuation. The capacity as of now is 24.1 million tons, which they are expanding. And I believe the capacity that they were adding in the north, actually that came on stream in the first quarter, was one of the reasons while the revenues were good, but in terms of EBITDA, they took a hit because of the additional expenses in the first quarter, which came in from the north plant. Now, over the remaining part of the year, the management has guided higher single-digit growth in volumes, and I would believe even EBITDA that they are indicating is pretty strong per ton. So, having said that, I think in overall performance for the remaining part of the year will be pretty strong. Anyway, first quarter is always weak for cement companies. So, I would suggest continue to hold JSW Cement as of now.
Okay, continue to hold JSW Cement as of now. Shivangi, what's your view on JSW Cement? Should he continue to hold or should he sell? He has a horizon of a year at this point.
I will have a little contra view here. We've seen that cement pack haven't performed in the last 1.5 years. And we've seen that the entire pack, even though whenever it started to gain a little bit of attention, it did not hold at those levels and kind of swung into a good up. I would suggest that cement pack would not be your preferred stock pick for the next 1 year. In fact, if you want something related, infrastructure as a whole is a much better sector. And one could look at Siemens or L&T for that matter. But JSW Cement for me right now will be an exit.
All right, so a little contra view there coming in for JSW Cement. The next query coming in from Shekhar-Chari, who writes to us from Hyderabad. He holds 100 shares of NBCC at 94 rupees and he wants to know whether he can hold or sell for the long term. So he is a long-term investor. He is making a slight loss on this stock. The stock is currently at 88. China, NBCC has a strong order book. What's your view at any time for should he continue to hold?
I would suggest continue to hold. If you look at it over a 5-year period in terms of financial performance, it has been a steady growth. I mean, though the order book position is very strong in terms of overall revenues, the growth has remained relatively steady. And I would believe that it will continue to do well. They have got some in Gurugram, their new project that is likely to contribute substantially to FY27 also. I would suggest that FY27 could be a decent year overall. And the management has also guided, a full year consolidated revenue target of about 16 to 17,000 crores with a margin of about 6.5 to 7% EBITDA margin, which actually makes it reasonably valued. If you look at it on an EV by EBITDA basis, it's about 18 times 1 year forward. I would suggest hold.
All right, so you would suggest hold on this one. Shivangi, what's your view for NBCC? Should he continue to hold at the current levels?
When we look at NBCC, we've seen that, the stock hasn't really performed exceptionally well in the last 5 months. And we've seen that the stock has moved in a very lackluster move, even though there were bouts of buying in between, but they were followed by profit taking. And this resulted in a very consolidative band on the monthly frame if you look at the larger time frame. So there is still more room for a little bit downside. 85 is the next support zone that we're looking out for this stock. I would suggest, if the view is particularly long term, then we could stay. But, a short to medium term view, I would definitely suggest to exit this one. 85 is the next support levels that we're looking out for. And upside remains capped to nearly 92 to 94 zones.
All right, so some key levels to watch out there for NBCC. Shivangi and Shaina, thank you so much for taking time out and being here with us on your stocks. But that's all we have time for on the show today. But do remember to email us or call us and send in your queries and we will address them with our experts. But stay tuned for Closing Bell to take you through the last hour of trade.
Some properties are not just homes. They are statements, achievements, legacies. At India Sotheby's International Realty, we represent the country's most exceptional properties with unmatched expertise. Unique homes, uniquely for you.
Sorry, I'm late.
No worries.
So our daughter, she's starting university in a few years. How do I safeguard against these dollar fluctuations?
So factoring in LRS, the route, and the currency hedge, here's your best move.
Ionic Wealth is your co-founder in your journey of wealth creation.
What's the rush? Let them get a second opinion first.
Yeah, this works.
Great. Please, continue.
Ionic Wealth is putting the power of institutional grade AI in your pocket, so you can get your second opinion first. Ionic Wealth AI.
रिन्यू बदल रहा है इंडिया की क्लीन एनर्जी की कहानी और इसके साथ है सूरज, हवा और पानी। रिन्यू क्लीन एनर्जी हमसे है।
Symbiotech Pharma Lab Limited proposes an initial public offering of its equity shares. The 100% book build offer is being issued at a price band of rupees 938 to rupees 988 per equity share of face value of rupees 2 each. Offer opens on Monday, August 24th, 2026. Offer closes on Thursday, August 27th, 2026. For risk involved and other details, please refer to the red herring prospectus and addendum, which is available on the websites of the company, the SEBI, the BRLMs, and the stock exchanges.
CNBC TV 18 tracks the pulse of markets and business in real time, bringing you the stories that shape the economy.
From breaking news to sharp analysis, we deliver insights that help you navigate businesses, markets, and investment opportunities.
Novama presents CNBC TV 18 Market Central.
Providing sharp market intelligence for wealth creation with a commitment to doing it right.
Get headlines to understand the reasons for the day's movers and shakers, and get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
The Hang Seng is up 0.5%, and the Taiwanese index is also trading above the flat line.
We are going to squash the economy of this murderous regime.
So the S&P was down almost 1%. The Nasdaq was down about 0.75%.
We are very much anchored in the way some of the larger players are in the market.
We are seeing a growth in the US economy in the energy sector.
40 points on the Nifty is what you have. The mid-cap index is starting about 20-30 points higher.
Innovative companies go through their ups and downs of investment cycle.
We are looking at gains of between around 400 crore in terms of EBITDA for Balrampur for this year.
It says India's online home services market is entering its blink-it moment.
The market breadth is looking strong though. I mean, you have about 1,800 stocks that are rising.
The new entrance into the F&O market for retail traders has come down.
Today, Nifty is not in the Friday mode, just taking some rest after what's been a hectic week for the Nifty, quite volatile. But right now, it's a green-looking screen.
Okay, well, that is the day so far, and it has been an absolutely sideways, a small, limited ranged kind of a day. And I think we've got a grand total of 10 points to show for all of the action so far. That's the Nifty for you, but in terms of single stocks, there is a lot of action. This is Closing Bell. We're coming to you from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me are my colleagues Rima and Nigel. Guys, good afternoon.
Hi, and for the whole day, we've got a grand total of less than 80 points in terms of a trading range.
Low.
Yes, high and low, 80 points, less than 80 points.
Yeah.
And that in percentage terms, my friend, is less than a third of a percentage point. So that's how sideways today's market trading session's been, 24,250. But for the week, when you map the performance, week to date, IT has lost about 2.7%. FMCG has been another drag, 2.4% down for the week. On the way up, it's capital market plays, metals, realty. That's where the action's been.
Well, that's right. 80-point range, as Rima said, and 90 minutes to the weekend. So let's get going then.
I think, and I think on Monday, after the results season, Rima, we were talking about how it will quieten down. I think, because, I mean, triggers, right? It's been reactions have been so large. And last couple of weeks actually were so big with stocks moving, flying around. And it feels like a distant past, right? I mean, only 5 days ago that the earnings season wrapped up. And of course, I mean, now it's, I think also, of course, this week, oil's come up a little bit. So the go-go kind of clean run kind of market with supported by strong earnings, that perhaps has taken a bit of a backseat. It's more measured in that sense. There are these blowout stocks. I mean, Welspun Corp will come up on your screen. That is up 15%. We'll talk about it. We had the management with us early on in the morning. But I mean, it's far and few in between in that sense. More often than not, these are smaller reactions that you're seeing at this point in time. Let's just quickly tell you the lineup which you will see. So it's range bound, at least as far as indices are concerned, but small caps are doing a little better. Metals, private banks, real estate are seeing gains. Welspun Corp, as I mentioned, big order, big gains, 15%. Stocks done very well. Urban Company we'll highlight. UBS is asking the question whether this can be the next big winner out of the entire platform space. And you've got sugar, which is in focus. Stocks are down. Sugar prices are up. Government's importing sugar to kind of cool off prices. So we'll talk about that as well. Precious metals, gold is up, back up a little bit from the recent lows of about 4,100. And some of these gold financing companies are coming up. Actually, even silver has come up a little bit as well. So there's a fair bit in terms of things to track in that sense. Videsh is with us. Beg your pardon. Ashish Kayal is with us for a quick technical check on things and trades that he'd want you to take. Ashish, good to have you on the program. Thanks for joining in. How do you see it?
Hi, Prashant. Afternoon to you and all the viewers. See, if you look at the overall index performance, we are trading in a range for quite some time. I mean, the index has moved down, but it is moving up also with a very small range. If you look at historical volatility, that's at the nearly 3 years low. If you look at the overall India VIX, they're trading below 11. So overall, the momentum is not building up. But having said that, yesterday we managed to close about the prior day high after 12 trading sessions. That indicates that there is some kind of a reversal that is happening. Momentum is yet to build up, but I'm going to play for the long side here. Any dips can be an opportunity to buy. We can aim index at back to 24,500 and possibly higher. But the real game is happening in the stocks. If you look at the small cap index, that's at lifetime high even today. The mid cap index touched lifetime high just about 4-5 days back. And that's showing that the overall action is still continuing, but it has become a stock specific market from the mid cap and the small cap space.
Okay, got it. Tell us then about a few of those stocks, Ashish, if you could help us out. Also, if you have a view on Kalyan Jewellers. Every time the stock goes to around 580, 590, it sees some buying. Even today, I'm observing the same. At what level would it negate this positive bias? And on the upside, what are the levels you're looking at?
On Kalyan Jewellers, we saw a substantial gain from 350. The stock touched 650 levels. Post that, we are seeing some kind of a consolidation. But you rightly pointed out, on the downside, the support is around 580, 585. Whenever it comes around this area, we start seeing some kind of positive action. So overall undertone is on the buy side. And there is a possibility we can again re-tax 650 or higher levels from here on. And the support is at 585 on the downside.
585, got that. Ashish, the stocks that you would recommend?
The first stock pick is going to be Paytm. As I mentioned, their stock-specific action has continued in this kind of a market. Paytm has shown a very smart move on the upside from 1,050 levels just about in June. The stock is now quoting at 1635 and ready to move towards the level of 1725 on the upside. That's the target. Stop loss can be maintained at 1585 on the downside. And the next stock pick is going to be AU Small Finance Bank. When Bank Nifty is still struggling near the current levels, EU Small Finance Bank is near its 52 weeks high, and that shows a very strong outperformance. We can expect the stock to reach towards the level of around 1165. Stop loss can be 1070.
Okay, thank you very much for that. Let's talk about Welspun Corp. Won its largest ever single order for $1.8 billion. Nigel, what do you think?
Well, that's right. Welspun Corp has been one of the biggest stars of 2026. And now comes another big trigger for them. The company has secured its largest ever single order worth $1.8 billion for pipe supply from its US manufacturing facility. Now, this takes the total order book to around 42,100 crores, and the execution period is going to be the next two fiscals. That's FY28 and FY29. The order is linked to the Permian Basin for LNG exports, giving Welspun significant long-term visibility, particularly in the North American energy infrastructure market, which has been their core focus. Nuvama, well, they believe that their estimates could see a 15 to 20% upgrade. Remember, their current EBITDA estimates for the next 2 years are in that vicinity of around 3,800 crores to around 4,300 crores or thereabouts. We should get that graphic plate as well up for our viewers in terms of what Nuvama is estimating. Well, the management spoke to us in an exclusive conversation today. They said that capacity debottlenecking will be undertaken as required, with the EBITDA directionally moving to around 5,000 crore rupees over the next 3 to around 4 years. And that is stunning because that would mean their EBITDA potential will be moving to 2.5 times in a matter of around 5 years. Just a few years ago, they were, south of 2,000 crores or thereabouts. And now, in fact, it's moved all the way they're talking about to around 5,000 crores or thereabouts. What stands out is the execution. Welspun has added capacity ahead of demand while maintaining a clean balance sheet. Despite the significant capex, well, now the company is sitting on a net cash positive number. The ROC is holding steady at around that 23% or thereabouts. And finally, a quick look at the shareholding pattern. The institutional ownership has risen from around 25% to around 35% over the last few years. The FIs such as Small Cap as well as Fidelity, they have appeared in the recent quarters, while Quant, Small Cap, has increased their holding on the DI side of things. Autumn, they have remained a long-standing investor in the company with a holding of close to around 5%. So that's all you have to know with regard to Welspun Corp. What a big outperformer it's been. And this large order of around 17,000 crores definitely adds a lot of spunk to shareholders. Well, earlier today we spoke to Mr. Vipul Mathur, the MD and CEO of Welspun Corp. He says that the order book provides visibility till 2030 with the EBITDA moving to around 5,000 crores. Let's hear him out.
More important is that the complete business continuity and visibility till 2030. I think so that 3 to 4 years of run, the visibility of business for the next 3 to 4 years time, which is very, very important for, for us.
Very quickly, if you could tell us, since you're saying that this order is giving you visibility, now by 2029, 2030, should we assume that Welspun Corp's EBITDA number looks closer to around 5,000 crores? Would that be a fair estimate? That's double of what you did last year.
There's nothing wrong to it.
It's working out like that, sir, because 8,000 crores you'll be executing in the next 2 years. That's FY28 and FY29. And you have as been guiding that you'll grow at 15-20% approximately. So it appears that 4,500 to 5,000 crores of EBITDA from Welspun Corp in the next 3 years is there for the taking?
That's our wish list as well, and I think so. We're all striving toward in that particular direction. And but to get to that number, Nigel, we have to be clear that all the geographies have to kick. I think so the US economy is kicking very well. We are very, very optimistic about our Saudi investments, and that will also kick in. And if that happens, and which is bound to happen, I don't think it is not unfair to assume a growth, something what you're suggesting.
Okay, all right. Well, the stock is not 500, 800, 1,500. Now it's 2,300 rupees. Gurmeet Chadha, the managing partner and CIO at Complete Circle, joins us on the show. Gurmeet, what do you make of this name? Welspun Corp, it's moving from strength to strength. Now you think all the good news is in the price. 60,000 crores of market capitalization with the potential EBITDA of 5,000 crores. Means it trades around 12 times EV upon EBITDA. What do you make of it?
It's been a stellar run, Nigel, for the stock. I think YTD is up, 150% plus. I think the massive order they got from US for almost closer to 2 billion. As now, I think the order book is now nearing $5 billion. So you have visibility for next 2-3 years. And I think what they have done successfully is they're very good with, the large diameter line pipes. And now they're getting into the high margin ductile pipes, etc. So also diversifying. And good return ratios. But obviously, I think we bought too little in some of our non-discretionary portfolios. It ran up too fast for our comfort. And that's one learning in this market. companies which are doing well, showing good order books, good earning visibility, strong performance are being disproportionately rewarded, and companies which are little average or lackluster are being punished. So you got to bet on winners where earning visibility is strong. So that's one learning here. So couldn't buy enough. That's one regret.
Okay. Hi, Gurmeet. Thank you very much for joining in. Shanti Gears, that's locked in an upper circuit of close to about 20%. Tube Investments, they're planning to buy a 2% stake in the company. Analyze the company. What does this mean?
No, so not Rima, part of our portfolio, but again in our coverage. But as I said, not like to like comparison, but we are quite overweight entire auto ancillary and ecosystem. The numbers have surprised. We have good exposure across, including Uno Minda, Sandhar Technology, Raj Ratan Global, which is more into bead wires. So enough of it already, but yeah, not part of the portfolio. And as you know, this market is, as I said, disproportionately rewarding any good news as well. So but as I said, not part of our portfolio.
Okay, not part of the portfolio. Let's talk about some platform companies. Gurmeet, good afternoon. So just let me get in Sudarshan to talk about Urban Company. Set this up a little bit, right? So there's this UBS note getting a lot of attention. Stocks up some 6-7%. So take it away.
What is UBS saying? It says India's online home services market is entering its Blinkit moment, and this company, that is Urban Company, is at forefront of this evolution, and it has mentioned some of the factors. First, there is a right product market fit by Urban Company. There is strong balance sheet that the company has been providing over the last few years. And third, that's the most important factor, is the execution track record with a clear focus on unit economics that company has been focusing not only since the listing, but over the last 5 to 6 years. And there are some of the factors why UBS is positive, and the stock is reacting to that as well.
That's Urban Company for you. By the way, are you a user, Urban Company?
Yes.
What do you use?
More for plumbing and...
What is it? Insta Help, right? It's called? No. It's called...
That's a part of Urban Companies where they send you the house help if your maid doesn't come, and then they will send you for 1 hour.
What is it called? It's a specific term for that.
So there is Insta Help. I don't know what it's... And then there is another company called Snapit, which also is in the similar space, and both the companies are vying for the market share. What's the name?
It's called Insta Help.
It is Insta Help by Urban Company, where they send you the buys.
If Mangalam was watching, it would kill us. We don't know Insta Help. But it is Insta Help. And now, this is the reason I'm mentioning Insta Help is because I think for the longest time, the worry was Insta Help loses money.
Yes.
That I remember. I didn't know the name of the service.
It's Insta Help only. Yeah, the company is deploying money from the regular business into Insta Help, but they see it as a huge category, and they're building the category along with that.
And they're seeing it as a category, but also, I think more importantly, recently they've clarified that they're using it as a funnel to kind of, essentially get into homes and use those leads, use that kind of as a funnel to offer more services. So I think that is perhaps, if you want to just track the trajectory of how the market perceived Urban Company, Insta Help, and the various segments, etc. One kind of thing which was a bit of a thorny point was this is the segment. Where are the unit economics? It's losing money. Why are you investing? But I think, the management's come forth recently with the investor meetings, etc., saying that this is a funnel which is going to help our other lines of businesses in a big way. Anyway, there was that UBS note as well. So let me ask Gurmeet to come in. Gurmeet, take it away. What's your view?
So, so you have to differentiate e-commerce. This is basically home services marketplace, offering all kinds of services. Roughly about, I think, a little over 80-90 lakhs annual transacting users, and picking up, I think, growing 30% plus. So I think it's for us, it's a wait and watch. We have recently added Prashant Misho in our portfolio when it went down to about 170 odd levels. That's where we are seeing significant scale getting built up. So, it's creating a nice platform for sellers, buyers, content creators, logistics guys. And unlike other e-commerce, it doesn't have a take rate. It's a zero commission model. And where you monetize the advertising part and the logistic seller fee, right? And I think now it's reaching a stage where, you can call it an inflection point, where the growth is and the losses are cutting down. So it's almost not touching 3,800 crore kind of a quarterly revenue. 26 crore annual transacting users, 250 crore plus orders. I think the scale is humongous. And I think this has the potential to probably do maybe 6,000-7,000 crores quarterly revenue, maybe in a year and a half from now. So we started getting into this. I just love the AI ecosystem and some of the algorithms they have created. This everyday low price model, carpenters, and all the SMEs and tier 2, tier 3 towns using it. So we like this more. But even urban companies are on our watch list. So we are creating a new age business portfolio. We have Eternal Paytm, we have Grow, and now we have Meesho in that. So we want to have it around 10% with 4 or 5 ideas.
And since you like this, you specifically sort of went into some detail about Meesho and why you like it, which is more D2C, smaller businesses and that kind of thing. I mean, Shiprocket operates exactly in that area. But of course, they kind of are between the seller and the buyer in terms of logistics and the payment and that kind of thing. Have you looked at this one?
Yes, we did. But as I said, you can choose one. So we've gone ahead with Meesho, and the price has nicely consolidated. And as I said, I see the revenues hitting 5,000 crore quarterly run rate very soon. The losses are now down by almost 50%, and maybe in a few quarters you would see once it breaks even. I think the growth suddenly in even in bottom line could be quite geometric. So I think that's the point when probably you will see more re-rating coming on the stock.
Gurmeet, Doodh Transmission, Leap, Milky Mist, Shiprocket, of course, these were all the recent listings over the last 2 weeks or so. You gave your view on Shiprocket, still wait and see how it plays out. But did you participate or are you interested in any of the other 3?
Not yet. Unfortunately, also, when you run a PMS, you run a more concentrated portfolio of 24, 26 stocks. So some things you need to let go, and so unlike a mutual fund, which can have a much longer tail. So we're tracking few of them, as I said, and this market, you probably need to rotate a little faster. But there's a lot of value emerging in some of the even boring businesses. So some of the existing names, even in large cap, offering so much value right now. I'm actually surprised the way market is reacting to the likes of Bharti or ICICI. And so many good names, M&M. I think there's so much value in large cap, and largely because of the positioning of FIs and the short position there is under. I think there's some bit of a rebalancing in the market will happen in second half. I think there's been a huge underperformance in Nifty stocks versus rest of the market. So I think we are now we went small mid caps like 70-80%, 65-70%. I think now there is an inclination to probably go back to some boring businesses. And I personally think, could be wrong on this, I think the tide is about to turn on FI flows. I think we are too much in the oversold zone, especially in some of the very select large cap names.
Back to betting on large caps, boring companies. It's just that some of these IPOs have given you such quick returns. Yesterday, we were having a discussion on IPOs, and he said that post-July, the IPOs have given you an average return of 25%. If you look at only the IPOs since August, it's been 36%. And for the full year, the number is a little more, 11%. So some of these recent IPOs have been money spinners and quick returns for the investors. But hold on, there's another story that we want to talk about, that's sugar. The government, in a move to cap rising prices of sugar ahead of the festive season, has allowed duty-free imports of up to 1 million tons of sugar. Ria joins in with the analysis.
Well, sugar stocks have been in focus today as the government has allowed 1 million tons of raw sugar to be imported at zero duty until the 31st of October this year. And this is because the government is trying to bring down the recent record high sugar prices that we've seen in the domestic market of late. And as per this notification, sugar mills and refiners with functional capacity to convert raw sugar into white sugar should apply between the 21st to 28th of August this year for the tariff rate quota that will allow imports at zero duty, and preference will be given to importers that will undertake to complete these imports by the 15th of October. And after this announcement came through, the benchmark white sugar futures in London and the raw sugar futures in New York jumped by as much as 4% after this announcement had come through. And some reports have also suggested that India is likely to import a large part of this sugar from Brazil, which can take nearly 2 months, and domestic supplies will then be boosted from October onwards rather than an immediate impact that most people were expecting earlier. And in terms of the impact, this can cap the domestic sugar rally to an extent, and sugar mills will also see a slight hit to their margins in the near term. Today, we are seeing some profit booking taking place across the entire sugar pack, and stocks like Balrampur Chini, Triveni Engineering, DCM Shriram, Dalmia Bharat Sugar, even EID Parry, all of these stocks trading with cuts today, down as much as 4 to 4.5% today.
Thank you very much for that. And on your screen, you can see the lines flashing. Gold prices surging once more. They crossed $4,500 an ounce earlier this week, now $4,600 an ounce. And I think they've been on a tear. So ever since there was that U.S. bond prices, I mean, the big story globally has been rising crude prices this week, rising U.S. bond yields, the dollar index cooled off, and all that is positive for gold prices. So globally, gold prices too have gone up. Gurmeet, a quick word on sugar and the intervention that we're seeing from the government's end.
No, so we don't have one, but we have been tracking Balrampur now for a while. It's a vertically integrated name with ethanol as well as sugar. Plus now they are getting into PLA, which is polylactic acid, which is bioplastics essentially, and working on a green chemical one. So that's the one we are tracking more for a sustainable one. Sugar has to be very, very tactical. And, once I've got it wrong very badly, so it's, some of the past scars prevent us from doing sugar. So no sugar for now, but Balrampur is on our track, especially if this bioplastic thing takes off. And there's a little more clarity coming on ethanol. Too much flip-flop happening here as well on E10, E20. So this more clarity comes, maybe we'll probably look at Balrampur at some point of time.
Okay, thank you very much for that. Let's talk about precious metals trading at multi-week highs. Manisha is here to get us a complete roundup. Manisha.
Well, thank you so much for that. It's the commodities clearly have been surging and precious metals are not too far behind. We are trading at around 3-month highs for gold and silver, both of these commodities. The overnight markets have been quite strong, but when you look at this week itself, it's a third weekly gain coming in for the gold and silver prices. Also, when you look at the overall week, gold is up by 5%, silver is up by 9% as well. And for the month of August, gold is now gained up by 11% and silver by 17% as well. There are various factors on why you're looking at money rotating back in case of precious metals. Well, one, it is a safe haven buying. You still have geopolitical concerns. It also has been about the crude oil prices surging to $92, $93 a barrel, and crude is up by 50% in this year. Much of that inflation clearly seems to coming into the market, and that safe haven buying is coming in for gold because of that as well. You have dollar index trading at 3-month lows. The global central bank buying has just about continued. The US debt is now trading towards or going towards $40 trillion. And that is something that will keep the money keep coming back in case of gold and silver there. The speculative buying is coming in. The short covering is happening as well. And when you look at the overall markets, well, Indian festival demand is coming quite strong as well. The markets believe that what we haven't seen in the past quarter perhaps would be covered for in the next 4 or 5 months. And that has been supportive as well. If you look at the future or forward-looking guidance coming in for gold, well, almost everybody in the global markets, Indian markets, believe that gold and silver is the place to be. The Wall Street banks like JP Morgan, Goldman Sachs believe that $5,400, even $6,000 an ounce is a possibility. We are trading at $4,600 right now. Metal Focus talks about 5,000. You have Deutsche Bank, HSBC, ING talking about levels anywhere between 4,600 to 4,900 in the final quarter of this calendar year. For the Indian markets, that would mean 1,80,000 rupees per 10 grams for gold, and silver could be going to 3,50,000 all the way back yet again.
Okay, all right. Thanks a lot, Manisha, for that. All that glitters is gold and twinkling is silver as well today. Well, Gurmeet, we'll thank you for that. Thanks for joining in. Have a good Friday evening and a good weekend ahead as well. We'll take a break, come back. Our Alpha Manager of the Day is waiting for us, Alok Agarwal of Alchemy Capital Management. Stay with us.
Sanction.
Welcome back. Alok Agarwal is with us from Alchemy Capital. Markets are absolutely flat. Nothing. 5 points. 24,240. Alok, good to have you with us here. Thanks for joining in. No reason to be, I mean, after a very, very busy, very hectic earnings season where stocks were also reacting big time, both up and down. I mean, natural for things to quieten down a little bit in that sense. I mean, are we awaiting more triggers? What's your sense, Alok, broadly? And, you know, before we took a break, we were talking about Dreamer, briefly mentioned the rise in the long end of the bond yield in the US. I don't know if you're watching any of it to take a call on the market, whether maybe, you know, if oil stays up and this is a worry at the margin, I mean, it can sour sentiment a little bit. I'm not sure, especially, and that matters if you're trading. Your thoughts?
Yeah, hi Prashant, pleasure being here. You know, a lot of things to be noted there. We entered this quarter with the start of the war, with crude prices being up nearly 30-35% from pre-war times. And nobody really would have expected that we would have a 10-quarter high kind of earnings growth. So earnings were definitely ahead of the estimates. Majority of the companies beat the estimates. There are far more upgrades than the downgrades. And we saw a very resilient market despite heavy selling by the FIIs. Of course, there's a lot of Hormuz discount given to this market because of the rising crude oil prices as well. And as you rightly touched, the most important variable today globally to be watched is the multi-decade high kind of yields that we are seeing globally. And that's forcing a lot of treasuries to take actions, be it on the currency side, be it, as you said, buying the long end of the bonds by issuing the shorter end. But the fact remains that so many years of liquidity infusion is now showing up in the form of higher yields and higher inflation. And managing that would be the key area to watch out. Typically, one can say that rising yields is not very favorable for high valuations. So that's an area that one needs to really look at. But nevertheless, a lot of areas in India are really showing growth. Manufacturing being in focus, both fiscal and monetary are aligned. The GST rate rationalization as well as the liquidity measures are still showing signs of getting into the markets and the economy.
All right. Hi, hello. Good afternoon. Good to see you in. So what's new? What have you all moved around in your portfolio? Any kind of shuffling you have done?
Actually, some of the areas continue to be the key focus areas, be it the power and the electrification theme, have been extremely bullish on the industrial metals and the precious metals as well. Over the last few couple of months, I think we have increased exposure more towards the pharma side and also towards the capital market side. And we continue to prefer these areas. So power equipment, metals, pharma, capital markets, as well as defense.
Got that. By the way, one of the simplest, cleanest trades, right? If you're worried about yields, etc., is gold. Yeah, I mean, it's already, you're seeing that on the screen as we speak right now. But, you know, it's I think it's moved up, what, 10%, 10-12% from the recent lows. But yeah, go on.
Yeah, Prashant, completely agree with you. You know, at the in the middle of this year, sometime when the Fed chairman got changed, there was a lot of fear that there could be hawkish stance by the new incoming Fed chairman because of his earlier stance and statements. And same got factored in terms of correction in some of these precious metals. But given the last few weeks intervention by the Treasury, and it looks like yield control is far more important. And in such a scenario, hawkish stance is the probability of that is getting down. And you know, look at some interesting data there. US debt to GDP is almost going towards where it was near World War II. And during those times, 50% of the debt was covered by the gold. Today, it's only 3% being covered by gold. So definitely, there's a long case for bulls on the gold side. And that's one area that's acting up as the main reserve currency. So as and when the debt numbers continue to be high, the yields continue to be higher. And in case the hawkish statements are not there, falling real interest rates in US would be positive for gold.
Also, I mean, you know, oftentimes it is because liquidity is looking at different things, right? I mean, it's been all about equities. Before that, it was about precious metals, right? I mean, there was this phase where It was just precious metals which were ripping higher, and they all kind of slumped a little bit. Then it all moved into equities, and we've been in that phase for the last couple of months. I mean, more than a few months now. Who knows? Are we starting one more round? I mean, it's almost like round robin in a way from one asset class to the other. But although it's largely been two asset classes, which is, if you look at the last 1 year, I mean, flipping between precious metals and gold. I mean, not really talking about oil, etc., as an asset class. Those who do oil, but for normal people, I mean, I think they can do equities, they can do gold easily, and maybe oil as well. But that's a completely different ball game in that sense. Just in terms of momentum, which I'm sure on the quant side you track pretty closely, what is that telling you, Alok, if you want to just run us through some color, not what you own, but where are you seeing momentum, where are you seeing momentum dying down?
Very clearly in India, the manufacturing has been the focus. And yes, there has been some turning or some rotation within that manufacturing as well. So for example, power equipments, etc., did far better in the earlier months. But both the growth as well as money seems to be moving more towards cables and wires and the lower end of power equipments as well. And we are also seeing a lot of money moving towards the pharmaceutical side. So those areas are definitely doing well. But some of the index heavyweights like the IT or the FMCG or the large banks, they're still struggling for the momentum side, both in terms of flows as well as from the earnings growth perspective.
Okay. All right. Alok, we leave it there. A good conversation as always. Thank you very much for joining us. Good speaking with you here on CNBC TV 18. I just want to quickly run you through SEBI's latest study, which tells a story about what retail has done, is doing in markets. I mean, their participation at levels have come off. But SEBI still says that the overwhelming majority, at least on the F&O side, is losing money. Hormuz is here to put all that data into perspective. Hormuz, take it away.
Well, SEBI study has two messages. One, change is the only constant, and the other one, there are certain things that do not change. The first thing that has changed is the number of active individual traders that has declined in FY26 from 98 lakhs to 78.6 lakh in FY26. This is, of course, the retail participation in the futures and options segment. Even the new entrants in the F&O space has declined by 40% on a year-on-year basis. Now, if you take a look at the aggregate net loss that individual traders made, that has seen a decline from 1.12 lakh crore in FY25 to just under 92,000 crores in FY26. That, of course, needs to be taken into account for the fact that the participation too has come down from last year. This one thing that has not changed, the number of traders who lose money. 9 out of 10 last year, 9 out of 10 this year as well, although the number from 90.9 has gone down to 87.7. But the individual traders making a net loss has also increased from last year, from 1.32 lakh to 1.47 lakh is the average sum that an individual trader has lost in the F&O segment in FY26. So who's making money? Everybody but the individual trader. Proprietary, FPIs, corporates, mutual funds, all of them have made anywhere between 3,000 to as high as 45,000 crore rupees in FY26. But take a look at the individual number. That 72,243 crore is a net loss number, not a net profit, even before you include the transaction costs in this. Now take a look at the expiry concentration as well. Majority of the index options turnover comes on the expiry day, on the same day expiry, that's 59%, a day before the expiry 75, and a week before the expiry is where majority of the 97% of the index options turnover comes from. Who is the bigger loss maker between an options trader and a futures trader? The answer is a futures trader. This is the amount of money, of course, that's 2 lakh rupees compared to 1.5 lakh for an options trader. Now take a look at the interesting trends that have emerged here. Two of them stand out. The age below 30 participants have increased to 43% from 31% in FY22. The standout one is the women traders, 17.1% of the total sum. The loss ratio here is 84.7%, and that is lesser compared to the men. That's the standout here. Now take a look at the traders versus the speculators one. The 35% of the total equity derivatives participants have zero equity holdings, and 78% of those have equity portfolios less than 1 lakh rupees. Now these small portfolio traders are contributing to 51% of the turnover, and 70% of the losses are also borne by these traders. So they are the ones that are doing the majority of the heavy lifting. Take a look at the transaction costs. In FY26, that stood at 25,000 crore, taking the 4-year sum to 1 lakh crore rupees, and that share of securities transaction tax, which stood at 13% in FY22, has gone up to 27% at the end of last year. Option buyers accounted for a majority of the traders. Yes, they also accounted for a majority of the losses as well. Only 2% of the option sellers, but take a look at the risk of being an option seller. The average loss made by an option seller is 51.5 lakh rupees. Compare that to a major options buyer and a pure options buyer, and that figure ranges anywhere from 1.5 lakh to 4.5 lakh rupees. Experience teaches you a lot of things but may not necessarily lead you to profits. Traders participating in their first year, 91% of them are loss makers. Participants who have participated for 4 years at a stretch, 95% of those are loss making, and who have participated for 5 years at a stretch, even 2/3 of those are still losing money. And 90 to 92% of those traders who lost money in 2 consecutive years participated in the 3rd year, and they lost money there, it's there as well. So that's the standout part of this SEBI study. Although participation has come down, but the losses remain constant. 9 out of 10 retail traders still lose money in the F&O space.
Thanks, Hormuz. And in that sort of a backdrop, I'll try to analyze the F&O market purely for educational purpose. Well, let's move to the options data. 24,200 put. The premium out there is holding around 50 rupees approximately. It's moved in that band of around 45 to around 55 rupees or thereabouts. There are signs actually that are writing at that particular stride. The 24,300 put as well. The premium out there has come down to around 80 bucks. I think it started the day at close to around 90 rupees or thereabouts. So there is some signs of writing even at those levels. So there is an even bit of a tussle between the call as well as the put side. And on the call side, the premium on the 25,250 call, even in the markets at the high point of the day, you're not seeing that premium run away actually. The premium actually is coming down, which is telling you there are writers, in spite of having the direction right. That's when the market has gone up 25, 30 points or thereabouts. You'll expect to make some money, you'll expect the premium to hold steady. But actually, the premium has come down by 13 to around 15%, which is indicating there are writers. The call writers still believe higher levels can get defended. And what are the levels? 24,350, which is incidentally where you have the 20-day MA as well. The reference point on the downside is actually the recent low, which is ballpark around 24,025 or thereabouts. Individual stocks are calling for attention though, and after the run that we saw on IT companies, the big boy Infosys has come in for some unwinding of positions in trade today. Well, a couple of stocks that have corrected a decent bit from the recent top, they're coming in for a bit of a short squeeze today. So if you look at Hindustan Zinc, that one in fact is seeing a bit of a bounce, and you have Bharat Dynamics as well, is also seeing a bit of a short squeeze in today's trading session. The range continues on the headline index, but individual stocks, they're doing a thing of their own. Well, we'll slip into a short break. You come back, or we'll get you the recent in terms of the technical calls. Stay with us.
Well done on that ESOP sale. Thank you. Now that you have this extra money to invest, let's build a staggered deployment approach and balance things out between aggressive and safe bets.
Ionic Wealth is your co-founder in your journey of wealth creation.
Hold up. Let him get a second opinion first.
Sounds good.
You can continue.
Ionic Wealth is putting the power of institutional-grade AI in your pocket, so you can get your second opinion first. Ionic Wealth AI.
Symbiotech Pharma Lab Limited proposes an initial public offering of its equity shares. The 100% book build offer is being issued at a price band of rupees 938 to rupees 988 per equity share of face value of rupees 2 each. Offer opens on Monday, August 24th, 2026. Offer closes on Thursday, August 27th, 2026. For risk involved and other details, please refer to the red herring prospectus and addendum, which is available on the websites of the company, the SEBI, the BRLMs, and the stock exchanges.
रिन्यू बदल रहा है इंडिया की क्लीन एनर्जी की कहानी और इसके साथ है सूरज, हवा और पानी। Renew clean energy हमसे है।
Symbiotech Pharma Lab Limited proposes an initial public offering of its equity shares. The 100% book build offer is being issued at a price band of rupees 938 to rupees 988 per equity share of face value of rupees 2 each. Offer opens on Monday, August 24th, 2026. Offer closes on Thursday, August 27th, 2026. For risk involved and other details, please refer to the red herring prospectus and addendum, which is available on the websites of the company, the SEBI, the BRLMs, and the stock exchanges.
Some properties are not just homes. They are statements, achievements, legacies. At India Sotheby's International Realty, we represent the country's most exceptional properties with unmatched expertise. Unique homes, uniquely for you.
Welcome back. Let's get into a few more trading ideas. Ashish Kyal now joins in for the last leg on the show. Ashish, it's turned out to be a very quiet trading session. I think since we started the show also at 2:30, the index hasn't moved. What are the trading ideas you're recommending?
Absolutely, the index has not moved anywhere. It looks like it's stuck at like a magnet at around 24,230, 24,240 levels. But that's how it has been for quite some time now. With respect to individual trades, Eternal looks to be very, very good. The stock has steadily been moving on the upside with a very clear positive trend. The target on the upside for Eternal comes to around 350 levels. One can maintain a stop loss for the stock at around 320. And the other stock on the buy side is Data Patterns. It has formed a very classic rounding bottom kind of a pattern. It's just giving a breakout on there. It's there. And we can expect the stock to move towards the level of around 5,300 on the upside. The stop loss on the downside can be 4,590 levels.
Okay.
Yeah, no, absolutely. By the way, it's a new listing. Actually, two names I want to ask. Welspun Corp, technically, if you have a view, don't disturb a stock cruising at high altitudes, at all-time highs. Is that the view, or is there anything else here?
If you look at Welspun Corp, Prashant, the stock has shown a substantial move of 15% on the back of the news. But I would not recommend to buy at these levels because the risk reward will not fit. If you have to place a stop loss on the stock, it's way too far away to sustain that risk. So my recommendation will be if there is any kind of a dip that we can get on the stock somewhere around 2,200 levels, if we get any, then that's the ideal level to be keeping a long positions or creating a buy trade there, maintaining a stop loss of around 2,070 levels and then expecting it to go towards the lifetime highs again of around 2,500, 2,600 on the upside.
The other one I wanted to ask is Urban Company. Again, it's just like a year old, not even a year old. But any thoughts?
Absolutely. So Urban Company has given a very strong breakout on the upside now. This stock, coincidentally, I was also on CNBC. I was playing the Kladi show and I won because of this stock today. And it is possibly moving towards the level of 170. I think it's a very strong breakout after quite some time. Formed a very classic cup and handle pattern, and 170 can be the short-term target, and we can even expect it to go towards 185. On the downside, 150 is a very crucial support. So the stock looks good from current levels as well from a risk-reward perspective.
Meesho has gone pretty sideways around the 200 rupee mark for the last 6 months or so. Ashish, have you looked at it technically?
Yes, Meesho went sideways, but if you look at yesterday's movement, Meesho showed nearly around 6 to 7% of uptick yesterday itself. and today it's just digesting that gain. So for me, the stock was technically in a range, but gave a breakout after around 1.5 months, and that's a very classic breakout. So my suggestion would be to use this dip as a buying opportunity and aiming for the pattern target of around 225. On the downside, 195 is a crucial support level.
Got it. Okay, all right. Thanks a lot for that, Ashish. Well, let's listen to an exclusive interview with CNBC where U.S. Treasury Secretary Scott Bessent said that a debt buyback program announced on Wednesday could be larger than the $4 billion, the upper limit that was announced. There's a very good chance that the U.S. budget deficit under President Donald Trump has peaked out.
We're trying to signal that we think that this is a thinly traded area of the market, that we're in August, and there's been a lot of corporate issuance that's influenced the market. And we believe that there are many underlying factors that the market is not looking at. And we are going to make a market in these. We routinely do buybacks, and we're going to increase the size of the buyback. And Sarah, I would note that it could be more than the $4 billion per issue.
Got that. Well, that's the Treasury Secretary in conversation with CNBC in the U.S. Now, after HDFC Bank, the board of ICICI Bank has approved overseas borrowing of $5 billion. Ritu is here with details. Ritu, take it away.
Well, ICICI Bank is stepping up its overseas borrowing plans, with the board approving a revised limit of up to $5 billion for raising funds in overseas markets through bonds, notes, or offshore certificates of deposit. Now, keep in mind, this is just an enabling resolution, which means $5 billion is the outer limit of the raise, so it's not necessary that the bank goes ahead and raises the entire sum. Remember, ICICI Bank has already raised about $750 million through overseas bonds, but the intent is clearly to go big here with this latest resolution. Now, this comes even as HDFC Bank has already raised about $1.75 billion in its largest bond issue by an Indian bank since the global financial crisis. This issue has two parts: $500 million of 3-year bonds and $1.25 billion of 5-year bonds. The 3-year bond by HDFC Bank was priced at 88 basis points above the US Treasury, while the 5-year bond was priced at 100 basis points above the comparable rate. Now, this is HDFC Bank's second major overseas borrowing in just over a month, where it had raised about $750 million in July. So HDFC Bank has now raised $2.5 billion in total from overseas markets in just under 2 months. Now, the timing is very critical because RBI's special FCNRB window closes at the end of August, which is a month earlier than originally planned. And under this window, RBI is absorbing the cost of hedging for banks, and that makes it cheaper for them to attract foreign currency deposits from NRIs. So banks are now moving on two fronts very quickly. They're raising as much FCNR money from NRIs as possible before the deposit window closes, and they're also tapping overseas markets for foreign currency funding, while the RBI support is available to offer that leverage to their depositors. And with ICICI Bank raising its borrowing limit to $5 billion, HDFC Bank already having done $2.5 billion, expect even more Indian banks to come ahead and tap global markets in the run-up to that special window closing.
Okay, Ritu, thanks a lot for that. Well, we have Anand Tandon, market expert, who joins us on the show. Hi, Anand. Good afternoon. Good to see you, Ben. Anand, I want to ask you about Polycab. It's a stock that slipped a little bit in the last few minutes yet again. And it's been a big wealth creator. Now, a couple of factors are weighing on the stock. One is a possibility of some supply overhang. We'll have to see whether or not that comes about. And the other problem is Ultratech Cement, or the Bidla Group, is coming in with full force in the final quarter of this calendar year. We know post the announcement, the stock corrected, and then it's pulled back with even higher ferocity. But what would you do in this sort of weakness? Were you looking to add, or will you want to stay by, aside for the time being?
It depends on your time frame of investment, really, because clearly, as you said, the sector is doing quite well, and most of the companies have reported good numbers. So has Polycab. But we have seen the same game play out in the paint sector. When the leaders were suddenly confronted with somebody like that, like the Aditya Birla Group and JSW, there was a fight for market share, because when you have that kind of money backing you, there will be obviously a time frame where there will be an erosion of margin as well as market share for most of the existing players. We are likely to see something similar here. The only good thing is that we are coming in at a time where the market itself for this kind of stuff is really roaring, because you have seen capital goods company, in particular those related to the electrical industry, doing exceedingly well, and therefore the demand is very buoyant. That may allow a little less pressure than what it was, for example, in the paint sector. But overall, you would expect to see competitive intensity becoming a bit higher.
What about competitive intensity in the gold loan space? Aditya Birla Cap also yesterday announced its entry. It's made a lot of wealth. We've seen gold prices surge along with that, even the fortunes of these gold loan companies. But from here on, with the number of players going up and the competitive intensity going up, gold prices in a way moving sideways, barring here and there one-day moves, what is the assessment of the overall opportunity over the medium term?
I think here the game is also going to be a little better, because of the simple reason that I think, we've probably seen a near-term bottom in gold. You're likely to see it going up from here, especially given what is happening in the US in terms of the dollar. And in that kind of scenario, obviously the ability to lend becomes more for the same gold. In this particular context, given the fact that, we may see a bit of tightening on interest rates even in the domestic market, people would look to be borrowing at the best rates that they can, and gold does offer enough security for the lender. So in the case of lending, it's never enough, right? There is always a new borrower out there who needs the money. And it's simply a question of what rate you can supply it at. So long as more people are coming in, I think you will find enough of demand for the credit. I don't see that as so much of a problem.
Yeah, no, absolutely. I think we'll take a break, Anand. There's about 7 minutes to go for market closing. We'll just come back in a minute and continue this conversation with Anand. Stay tuned.
The thing Iran most urgently wants.
वाह सेंचुरी प्लाई क्लब प्राइम फिर भी कुछ हुई तो फुल कॉस्ट वापस सिर्फ प्लाईवुड का ना पूरे फर्नीचर का इडियट है क्या कौन देगी सेंचुरी प्लाई टोटल कवर
10 साल तक प्लाई, लैमिनेट, लेबर, ग्लू, ट्रांसपोर्ट सबका फुल कॉस्ट वापस इंडिया में पहली बार।
तू ना सिर्फ नाम का चतुर
Okay, well, welcome back. By the way, the closing auction session is underway, and in about a minute or so, it'll come to an end. I mean, you can put in the orders, you can see the indicative price change happen, and of course, I mean, between 328 and 330, you'll have the final price, which will come up. The Sensex, similarly, 77,470. And 77,522, by the way, was the price at 315. So I think there is a bit of a change, 252, 30-point change, by the way, 20-point change, beg your pardon, on the Nifty, and maybe a bit more as far as the Sensex goes. Rima.
Well, I think on Sensex, the indicative closing price is lower. Once we'll just get that rate up. On the Nifty, it's higher by 20 points, but that Sensex will come. No, it's similar only. It's just about 15 points up on the Sensex and 20 points up on the Nifty. Just some more stocks which are seeing some big moves. You've got Parag Milk, which has suddenly spiked close to about 10%. It's been moving up in the second half of the trading session, but now big gains. Well, it's been a subdued session for IT, but Happiest Minds has broken out, so 8% gain on that. Shiprocket, Milky Mist, some of the recent listings, they're on fire. And Amagi Media Labs up nearly 4.5%. Anand, any of these names, do you like them? I mean, it's all hodgepodge, but Milky Mist, maybe some of the other dairy companies are getting re-rated after the kind of listing Milky Mist had. And Amagi Labs, listed earlier at the start of the year, issue price was sub 400. Now the stock has crossed 600 rupees. It's a little complicated, this company, to understand, but what do you like?
If you have to look at a business model, I think media is more interesting than milking companies. Amagi certainly has an interesting business model because you are looking at a company which is able to tie together both the broadcasting, the transmission, the advertising. So, and obviously add some value because you can allow companies to bring in a channel almost immediately without having to put up any major capex. The big challenge I see in this is that, most players in the market who are existing players with large content already have their distribution set up. So to that extent, weaning them away will be a long cycle process. But that said, they have been extremely successful in getting to a certain stage. And even their existing business growth is showing at least strong 20% growth. So definitely looks like an interesting company, barring the valuation. That is your choice. But otherwise, the company's business seems to be on a strong kick.
Okay, thank you very much for that. Anand, we leave the conversation here. The bell has gone and the final close on the Nifty is 24,252. And that's exactly at the indicative closing price at 315. The Nifty was at 24,234. The indicative closing price was 24,253, 24,254. And we've closed exactly there. So it's a gain of close to about, there you have it. The forecast, 234. The settlement rate is 252, but in line with the indicative rate. On the Sensex as well, it's about 18 points higher compared to the 315 level. On the Nifty Bank, it's about 115 points. But as I said, exactly around the indicative price. So it's been a quiet trading session. In fact, for this week, the Nifty is down close to about 0.5%. This is the week when crude prices inched up nearly 5% over the week, crossed that $94 per barrel mark overnight. That was a little bit of an overhang. The mid-cap index was pretty much flat, down close to about 0.1%. Some of the big movers for the day, Power Grid, HDFC Life, Kotak Mahindra Bank, Nestle, BEL. 5 Nifty stocks ending with a gain of 1% plus. Out of that, 2 of them, Power Grid, HDFC Life, were up more than 2. On the way down, Trent, Maruti Suzuki, BSC, HCL Tech, Interglobe Aviation were down between 1 and 2%. Well, with that, it's a wrap on this edition of Closing Bell. Don't go anywhere. On the other side is our special, editors roundtable.
India.
A range-bound week on the Dalal Street saw the Nifty and the Sensex slip nearly half a percentage point each, with IT, FMCG and PSU Banks being amongst the big drags. More than 30 out of the Nifty 50 stocks ended the week in the red. Over the next 30 minutes, we'll decode the week on the Dalal Street. We'll put the spotlight on the performance of the recent healthcare IPOs. Hello and welcome to Editors Roundtable. I am Reema Tendulkar. With me are my editors, Ekta, Nigel and Prashant. And also joining us here on the show via Zoom is Rajesh Kothari, MD of Alf Accurate Advisors. Hi guys, another week done, and this was a week without the earnings season and things went very, very quiet. The only thing is you get that sense that the macro overhang has picked up compared to the prior week with the way crude prices have moved or even the US bond yields.
I think oil's up 7% this week. Bond yields, we put the data up. I think the 30-year is up 10, 12 basis points this week. It's up 45 basis points year to date. So you're absolutely right. I think the market action
turned a little adverse,
yeah,
but
maybe a little bit, yeah. But it's a Friday, it's a weekend, and things have known to happen over the weekend with comments, etc. So you may come up on the other side with anything. I mean, could be 100, could be back to 90, 85, whatever, right?
And Trump is known to be sensitive to movements in crude prices and bond yields. So that's always a watch point.
Actually, that's the reflexivity. Higher oil prices essentially mean that it'll attract some commentary,
correct,
which eventually is the reflexivity that it'll perhaps push oil prices lower. I don't know if we are there yet or not. But that is it. But you're absolutely right. Otherwise, absolutely quiet. I mean, look at Friday's session, right?
Yeah.
I mean, I think, 3 points, 4 points, 10 points or whatever. And I think...
and the range was about 70, 80 points for the whole trading session.
But I think IT was quite active this week.
Negative, negative on the way down. But we had two downgrades, right? CLSA and Kotak. And these were the two bastions which still held on to having a positive view on large cap IT. So many were bullish on mid cap IT, like your Coforge persisted. Very few were still very bullish on IT, and they had an ad rating, bullish buy call. But today, I think these two also threw in the towel this week. But this was the week, Nigel, where we also had some splendid IPO actions. The one which got listed, rocket moves.
Well, that's right. I have some good. I think there are two overhangs for the Indian markets, and the reason why we're not going up. One is that this fresh supply of paper, the liquidity is getting drained a little bit, which some argue is good. But I think the kind of supply that we're seeing is quite large. And the second factor you all mentioned was the macro factor, right? But crude oil prices moving up. That's what's denting sentiment. We're talking about multi-quarter high earnings growth, and still the markets couldn't get up and going. So I think both these two factors are weighing on. But let's get in Rajesh Kothari, Managing Director at Alf Accurate Advisors, who joins in. Hi, Rajesh. We prefer to have you in the studio, but this time you're, joining virtually. Tell us how you're feeling about the Indian markets. Very good earnings season, but we're not running away still. First, let's comment on the headline index.
Well, I think, while the index from the low of March, of course, they started moving up. And I think the 1Q results have been quite decent. And if you look at overall macro backdrop, the credit growth is now almost 18%. If you look at last year, the credit growth was hovering around high single digit 9-10%, from 9-10% to 18%. Second, if you look at the consumer, post-COVID, for 4 years, consumer was under stress. After a very long time, you are seeing many consumer companies reported quite healthy numbers. And third, if you look at the capex, most capital goods companies have reported reasonably good order intake growth. Whenever there is a trinity of credit, consumption, and capex, corporate earnings growth improves. And that's what gets reflected even in 1Q numbers. And the valuations are still reasonable. So I think market broadly looks quite positive over next 6 to 12 months. Because, of course, we have already seen the last 2 years of pain. And I think that even as the crude oil stabilize, FI outflows will also probably reduce. And that also further add to this overall good momentum.
So, Rajesh, since this trinity of consumption, credit and capex is working for us, is this the most bullish you've been on the Indian market starting today or starting the last 2 months compared to what you were in the last 12 months?
Yeah, it seems so because the worst seems to be over. See, if you look at, remember last year, February 2025, that's where the tariff war started. And then US policy against India throughout February to August. In September, we had a GST cut, huge positive for Indian economy. But by February, the US-Iran war, so oil price spike, supply chain issues. And from April, and as I speak with you, the stability is coming back, which is a good news. So I think the worst is probably over. and hopefully things should improve from here.
And Rajesh, wanted your thoughts in terms of one particular sector which did see some amount of movement this week, which was the entire sugar space. It did snap a lot of its gains today. But nonetheless, are you looking at that space from, say, a 3 to 6 month perspective based on the possibility of rising sugar prices?
I mean, we are not, generally we avoid the commodity stocks. Of course, within sugar, there are 1 or 2 companies which are moving towards the specialty chemical. So there are only 1 or 2 interesting companies which we are looking within sugar space. But as I speak with you, currently we do not hold any companies in the space.
Okay. Eka, you've been doing a lot of analysis on pharma, healthcare. We had the town hall on hospitals. So what's the latest on healthcare companies? I mean, what's caught your attention?
Well, I've moved beyond hospitals for now. I've ended the week with the entire IPO space within the entire healthcare space. So, what really caught my eye was the Molbio Diagnostics listing. I think that was a very interesting listing. It listed at a premium of around 21%. And what it does actually caught my eye because it makes portable medical testing equipment and diagnostic kits, which includes its TrueNat molecular diagnostics platform. So it's not a typical diagnostic company. So that got me thinking in terms of what are the other niche healthcare companies which have listed recently, which are not your typical models that you see. So I looked at around 7 companies and 6 of them in fact have given good returns from the IPO price. So I'll start with Hexagon Nutrition. The IPO came out recently. Its IPO price was around 45 rupees. It's given returns of around 75%. It manufactures micronutrient premixes and specialized nutrient products. Niche hospital plays have done very well. So
sorry, this company goes into what? These niche micronutrients?
So it goes into, say, it fortifies your food. So it produces things which fortify your food, with iron or other kind of nutrition. So that's a different play in terms of the entire healthcare space. Now, niche hospital plays, they've done very well. Nephrocare, for example, it's in renal care. It provides dialysis. It's up 47% from listing. Then the IVF company, Gaudium IVF and Women's Health, it's gained 44% from its listing, which was just in Feb of 2026. Gujarat Kidney and Super Speciality, it has 7 mid-sized hospitals only in Gujarat. It's given returns of 39%. Dr. Agarwal's Healthcare, it's basically eye clinics. It's up 24.5%. So that's the least amongst all of them. But nonetheless, the niche hospital plays continue to give returns. Lakshmi Dental hasn't done well. So that one is down around close to 54%. Now, what's coming next? The IPO pipeline also looks good. Symbiotic Pharma Lab, interesting play because it has a strong play in steroid and hormone APIs. Rays of Belief is a neurodevelopmental care center company. So that's going to be interesting. Indira IVF, which is a huge IVF company, SMT Technologies, which is again in medical devices, G Surgivare, again in medical devices and surgical products. And then we also have a very interesting company called Noble Hygiene, which is coming out. And guess what it makes?
Adult diapers.
It has a revenue of around over 800 crores. So it's a huge business for that particular
And the
company.
hero product is adult diapers.
Different types of absorbent products. So adult diapers is one of them.
By the way, out of the listed names that you mentioned, and of course this is a very interesting list, I should confess that apart from Dr. Agarwal and Lakshmi Dental, the others were like, when did they list? When did what?
They are the smaller companies. They are smaller.
The hospital company out of Gujarat, right?
Yes, Gujarat Kidney and Speciality, then Gaudium IVF. These are the smaller companies, but they've given excellent returns, and they're niche plays, niche stories. They've got funding in the past, so maybe there's some kind of exit which has taken place as well. So all interesting stories. In fact, Rajesh, wanted your thoughts in terms of whether you're looking at any of these different plays, any of these niche plays within the healthcare as well as the entire IPO space.
I think, our rule of thumb remains the same. Look at the company, if the company is market leader, look at it if it's a very niche business. But interestingly and importantly, it has to be the scalable. So we generally prefer the companies, with a likely net profit size of 100 crores plus. And to make 100 crores, you need 125 crores profit before tax, roughly 200 crores of EBITDA, and therefore roughly about 1,000 crores plus at least the revenue. So we prefer the companies which have a scale rather than looking at very, very small companies, because India is a hugely fragmented market. There are thousands of such small companies in every town, every city. probably few of the villages as well. And therefore, you don't have actually the like-to-like comparison. The moat is missing in many of this, very small companies. The systems, technology, some practices, those are always needs to be worked upon. So we prefer the companies which have a scale and the niche business, provided, of course, the return on capital employed is very high. So be it a healthcare space or even in the general IPO markets, we are very, very selective.
All right, Rajesh, I wanted to ask you about precious metals, right? Gold, what a big comeback it gave this week itself. And some of those gold-related plays actually did well, namely the gold financiers. Because when they corrected, when gold prices came down, by close to 20-25%, you had all these gold financing companies that came down. The competitive intensity yet is very, very high. You had AB Capital as well that's made their foray into it. But what do you make of this space?
I think this space is interesting, and the opportunity is, of course, huge. The market size is huge. So while, of course, the competition is increasing on one end, but there are enough number of borrowers on the other end. And of course, NBFC to a certain extent has a little bit more advantage compared to banks because the turnaround times are probably much quicker compared to the banks. So I think there are a few large NBFCs which has been in this business for last 2-3 decades. So we prefer to stick to that in case we become positive on gold finance. And the growth is going to remain, I think, significantly higher compared to overall credit growth of the country. So I think it's an interesting space. Of course, one needs to be selective. But, I think the space should do well from here on.
Rajesh, we had a banking transformation summit earlier. And gold loans, of course, we had an NBFC panel on it. So we had L&T and Piramal and others. And gold, of course, came up. And it was actually interesting because, the general view we get is that it's bullish and it's going to be pretty strong. But, one of the Piramal was the one which kind of mentioned they've just entered the gold finance business. And their view essentially was that, it's grown very fast. I think it's up. The size of the industry from 4 lakh crores 3 years back is 21 lakh crores now. And everyone is in it or is getting into it. So profitability will not remain what it was. And some of the top players will eventually go to, single-digit market share like it works in pretty much other segments. I don't know. My question is the best behind? We're looking through the lens of here and now, but this was from an industry player. What's your sense?
I think, gold is basically the secured asset, so definitely it attracts the lenders to do this because it is a collateral backed thing rather than unsecured. And in a collateral backed thing, therefore, the spread has to be lower because it is a more secured business and therefore the credit cost is lesser. So as a lender, what they do is that they look at not only the spreads, the lending rate, but they also look at the likely default and the underlying collateral. And then they adjust it to work it out what should be the lending rate. As the banks entered this space, the lending rates therefore has reduced compared to what it used to be 3 years back. But at the same time, the RBI regulations also became what I would say a level playing field between banks and NBFC. And hence banks have decided to focus more on the gold finance as a business. And therefore, generally speaking, what we do is that rather than focusing on pure gold finance lender, we prefer the institutions who have a gold finance as one of the segment. So that in case if suppose gold finance business goes into say slow mode from 4th gear to 3rd gear, you have other 3 businesses which probably can move from 3rd gear to 2nd gear. And then basically it helps. Having said that, the opportunity size still is large. It is a reasonably large opportunity size. While the size of industry grew, nobody knows the unorganized market. And that's huge. And even today that remains huge. And that's why most of the NBFC or banks or even cooperative banks, urban cooperative banks, rural cooperative banks, everybody is doing this business from so many years, from last probably 15, 20 years. But ability to turn around is very important. Ability to make sure that it doesn't enter into the, the high slippage at some point of time is very important. Yeah. The LTV norms are very important. So I think the rail guards are important in any lending business.
No, absolutely. My point was if you have a specific view on gold finance, but you don't. You like to own a diversified sort of finance player to kind of balance it out in that sense. Rajesh, you like real estate ancillary plays, right? Home building, pipes and that kind of stuff. Just talk to us a little bit about it. I don't think you have a very constructive view on real estate developers, but I think this is the space that you like.
Yeah, so we are cautious on the real estate as a space as far as the developer side goes. And we are more positive on the building material within that overall space. And if you look at total number of registration, the new homes bought and the registration in last 3 years, particularly post-COVID, it has been huge. And all those registrations, it enters into cycle of now actual delivery to your end consumer, end customer. And as that happens, you will see more building material to be consumed. So be it tiles, be it plywood, sanitary ware, and all such ancillary products, including wires, including cables. Therefore, we'll see positive trends for next, I would say, 2 to 3 years, because last 4 years, registration data is huge. Those homes which are got registered in last 4 years is coming up for delivery starting from this year for the next 3 years. Typically, it's a 4 to 6.5 years kind of a, the project cycles, depending upon, of course, the cities and the size of project. So I think, therefore, this segment should do reasonably well over next 2.5, 3 years. Of course, the raw material cost is very important. In case of tiles, for example, the power cost is very important. In case of plywood, the imports from other countries.
Rajesh, in tiles, what do you like? Do you like the leader, Kajaria, or a very small player like Somani? What do you like?
I would not like to give specific name, but I think probably the entire sector will do well. Of course, within that, the top 3 will do better.
Fair enough. Rajesh, now let me take it, zoom out a little bit, right? I mean, from micros to the big worry, which of course we were talking about all week, which is of course the US bond market flashing a bit of a warning signal. And this is basically not, by the way, the the short end of the yield curve in the US, which is 2, 5, 10, etc. But this is the really long end, which is the 30-year yield. Just look at levels, right? 31st December 2025, the yield was 4.84. We closed yesterday at about 5.25, and I think we hit about 5.35 earlier this week, which was the high. Which means for the year, I mean, yields have moved up about 40-odd basis points. This, of course, matters for equities as well, because all calculations, equity calculations to derive DCF, cost of capital, it all comes from long yields, and especially, of course, it flows from the US in that sense. The treasuries in the US have stepped in. They're saying we'll buy more bonds. And of course, that did not work. So you had Treasury Secretary Bessent, who went on CNBC last night, essentially, doing both things, dissing the bond market reaction, saying anything can happen in 24 hours, it's just noise, but at the same time also promising. And that is, I think, why the market is a little unsure what to make of it. It's a sign of, they're trying to comfort, but, comforting, dissing, but also saying, well, promising to act. And this is what they said, Bessent said. They said that by the end of the week or early next week, they will essentially focus on fiscal consolidation, which of course has not happened since January of 2025, when this administration sort of started or took over. Now, all this we know, right? But do these measures work? So why not look at 2 other countries which have used these measures in the past? The most famous example by far is, of course, Japan. Yield curve control was launched in 2016. The aim was to keep yields at 0%. It worked for a number of years. But why did it work? It worked because inflation was 0. Domestic savings were abundant. But in 2022, you had the first signs of inflation starting to come through. And guess what? It became very costly to keep yields under control by buying these bonds, because the balance sheet ballooned, and eventually they had to raise rates, right? Which happened in late 24 or 25. So once inflation returned, it became unsustainable. The second example is Australia. Australia during COVID said, well, we want to cap long end of the yield curve at 0.5% or something. Because, I mean, the assumption was that rates and interest rates will remain zero will remain non-existent for a long time. Again, it worked till the market decided that it's not, which is that inflation came back and growth picked up as well. So in 2023, just 3 years after kind of sort of, committing to controlling the long end of the yield curve, the Australian Central Bank had to abandon the target and basically dropped the idea. The lessons, I mean, there are only 2 examples, but there are, of course, you can look at emerging markets like Turkey, Brazil, etc. They've done this for a number of years. But from the developed market, since we're talking about the US, the lesson is simple that, well, when markets agree with the destination, that there's no inflation, growth is weak, etc., this works. But as soon as inflation starts to come back, and the destination is something different from what the market thinks the end destination is, it does not work. And I think that is the problem in the US's case. It's not a technical problem. The problem is debt. And I think the amount of sovereign debt, which is whatever, $40 trillion or so now. So unless growth weakens materially, inflation falls decisively, or fiscal concerns are kind of go away, I mean, I think, you can do this, you can suppress yields for a while, 5, 10, 15 basis points, but the trajectory has been very clear, as we saw with those examples that I put out earlier as well. So, I mean, that's going to be the big cue, Rima, as we come back to next week as well.
Yeah, there was an interesting discussion on CNBC International whether US government faces the chance of a downgrade. Already the ratings were downgraded, and they said Microsoft actually has a better credit rating than the US government right now. It's only two companies. One is Microsoft and the other one is Johnson & Johnson. But the counter argument is that if earnings continue to deliver, then perhaps from an equity market point of view, it could be okay. We can live with higher.
Equities can be okay. But the point is that, I mean, if growth is so strong, and it is strong, I mean, you cannot keep yields lower. That's the point. Growth has to weaken, and then that subsequently impacts inflation. Inflation goes down, and then yields start to reverse. But you've got the exact opposite trajectory right now. And that is the reason why, I mean, they can buy bonds, and we'll see what happens. I mean, they promised something by the end of the week, which is today, or maybe early next week.
All right, and it matters for AI companies. They're driving growth and they're borrowing in the debt market, so higher yield is going to hurt. Rajesh, you want to quickly comment on the macros? Is that potentially the big risk for the Indian markets out 6 months from here?
No, I think, then that's where the differentiation will start. Just like how US and Japan, the differentiation started, am I right? So ultimately, what one needs to look at is the two things. One is clearly in US, the investors gave government the benefit of the doubt. But today they are demanding a higher price for that trust. So market is no longer asking whether America has too much debt or not. It is started to ask how much longer it can afford it. So the era of cheap, unlimited borrowing may be ending. And that's what basically means. It means higher yield for longer time, particularly in US market. So clearly from global investors' perspective, that's basically warning sign for US. As far as India goes, our inflation and our bond yield is in line with expectations. So we don't need to worry very too much about it.
Right.
But of course, as far as US equity market goes, the earnings growth has been very solid. And it's a 20% growth story in US right now, S&P 500. That's huge. So both equity and debt market, we need to differentiate in US.
Okay, Rajesh, always good to have you on the show. Thanks a lot for giving us your views on the economy, on macros, as well as on various sectors that we did discuss. Well, it's curtains down on this edition of Editors Roundtable. Thanks a lot for watching. Stay tuned. More news and updates coming up on the other side.
Between US and Iranian.
When the market moves, we don't just report, we decode.
From the boardroom to the trading floor, we track what's driving business and impacting investor sentiment.
With insight that empowers and guidance that builds wealth.
Nuvama presents CNBC TV 18 Market Central.
For your daily source of market intelligence and wealth creation, with a commitment to doing it right.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Oil prices on track for a second weekly rise as the stalemate between the US and Iran continues. US Treasury Secretary Bessent warns Iran of toughest sanctions in history. Says details will be shared on Monday. Tehran slams Washington's economic D-Day threat as illegal and inhumane. 2 commercial vessels carrying a total of 22 Indians on board hijacked by pirates in separate incidents off Yemen and Somalia. Government sources say the Indian crew members are safe and standard operating protocols are being carried out. Sensex and Nifty down 0.5% this week. IT stocks lead the decline along with the FMCG and PSU Banks. Rupee remains closer to the 96 mark against the dollar. India's top private banks look overseas to raise funds. HDFC Bank mops up $1.75 billion in the biggest overseas bond raise. ICICI Bank board clears fundraise of up to $5 billion. Government allows duty-free import of raw sugar for the first time in a decade to cool record high prices and brace for surging demand ahead of the festive season. Imports of 10 lakh metric tons under tariff rate quota has been allowed till October. Reports suggest sugar mills have also been advised to advance crushing to improve availability. Nearly 9 out of 10 individual retail traders lost more than 72,000 crore rupees in the futures and options market last fiscal. A SEBI study shows proprietary traders using algorithms raked in nearly 44,500 crore rupees. Colgate-Palmolive names Manish Anandani as the new CEO. Prabha Narasimhan has been promoted to a global role after leading the personal and oral care company for nearly 4 years. India's air passenger traffic drops to 4-month low in July, but Indigo manages to gain market share despite the decline at the expense of Akasa and SpiceJet. Elon Musk quotes India once again for his satellite internet services company Starlink, says it will help less served rural areas. Government rejected an earlier application citing non-conformity with certain features and spectrum bands. Our top story this evening, tensions in West Asia intensifies. White House warns Iran of economic isolation. Negotiations between both countries have not seen any breakthrough since the ceasefire pact came to an end earlier this week. Here are the latest developments. Now, US Treasury Secretary Scott Bessent said that economic measures to isolate Iran will be revealed next week. In an interview with CNBC, Bessent also warned America's allies, and I quote, "You're either with us or against us," end of quote. He added that Washington will use its full might against countries doing business with Iran. US President Donald Trump had earlier echoed a similar sentiment in a social media post. China has responded to Trump's threat. Beijing's foreign ministry has said that US sanctions and pressure would not resolve the conflict and urged relevant parties should take responsible measures through political and diplomatic means. Remember, China accounted for nearly 80% of Iran's oil exports last year. Iran's foreign ministry also issued a statement accusing the US of economic terrorism and crimes against humanity. Meanwhile, Brent crude prices are heading for the second weekly gain. The US military has said it has redirected 67 vessels and disabled 3 in the Strait of Hormuz as of yesterday. According to shipping data from Kepler, 2 vessels have passed through the waterway in the last 24 hours. Here's the US Treasury Secretary Bessent on the economic measures against Iran.
The president last night said that there's more economic pressure coming on Iran. I know you're heavily involved in this and executing this. What can we expect here?
Yeah, you're going to expect, I'll be holding a press conference on Monday to talk about exactly what we're going to do. And again, we have asymmetric information, and I'm not sure why oil has popped up on this, because this, for now, and it is at the president's discretion. If we are doing the maximum economic pressure, then that means that likely there will not be a large-scale kinetic restart. But I would emphasize that is for now. We are going to all of our allies, and this is going to be the greatest coordinated economic isolation in the history of the world. and we are going to them and saying, you are either with us or against us. You want this murderous regime to end. And if you insist on doing business with them, either transferring money, buying their oil, they're doing seaborne ship transfers, then the U.S. Treasury and the U.S. government, they will put its full might and force toward enforcing against you. I see lots of reports that said, oh, well, this has never worked. It does work because we have a combination. It is a 1-2 punch. We have the blockade, and we are going to have the toughest sanctions in history. And I will tell you, this will work. It worked in Venezuela once we put up the blockade. It is working in Cuba right now, and it is going to work in Iran, and we are going to collapse this regime.
Now, 22 Indian nationals are reportedly in the custody of Somali pirates. 2 vessels were hijacked in separate incidents off the coast of Yemen and Somalia. Government sources say all 22 Indian seafarers are currently aboard 2 vessels hijacked by Somali pirates are safe. However, the development come as fresh setback to shipping traffic in the region, which is already disrupted due to the war in Iran. All right, on to the day's market action. The frontline indices closed flat in a muted session, with the Nifty holding above the 24,200 mark. Banking stocks outperformed, while IT stocks snapped their 2-day winning run, dragged lower by negative brokerage reports. Despite today's resilience, the week remained range-bound, with the Nifty and Sensex losing around 0.5% each. More than 13 Nifty stocks ended the week in the red, with IT, FMCG and PSU banks among the biggest drags. Shares of sugar stocks fell in today's trade. This after the government allowed duty-free imports of 1 million tonne of raw sugar till 31st of October. Sugar mills and refiners have been asked to apply for the zero duty tariff rate quota between 21st August and 28th of August. Preference will be given to importers committing to complete imports by 15th of October. The move is aimed at boosting supplies and cooling record sugar prices ahead of the festive season. India's top private banks look overseas to raise funds. HDFC Bank has mopped up $1.75 billion in the biggest overseas bond raise by an Indian bank since the 2008 financial crisis. Meanwhile, ICICI Bank board has cleared fundraise of up to $5 billion. Ritu Singh gets us more on the dollar debt derby.
Well, ICICI Bank is stepping up its overseas borrowing plans, with the board approving a revised limit of up to $5 billion for raising funds in overseas markets through bonds, notes or offshore certificates of deposit. Now, keep in mind, this is just an enabling resolution, which means $5 billion is the outer limit of the raise. So it's not necessary that the bank goes ahead and raises the entire sum. Remember, ICICI Bank has already raised about $750 million through overseas bonds, but the intent is clearly to go big here with this latest resolution. Now, this comes even as HDFC Bank has already raised about $1.75 billion in its largest bond issue by an Indian bank since the global financial crisis. This issue has 2 parts, $500 million of 3-year bonds and $1.25 billion of 5-year bonds. The 3-year bond by HDFC Bank was priced at 88 basis points above the US Treasury, while the 5-year bond was priced at 100 basis points above the comparable rate. Now, this is HDFC Bank's second major overseas borrowing in just over a month, where it had raised about $750 million in July. So HDFC Bank has now raised $2.5 billion in total from overseas markets in just under 2 months. Now, the timing is very critical because RBI's special FCNRB window closes at the end of August, which is a month earlier than originally planned. And under this window, RBI is absorbing the cost of hedging for banks, and that makes it cheaper for them to attract foreign currency deposits from NRIs. So banks are now moving on 2 fronts very quickly. They're raising as much FCNR money from NRIs as possible before the deposit window closes, and they're also tapping overseas markets for foreign currency funding, while the RBI support is available to offer that leverage to their depositors. And with ICICI Bank raising its borrowing limit to $5 billion, HDFC Bank already having done $2.5 billion, expect even more Indian banks to come ahead and tap global markets in the run-up to that special window closing.
Thank you, Ritu, for that. Prabha Narasimhan will be stepping away as Managing Director and CEO of Colgate-Palmolive India after 4 years at the helm on September 27th. She will transition to a global role of Executive Vice President, Marketing for the Asia-Pacific Division. Manish Shanandani will succeed her. He's a Colgate veteran who had worked in the company for 13 years. Tata Motors rolled out a fresh round of price hikes, raising rates by up to 25,000 rupees across its portfolio. This spans both internal combustion and electric vehicles. This marks the automaker's second price correction in just 3 months. The Supreme Court has agreed to urgently hear Maharashtra State Electricity Distribution Company's plea challenging a nearly 600 crore rupee award to JSW Energy. The dispute relates to JSW Energy's Ratnagiri Power Unit and whether directions issued by the Ministry of Power under Section 11 of the Electricity Act applied to it. MSEDCL moved the top court after the appellate tribunal refused to allow the power distributor to seek a review of the award before the Maharashtra Electricity Regulatory Commission. In December 2025, the commission had ordered the Maharashtra Discom to pay 600 crore rupees to JSW Energy in a tariff dispute. Future and options segment remains a deadly cocktail for individual traders. As per a SEBI study, 9 out of 10 retail traders lost money last fiscal. That's not all. Close to 66% of individual traders who remained active in the F&O segment across 5 consecutive years lost money every single year. Hormaz Fatakia joins us now. Hormaz, what are the key takeaways?
Well, SEBI study has 2 messages. One, change is the only constant, and the other one, there are certain things that do not change. The first thing that has changed is the number of active individual traders that has declined in FY26 from 98 lakhs to 78.6 lakh in FY26. This is, of course, the retail participation in the futures and options segment. Even the new entrants in the F&O space has declined by 40% on a year-on-year basis. Now, if you take a look at the aggregate net loss that individual traders made, that has seen a decline from 1.12 lakh crore in FY25 to just under 92,000 crores in FY26. That, of course, needs to be taken into account for the fact that the participation too has come down from last year. This one thing that has not changed, the number of traders who lose money. 9 out of 10 last year, 9 out of 10 this year as well, although the number from 90.9 has gone down to 87.7. But the individual traders making a net loss has also increased from last year, from 1.32 lakh to 1.47 lakh is the average sum that an individual trader has lost in the F&O segment in FY26. So who's making money? Everybody but the individual trader. Proprietary, FPIs, corporates, mutual funds, all of them have made anywhere between 3,000 to as high as 45,000 crore rupees in FY26. But take a look at the individual number. That 72,243 crore is a net loss number, not a net profit, even before you include the transaction costs in this. Now take a look at the expiry concentration as well. Majority of the index options turnover comes on the expiry day. On the same day expiry, that's 59%. A day before the expiry, 75%. And a week before the expiry is where majority of the 97% of the index options turnover comes from. Who is the bigger loss maker between an options trader and a futures trader? The answer is a futures trader. This is the amount of money, of course, that's 2 lakh rupees compared to 1.5 lakh for an options trader. Now take a look at the interesting trends that have emerged here. 2 of them stand out. The age below 30 participants have increased to 43% from 31% in FY22. The standout one is the women traders. 17.1% of the total sum. The loss ratio here is 84.7%, and that is lesser compared to the men. That's the standout here. Now take a look at the traders versus the speculators one. The 35% of the total equity derivatives participants have 0 equity holdings, and 78% of those have equity portfolios less than 1 lakh rupees. Now these small portfolio traders are contributing to 51% of the turnover, and 70% of the losses are also borne by these traders. So they are the ones that are doing the majority of the heavy lifting. Take a look at the transaction costs. In FY26, that stood at 25,000 crore, taking the 4-year sum to 1 lakh crore rupees, and that share of securities transaction tax, which stood at 13% in FY22, has gone up to 27% at the end of last year. Option buyers accounted for a majority of the traders. Yes, they also accounted for a majority of the losses as well. Only 2% of the option sellers, but take a look at the risk of being an option seller. The average loss made by an option seller is 51.5 lakh rupees. Compare that to a major options buyer and a pure options buyer, and that figure ranges anywhere from 1.5 lakh to 4.5 lakh rupees.
All right, thank you, Hormaz, for that. Moving on, Atomberg is the latest consumer appliance maker to tap into India's IPO market. The company has filed draft papers with SEBI for a fresh issue of up to 450 crore rupees and an offer for sale of up to 7.65 crore shares. Now, the company plans to use the funds for debt repayment, brand building and research and development purposes. SpaceX CEO Elon Musk has said that Starlink satellite internet service will help, in his words, the least served in India, especially in rural areas. Musk was responding to a post on social media which claimed that more than 11,200 of India's listed villages still had no 4G coverage. Musk's remarks came a day after Starlink was reported to have reapplied to offer satellite communication services in India. Nearly 40,000 Hyundai motor workers have gone on strike in the company's first full-day walkout in a decade, bringing production to a halt. The workers are demanding higher performance bonuses, reinstatement of dismissed union members, and a higher retirement age after wage talks with the management broke down. Workers from Hyundai affiliate Kia and suppliers are also holding a rally outside the Seoul headquarters. Abbott has agreed to pay $670 million to settle claims involving around 2,000 infants over alleged harms linked to its specialty formula for preterm babies. The lawsuits allege that the formula is linked to a potentially fatal bowel disease. The settlement includes a $495 million payout awarded to a parent in Illinois in 2024. Abbott has not admitted liability and continues to stand by the safety of its products. Around 1,700 lawsuits involving claims on behalf of about 12,700 infants still remain. Right, a quick look at national headlines. Manipur remains tense over demands for implementing a national register of citizens with 1951 as the base year. Several groups have taken to the streets demanding an NRC before the census exercise. Schools and colleges will remain shut till Sunday. Meanwhile, interstate public transport between Imphal and Guwahati has resumed after nearly 3 years. The first services carried 125 passengers from Imphal towards Guwahati, marking a step towards restoring connectivity. Congress MP Rahul Gandhi staged a sit-in outside Delhi's Parliament Street police station demanding an FIR for a 19-year-old pellet gun victim. Gandhi arrived with Sahil Lochab, who was shot with a pellet gun during the July 20th student protest in Jantar Mantar. He began the protest after the police refused to register the complaint. Gandhi sat outside the police station and said he would remain there until the case was formally registered.
जिसमें साफ लिखा है कि इनके शरीर में 200 से ज्यादा छर्रे हैं, आंख में 3 छर्रे हैं, आंख इनकी खो गई है, उस आंख से वो नहीं देख पाएंगे और इनके दिल के पास, बिल्कुल दिल के पास छर्रे हैं जो छुए नहीं जा सकते हैं। दिल्ली पुलिस ने कहा कि हमने छर्रे नहीं चलाए, तो एक ही सवाल है, अगर आपने नहीं चलाए तो किसी ने तो ये छर्रे चलाए होंगे।
Workers of the Cockroach Janata Party were attacked in Rajasthan's Jaipur and stopped from entering a government school. CJP leaders alleged the BJP was behind the attack. The BJP has denied the charges. The CJP has been touring schools across the country to address issues faced by the students and raise awareness. The centre has denied clearance for Telangana Chief Minister Revanth Reddy's US visit. He is currently in London and was planning to visit US to explore education and skilling partnerships with top universities. As per Reddy's office, the Ministry of External Affairs said clearance from political angle is denied. He will now return from London to Hyderabad on August 23rd instead of flying to Boston. The Telangana CM has directed officials to continue their trip and finalize MOUs with Harvard, MIT and other institutions. India's air travel boom may be losing altitude. Domestic passenger traffic hit a 4-year low in July, falling nearly 5% year-on-year. Indigo managed to gain market share despite the decline at the expense of Akasa and SpiceJet. Madhiya Mujawar joins us to explain what's behind the numbers.
Well, passenger traffic has declined to a 4-year low for July, and while July is traditionally considered a slower travel month, this is still a 4.8% decline year-on-year, with domestic airlines carrying 120 lakh passengers compared with 126 lakh passengers a year ago, and the slowdown is visible in the broader numbers too. For the January-July period, domestic passenger traffic grew just 0.6% year-on-year. So what exactly is happening in Indian aviation? Interestingly, while the overall market has slowed, Indigo has gained market share. Its share rose from 66.3% in June to 67.4% in July. Air India Group also edged up marginally, while Akasa and SpiceJet lost market share. But this is where the numbers need some unpacking. Indigo didn't gain because it carried more passengers. In fact, its traffic fell, the passenger load fell 9.4% month on month. But look at the decline across other players. Air India Group saw 10.8% decline, Akasa fell 22.8%, and SpiceJet saw traffic drop almost 29%. So Indigo gaining share because its traffic declined less sharply than several of its competitors, and that points to the bigger trend. This is not just a demand slowdown. Airlines are also recalibrating capacity. Data by aviation analytics firm OAG shows that Indian airline capacity has contracted 1.5% in August, with domestic capacity down 0.6% and international capacity down 3.3%. So we are seeing slower passenger growth and capacity rationalization at the same time, and that is leading to an increasingly concentrated market, with Indigo strengthening its dominance, Air India Group holding relatively steady, while smaller carriers losing share. Now, against this backdrop, Indigo is looking well beyond the domestic market. At his first AGM as Indigo CEO, Willie Walsh said that international capacity could account for around 40% of the airline's overall capacity by financial year 30. He also called the Airbus A350 induction that is coming up the single biggest milestone for Indigo over the next 5 years. As the airline looks to build a profitable long-haul network and safety and fitness for duty, Walsh said that Indigo conducts 100% pre-flight alcohol checks at Indian airports. So while substance testing is done at induction level and randomly thereafter, with random testing routinely reaching around 20%. So domestic share may be entering a slower phase, but Indigo is using its scale and market leadership at home to make a much bigger international play.
All right, thank you for that comprehensive update, Madiha. With that, it's a wrap on this edition of 360. But before we go, we'll tell you another update about Indigo that remains the dominant player in India's aviation market. The airline has run into another tech glitch. Indigo's website and app faced issues today, with passengers unable to book flights and complete a web check-in. This is the second such outage for Indigo this week after a similar glitch on Wednesday. And with that, it's a wrap on this edition of Business 360. News and updates continue right here on CNBC TV.
Mr. Tiwari, Mr. Chandra, Rajiv and Mr. Agarwal, thank you very much for joining us at the Banking Summit. This is quite clearly a very, very important panel because we are in the contours of a changing banking system. The way in which people are saving has changed. More and more people have become investors. But before I come to that dreary question, just because of the changed notification we got a few days back, Mr. Tiwari, are you very angry with the Reserve Bank because they shut the FCNRB? Mr. Murmu has left. That's why I'm boldly asking you.
This is a recorded telecast event, so I would leave it at that.
No, but did it come as a surprise, and will that change your plans?
Not really, because we had
you're the biggest.
No, we had an internal target, and we are close to achieving that. So I don't think we were really too much perturbed by the stoppage. This was under discussion that if the flows are really strong, then maybe an early call can be taken, which is what he was alluding to. That's a dynamic situation. So for us, it has not made a material difference. We'll still achieve the target which we had set.
Okay, so what do you think may be the full amount by August 31st? There were about 17 days after the announcement of the advancing of the deadline. We did 52. You think the pace looks like we may hit 70? Because with each passing deadline, it seemed to pick speed.
Yeah, it might, because the flow has been really strong in the last 15 days and more. So therefore, the number you talk about may be achieved, but I'm really not sure about the pipeline with different banks. We know our number, but surely other banks, I can't hazard a guess.
Fair point, sir. Rajiv, do you think this makes for better margins for the banking system? Because this, steady deposit is now there with you all. And for some banks, it may be a little cheaper. I don't know how it is. But will FCNR be a reason for easier margins?
I think, one of the messages that we got when we met RBI was that we're doing this for the nation, and this is not really about, making more money. Okay. But let's work hard to, get the dollars in from a national perspective. But having said that, I think there is dispensations on CRR, there's dispensations on SLR, and also dispensations on the lending side from a PSL perspective.
Yes.
Put it all together, it makes a very compelling proposition for all banks.
Okay, fair enough. Mr. Chandra, would you say that loan growth and margins can be helped? You've got more to lend. You've got a steady money, 3-year or 5-year, which you didn't have. Term deposits were not coming. So should we expect both loan growth and margins to help?
Yeah, to a great extent, definitely towards the deposit side. Definitely it is going to ease the cost of deposit, no doubt about it. Because one is that interest rate with what cost of deposit was coming. And second is the CRR, SLR exemption which has come. So definitely the cost of deposit because of this inflow which has come in the system, I think it will be reduced. Now, once that money has come, definitely it is going to be utilized for the lending purpose. So to that extent, I think credit growth is also going to happen in the system. So from both the angles, the deposit side and the lending side, definitely all the financial institutions are going to be benefited about that.
Sanjay, you want to add to that? You think if you started the year, you gave a guidance of some number, it can be increased by 1 or 2 percentage points because this is quite a bit, 70 billion if it is.
I think, Lata, this is all for big daddies, We being a bank, small finance bank, we were not playing this game at all.
You have become an adolescent now.
No, I know you asked this question to Sir, but we didn't play this game at all because being an SFB, it was difficult for us to get the guarantees on board and all those things.
Sanjay, but the ecosystem has more money.
I know the SBIs and the PNBs should grow more because of that money.
No, I mean...
I'll just add a couple of things. See, margin-wise, it's neutral. Because there is a...
neutral?
Neutral in the sense that there's a lesser margin on the deposit itself because what we are paying on that. But it is balanced, as Rajiv explained, by the CRR, SLR and PSL. The important thing is liquidity. So this is in turn replacing those high-cost bulk deposits and all. So overall, it should be good for the banking system.
No, it also makes you all more competitive vis-a-vis the bond market. bond market is running away with the price of crude and the US yields. So that's why I was asking whether you're at a better position.
I think for us, what we are betting on is this, that SBIs will not raise money, more costly money, and indirectly, to help us, and so if big daddies are safe, they are having a lot of money, so the people like us will take rest and can do our business.
I know a few foreign banks are lending to a lot of other smaller banks, so...
But maybe not us, sir.
I'm missing a foreign banker here.
No, one important aspect, in fact, that also we should look into that. This entire activity has brought a lot of foreign investors into picture now. Now you have seen almost all the leading banks, public sector banks I'm talking about, they went to the overseas market, they have raised the dollar bond, they have raised the overseas lending. I think to that extent, that much exposure has gone to the world. And I have seen that a lot of foreign banks, they have shown a lot of interest in participating in that, whether it is the dollar bond or the overseas lending. So to that extent, the market has become very, very wide. And we were able to expose ourselves to the world platform now. I will talk about Punjab National Bank. For the last almost many years, 20 years, we had not gone to overseas to raise the fund.
What may you end up, 31st August?
See, we had given the commitment and we were very firm in the very beginning, around 2 to 2.5 billion. And we are still holding to that position and we are going to cross that here.
Okay, and after that you will go for an OFCB?
Yeah, in fact, we have already initiated the process. We have already filed to the SEBI also that we are going to raise MTN, $500 million. And 500 plus 500 green shoe is also there. And that somewhere between 10th to 15th of September, we are going to do that. And we have already raised 1 billion foreign lending through the syndication. And that too, we went to the Taiwan market, where many Taiwanese bank, Japanese bank, and Korean bank, they participated. And very successfully, $1 billion we raised and plus 500 green shoe also. So to that extent, the market has become very wide. And all the public sector banks, we were able to expose our presence to showcase the Indian growth story. See, if the public sector banks are able to raise that much fund in the Indian market, it shows the resilience and the strength of the Indian economy.
Of course. No two ways about that. People were willing to take exposure to Indian banks. So the end amount will be much more than 70 billion if there are going to be OFCBs following. Will you all do more?
That, of course, was always the additional amount. So the ECBs and other things are being raised. And people have preponed that decision to take advantage of this window. So that obviously will be an additional number.
Okay. Rajiv, will you all also do that? Going to the global market?
There are three pieces within the FCNR puzzle, so to speak. One is the plain vanilla retail money. I think currently the rates that are being offered by all Indian banks is very attractive. And, even for us, we're seeing a good inflow into plain vanilla retail money.
Attractive for the depositor?
As a depositor. Then there is leverage that we are providing through from our balance sheet. And obviously, that has, we've been able to get funding through, through bilateral transactions. But Mr. Tiwari mentioned some foreign banks are lending. Yes, they have lent, to us as well. And the third piece is where we are working with partner banks as well. So there is good traction on all three platforms. Our overall market share on the FCNRB is around 3%. And so therefore we think that we should be getting, whatever that number is, we should get about 3% of that.
Okay, let me come to the other thing that has just hit us. The fact that banks now will be compensated somewhat for some UPI payments. P2M, as they say, payments to merchants. Rajiv, what is in your mind in terms of how much? Will it be 30 basis? It will be less than debit card, we were told. If it is as much as a debit card, what are your best guesses in terms of the split and the amount?
No, first let's split the transactions. P2P is out.
Yes.
P2M up to 2,000, 2,500 rupees, that's out.
They haven't said
right?
so,
and then,
but
so
we are
therefore
assuming.
it is really the higher value transactions that we could effectively get paid on. And I think if you look at the credit card business, the classic four-party model, there is an acquiring bank, there's an issuing bank, there's a customer in between, and there is a network. There the customer pays, and that income is split between the acquiring side, issuing side, and the network. We will come up with a model of a similar nature for that chunk of P2M that could potentially get paid. I think you don't want to kill the goose at the same angle as well, and so therefore that amount has to be. The good thing is that the habit formation has happened. That more and more transactions are going through UPI. That habit formation has happened. The ability of the merchant to absorb 15, 20, 25 basis points, I think certainly exists, because you have to also see it relative to the cost of cash.
Yeah.
It's not as if cash transactions are free.
No,
there is the risk of it sitting in the store. There is a cost by the time you deposit it in the branch, etc., etc. And so therefore all merchants will look at it relative to that as well. So I would imagine 20-25 basis points.
Okay, overall it'll be charged about 20.
And that would be split between the acquiring, issuing, and the network.
The banks may get a third or half of it. How much is the system paying actually for it? Either of you, since you all are the bigger banks, is the system paying 10,000 crores at the moment?
I think it is a substantial amount. And see, it is not like we are paying or we are reimbursing. It is basically the architecture and the infrastructure which the banks have created. That is the thing it is now.
So you think it will become a no profit, no loss for you all at least once the payment starts?
As of now, we are already doing it without any charging anything.
Now you're paying for it.
So we have already created the infrastructure. Let us wait and see. I think DG has also told that RBI, NPCI and the government, I think all three are engaged in that particular activity. So let us wait and see that how it pans out and what is the final outcome it comes now. So I will be still holding to that position.
Okay.
That let it come from the other side now.
let me come to the other question, which, was the heart of this, contours of banking. Mr. Murmu laughed it away when I said that deposits have become hard to come by. As recently as April and May, deposit growth was in single digits. It was actually 9% as recently as March and April. It becomes 10 only in April, and it is, inching towards 14, 15 only now. It may dissipate as soon as the FCNR flow ends. So what would your ask be? I mean, how do you structurally solve this problem of deposits growing slower than credit?
So you're right on the structural part. The shift from saving to investment has started happening, and it's gaining momentum. So I don't think there's going to be a go back to deposits. It's not going to be there. In fact, in the PSB conference which we had, this is one of the themes. And there's so many deliberations took place. All the numbers definitely point. I mean, we just look at the mutual fund number. I'm not even talking about stock market. From 2020 to 2025, the mutual fund AUM has tripled, 25 trillion to 82 trillion. And therefore, the deposit growth has slackened. There's no denying that fact. So what is to be done now? So my sense is that we have to now look at innovative solutions. It's no longer walk-in deposits, which we used to have, or this thing. So one thing is, I mean, some of the deliberations which we did, youth was, of course, one of the things. That today what happens is, while we may open some youngster's account, the parent will fund it or may under guardianship, and then subsequently we may give a scholarship or some later on a loan. After that, there's a break. Very few of us actually follow that journey through to the job and to the future and all. Now, such segments now, and somebody talked about the self-help group, Mr. Murmu talked about that. Now, again, we have only limited to that particular product of the loan, and maybe whatever related deposits. We don't look at each individual and say that, okay, what is their journey here? So each of these segments, whether it is women or youth or entrepreneurs, we'll have to look at the whole journey, lifestyle journey. That's one. Secondly, on enterprises, today we are talking about ecosystem. But again, it cannot be just a loan product or an insurance product alongside. It has to be the full spectrum, including deposits. So deposits will be a byproduct of multiple things. Transaction banking, which private sector banks have done very, very well. Now all the PSBs, public sector banks, are also very strong, and any current account will be a derivative of transaction banking. It cannot be a standalone current account. It's very hard. So one is that we have to be more nuanced about all these things. Second is that while we'll do all this, clearly there is a case that we look at alternate funding mechanisms. So some of them have already started happening, case in point being the infrastructure bonds. Now on the face of it, looks like 7%, whatever plus is a high rate for a 15-year period. But we have to remember that that we always had an asset liability mismatch issue. The average deposit tenors for 3 years, whereas the loans could be 10 years.
So infra bonds will go up, you're saying?
Infra bond is one instrument, which it's a very good instrument. So why not? Secondly, the other things are I'm not talking about 81, 82 bonds, but there are instruments which have been very sparingly used. Now banks are getting into CDs and CPs and all, but they've been there. NBFCs are very strong users. So that will be a short-term usage. Then we have the securitization. There are some challenges on the regulation side and etc., yield side. But clearly a 30 lakh crore of housing loan book sitting there.
It's not securitized.
It's not securitized. There's no cash available against that. Similarly, a vehicle loan book of almost 10 lakh crores. So huge amounts of bank books are available for securitization. I think this is a market which is going
There is no regulatory worry or ask.
No worry. There are some fine-tunings required, which we are now taking up. And then we have to look at the other available instruments. So I guess it's going to be a mix of targeted deposit taking and end-to-end life cycle management, then also on the alternate funding mechanisms which are there, and a whole mix of all this. It has to be hard work now. This problem is no longer easy that people will just come on their own and you just pay them a little higher interest and they will come. No, that time is gone.
Our parents saved entirely on term deposits. And we don't. We serve mutual funds. Out of time, sir, but any quick ask from the Reserve Bank on the deposit front? They are freed for bulk deposits. You'll have some freedom to
in fact,
charge.
In fact, that was already there in the system. The differentiated bulk deposit interest rates, already it was there. What RBI has done it that they have made it very transparent, and they have given a timeline that earlier what was happening, and now also it is happening, that bulk deposit rates throughout the day up to 12 o'clock, 1 p.m. also, every bank used to prescribe that, depending upon what is the inflow that is going to come. Now RBI, what is asking is that by 10 o'clock, you have to prescribe your bulk deposit rate. They are giving a cushion for another 10 minutes. So by 10:10, all the banks, they have to declare their bulk deposit rate, and throughout the day, whosoever comes within that bracket, that has to be given to that rate to that individual or the corporates.
Okay.
So basically the transparency has come. In fact, the deposit side, what Mr. Tiwari was also mentioning, see, three things are required to be done in the system. One is, especially I'm talking about the public sector, because leading private sector banks, they have already in place the relationship manager concept or the wealth manager concept, but many of the public sector banks having millions of customers, but this wealth management concept, or to a great extent the relationship manager concept, that is missing now. So now the time has come when the deposit is migrating towards the capital market. I think we should have a very, very strong system in place. So that is one thing which I think all the leading public sector banks, they have to do it. Second is the infra bond or the green bond. I think definitely that is one route we need to move upon. And instead of just harping on the deposit, that is one thing. Third aspect, again, after seeing the global market, there is a very good opportunity to raise the MTN and the dollar bond or the overseas lending, and all these things, I think they should supplement to the deposit side.
Fair enough, fair enough. I am being asked to wind up, so let me just end up with a rapid fire. All of you, one number. Rajiv, what do you think is the credit growth likelihood this year? Will it be better than this 18%?
We think that there'll be a little bit of a slowdown from here, so maybe somewhere between 16 to 18%.
Okay. Mr.
16% roughly.
No, the question to you was, will margins be better?
Oh, sorry.
Better. I'm only asking for monosyllables.
Margins will always be under pressure, and India anyway higher margins than many other countries.
Oh,
so I don't think margins are going to improve tremendously. Might be a small blip up, but longer run they'll be always come down.
Okay. Mr. Tiwari, Mr. Chandra, I want to ask you whether bad loans will climb up a bit. There is El Nino pressure and there is higher raw material cost for SMEs. Many SMEs tell us packaging material is expensive, etc. So is the best over?
No, I will not subscribe to that. It is more hyped, I will tell you.
Okay.
And
just a monosyllabic, they are yelling at me.
No, it is basically you see the numbers, and numbers are speaking now.
So
you see the Q4 number or the Q1 number of this financial year.
Yours was good.
Not PNB I'm talking about. I'm talking about the banking in general, all public sector and private sector. Best SMA percentage and the best GNPA
so
and
no
net
danger
NPA.
of...
As of now, no danger at all. And all of us are ready to meet all the challenges, even if it comes. See, we were talking about the El Nino, but so much rain has come to the different parts of the country.
Okay, I'm sorry,
so we need to be very positive about things now.
Same question to you. Slight uptick, possible?
Yeah, so I think I'm echoing this as view that this is one of the best time, and I strongly believe anything plus 16% is the number which
is the growth that you're looking at. Thank you very much. You all leave us very optimistic. You're not complaining about deposits as much as perhaps the onlookers and the experts are complaining. Thank you very much, Rajiv, Mr. Tiwari, Mr. Chandra, and Sanjay.
Thank you so much.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Oil prices on track for a second weekly rise as the stalemate between the US and Iran continues. US Treasury Secretary Bessent warns Iran of toughest sanctions in history. Says details will be shared on Monday. Tehran slams Washington's economic D-Day threat as illegal and inhumane. Two commercial vessels carrying a total of 22 Indians on board hijacked by pirates in separate incidents off Yemen and Somalia. Government sources say the Indian crew members are safe and standard operating protocols are being carried out. Sensex and Nifty down 0.5% this week. IT stocks lead the decline along with the FMCG and PSU Bank. Rupee remains closer to the 96 mark against the dollar. India's top private banks look overseas to raise funds. HDFC Bank mops up $1.75 billion in the biggest overseas bond raise. ICICI Bank board clears fundraise of up to $5 billion. Government allows duty-free import of raw sugar for the first time in a decade to cool record high prices and brace for surging demand ahead of the festive season. Imports of 10 lakh metric tons under tariff rate quota has been allowed till October. Reports suggest sugar mills have also been advised to advance crushing to improve availability. Nearly 9 out of 10 individual retail traders lost more than 72,000 crore rupees in the futures and options market last fiscal. A SEBI study shows proprietary traders using algorithms raked in nearly 44,500 crore rupees. Colgate-Palmolive names Manish Anandani as the new CEO. Prabha Narasimhan has been promoted to a global role after leading the personal and oral care company for nearly 4 years. India's air passenger traffic drops to 4-month low in July, but Indigo manages to gain market share despite the decline at the expense of Akasa and SpiceJet. Elon Musk quotes India once again for his satellite internet services company Starlink, says it will help less served rural areas. Government rejected an earlier application citing non-conformity with certain features and spectrum bands. Our top story this evening, tensions in West Asia intensifies. White House warns Iran of economic isolation. Negotiations between both countries have not seen any breakthrough since the ceasefire pact came to an end earlier this week. Here are the latest developments. Now, US Treasury Secretary Scott Bessent said that economic measures to isolate Iran will be revealed next week. In an interview with CNBC, Bessent also warned America's allies, and I quote, "You're either with us or against us," end of quote. He added that Washington will use its full might against countries doing business with Iran. US President Donald Trump had earlier echoed a similar sentiment in a social media post. China has responded to Trump's threat. Beijing's foreign ministry has said that US sanctions and pressure would not resolve the conflict and urged relevant parties should take responsible measures through political and diplomatic means. Remember, China accounted for nearly 80% of Iran's oil exports last year. Iran's foreign ministry also issued a statement accusing the US of economic terrorism and crimes against humanity. Meanwhile, Brent crude prices are heading for the second weekly gain. The US military has said it has redirected 67 vessels and disabled 3 in the Strait of Hormuz as of yesterday. According to shipping data from Kepler, 2 vessels have passed through the waterway in the last 24 hours. Here's the US Treasury Secretary Bessent on the economic measures against Iran.
The president last night said that there's more economic pressure coming on Iran. I know you're heavily involved in this and executing this. What can we expect here?
Yeah, you're going to expect, I'll be holding a press conference on Monday to talk about exactly what we're going to do. And again, we have asymmetric information, and I'm not sure why oil has popped up on this, because this, for now, and it is at the president's discretion. If we are doing the maximum economic pressure, then that means that likely there will not be a large-scale kinetic restart. But I would emphasize that is for now. We are going to all of our allies, and this is going to be the greatest coordinated economic isolation in the history of the world. And we are going to them and saying, you are either with us or against us. You want this murderous regime to end. And if you insist on doing business with them, either transferring money, buying their oil, they're doing seaborne ship transfers, then the U.S. Treasury and the U.S. government they will put its full might and force toward enforcing against you. I see lots of reports that said, oh, well, this has never worked. It does work because we have a combination. It is a 1-2 punch. We have the blockade, and we are going to have the toughest sanctions in history. And I will tell you, this will work. It worked in Venezuela once we put up the blockade. It is working in Cuba right now, and it is going to work in Iran, and we are going to collapse this regime.
Now, 22 Indian nationals are reportedly in the custody of Somali pirates. 2 vessels were hijacked in separate incidents off the coast of Yemen and Somalia. Government sources say all 22 Indian seafarers are currently aboard 2 vessels hijacked by Somali pirates are safe. However, the development come as fresh setback to shipping traffic in the region, which is already disrupted due to the war in Iran. All right, on to the day's market action. The frontline indices closed flat in a muted session, with the Nifty holding above the 24,200 mark. Banking stocks outperformed, while IT stocks snapped their 2-day winning run, dragged lower by negative brokerage reports. Despite today's resilience, the week remained range-bound, with the Nifty and Sensex losing around 0.5% each. More than 13 Nifty stocks ended the week in the red, with IT, FMCG and PSU Banks among the biggest drags. Shares of sugar stocks fell in today's trade. This after the government allowed duty-free imports of 1 million tonne of raw sugar till 31st of October. Sugar mills and refiners have been asked to apply for the zero-duty tariff rate quota between 21st August and 28th of August. Preference will be given to importers committing to complete imports by 15th of October. The move is aimed at boosting supplies and cooling record sugar prices ahead of the festive season. India's top private banks look overseas to raise funds. HDFC Bank has mopped up $1.75 billion in the biggest overseas bond raise by an Indian bank since the 2008 financial crisis. Meanwhile, ICICI Bank board has cleared fundraise of up to $5 billion. Ritu Singh gets us more on the dollar debt derby.
Well, ICICI Bank is stepping up its overseas borrowing plans, with the board approving a revised limit of up to $5 billion for raising funds in overseas markets through bonds, notes or offshore certificates of deposit. Now, keep in mind, this is just an enabling resolution, which means $5 billion is the outer limit of the raise, so it's not necessary that the bank goes ahead and raises the entire sum. Remember, ICICI Bank has already raised about $750 million through overseas bonds, but the intent is clearly to go big here with this latest resolution. Now, this comes even as HDFC Bank has already raised about $1.75 billion in its largest bond issue by an Indian bank since the global financial crisis. This issue has 2 parts, $500 million of 3-year bonds and $1.25 billion of 5-year bonds. The 3-year bond by HDFC Bank was priced at 88 basis points above the US Treasury, while the 5-year bond was priced at 100 basis points above the comparable rate. Now, this is HDFC Bank's second major overseas borrowing in just over a month, where it had raised about $750 million in July. So HDFC Bank has now raised $2.5 billion in total from overseas markets in just under 2 months. Now, the timing is very critical because RBI's special FCNRB window closes at the end of August, which is a month earlier than originally planned. And under this window, RBI is absorbing the cost of hedging for banks, and that makes it cheaper for them to attract foreign currency deposits from NRIs. So banks are now moving on 2 fronts very quickly. They're raising as much FCNR money from NRIs as possible before the deposit window closes, and they're also tapping overseas markets for foreign currency funding, while the RBI support is available to offer that leverage to their depositors. And with ICICI Bank raising its borrowing limit to $5 billion, HDFC Bank already having done $2.5 billion, expect even more Indian banks to come ahead and tap global markets in the run-up to that special window closing.
Thank you, Ritu, for that. Prabha Narasimhan will be stepping away as Managing Director and CEO of Colgate-Palmolive India after 4 years at the helm on September 27th. She will transition to a global role of Executive Vice President, Marketing for the Asia-Pacific Division. Manish Shanandani will succeed her. He's a Colgate veteran who had worked in the company for 13 years. Tata Motors rolled out a fresh round of price hikes, raising rates by up to 25,000 rupees across its portfolio. This spans both internal combustion and electric vehicles. This marks the automaker's second price correction in just 3 months. The Supreme Court has agreed to urgently hear Maharashtra State Electricity Distribution Company's plea challenging a nearly 600 crore rupee award to JSW Energy. The dispute relates to JSW Energy's Ratnagiri Power Unit and whether directions issued by the Ministry of Power under Section 11 of the Electricity Act applied to it. MSEDCL moved to top court after the appellate tribunal refused to allow the power distributor to seek a review of the award before the Maharashtra Electricity Regulatory Commission. In December 2025, the commission had ordered the Maharashtra Discom to pay 600 crore rupees to JSW Energy in a tariff dispute. Future and options segment remains a deadly cocktail for individual traders. As per a SEBI study, 9 out of 10 retail traders lost money last fiscal. That's not all. Close to 66% of individual traders who remained active in the F&O segment across 5 consecutive years lost money every single year. All right, time for a short break. When we return, the government has notified a new tranche of the production-linked incentive scheme for mobile phone manufacturing. More details in a bit. Stay tuned.
CNBC TV 18 tracks the pulse of markets and business in real time, bringing you the stories that shape the economy.
From breaking news to sharp analysis, we deliver insights that help you navigate businesses, markets, and investment opportunities.
Novama presents CNBC TV 18 Market Central.
Providing sharp market intelligence for wealth creation with a commitment to doing it right.
Welcome back. The government officially announcing the launch of the mobile phone manufacturing scheme happened only moments back, and this will be the big scheme, the big flagship scheme that the government is betting on to take the manufacturing journey as far as mobiles are concerned, taking it to the next level. Now, bear in mind the mobile PLI, that's phase one, ended in March of 2026. Now, this scheme, the MPMS now takes over from the 1st of April. It will be eligible. It will be available for a duration of 5 years, beginning with this fiscal year, the current fiscal year, FY27. Now, what's important is that in a marked shift from the phase one, this mobile manufacturing scheme, what it seeks to do is to go and push on two counts. Number one, of course, increasing the domestic production as far as manufacturing is concerned. But number two, importantly, also on building a national champion, a domestic brand. In fact, we heard from the minister not very long back who said that there is a very clear push and that the ministry, the government, is already in conversation with as many as 3 players to, in fact, build on a national champion. We've seen manufacturing, Apple doing it here, Samsung doing it here. No national champions. The government wants to fill that gap. In terms of building manufacturing expertise, well, the incentives now are graded. It's not a one-stop shop. It's a graded incentive program that's available, 2.25% to 5%, depending on what the incremental sales are. That's, of course, something that the companies will have to establish. And then subsequently, there are additional incentives for number one, local sourcing, 1.5%, and additional incentive if the IP is Indian and the R&D is here in India. So that's the broad thrust that the government is looking to give. In fact, for more on that, let's go across and listen in to the minister himself, Mr. Ashwini Vaishnav.
Segments which are economy segments, then there are premium segments, then there are super premium, then there is a very high value mobile phone. So there are basically 4 segments normally seen in the smartphone. We are asking the industry which segment you would be comfortable with. Their point is that we would like to play in a segment which has very high volume, because once we have the volume, then we can really have a sustained play, sustained production and a sustained market going forward. So the industry has to now take the final call.
Well, for more on this, we're now joined by Pankaj Mahindra, the chairman of the ICAA. Mr. Mahindra, thank you so much for joining us. My first question to you, the government this time around has a graded incentive program. There's 2.25% if you have lower sales, and then 5% if you qualify that bar and you reach higher sales. Is this geared towards perhaps pushing for greater exports? Again, we are seeing flat smartphone sales in India. So one imagines that to realize these kind of numbers, to get the 5% benefit, the companies will have to export.
See, even PLI 1.0 was primarily because by 2019-20, we had completed, almost saturated the domestic market. So the PLI 1.0 was, indirectly focusing on global scale. And so a very large portion of that we exported. PLI 1.0, we touched a manufacturing of about 22 lakh crores at merely a cost of less than 20,000 crores. So less than 1%. And it has become a truly global size industry with output of $71 billion plus. So that has created the scale. Because we are such a large exporter now, obviously the scheme has a greater focus on further building scale. The domestic market has been quite slow. So there will be a very large part of this will be for export.
Sure. My next question to you again, and this is a follow-up to the very first question, that if you are looking for an export push that is subsidized by the government to some extent, do you think that could run into some tariff troubles, some WTO troubles going forward?
Not at all. The export push is not at all supported by the government. This is a, production-linked incentive, right? And it is, it can be both sides. It is to lift the domestic production up. You could have a situation in which domestic demand shoots up. And that can also happen during the course of these 5 years. And we expect that domestic demand will improve Because if you remember, China peaked at about 390 million smartphones annually, and we are at 150 million annual for the last 3-4 years. So you'll have a spike. It may happen in 28. It may happen in 29. It could happen earlier. So that spike will happen. So it is both domestic and this thing. But the structure of the industry is such now that people are exporting out of India because of the. It is proved that we are one of the finest manufacturing nations of the world.
Sure. Sure. We're just running out of time, Mr. Mahindra. Quick 30 seconds to you. Big focus on building a national champion. Do you see it coming from the current bouquet of players, or do you see a new player emerging? The minister says mid of 2027, expect an Indian brand.
That's a very hard road because the industry, the global industry, is divided between 5-6 players or 4-5 players. And we are very determined to have national champions emerging out of India in not only mobile phones, but in other categories also. So that's a big effort, but it cannot be just, superficial brand. It has to be a brand or brands deeply invested in R&D, in, technology, in building the entire ecosystem, and the ecosystem helping the domestic brands. It's a very hard road and a very challenging task. But you have seen the magic which this industry has done with the support of the government. So we have taken up that challenge, and we will deliver something good to the nation.
Well, the government has set very tall targets. I'd like to thank Mr. Mahindra for joining us for his valuable time as well as insights. But let's continue with this discussion. We also have with us Mr. Ashok Chandak, the president of ISA. Mr. Chandak, thank you so much for joining us. I'll just carry on that theme with you as well. National champions, the government is very firm that the government wants the IP to rest here, to the R&D to be done here. It wants the product to be cost effective and also to be competitive with the best in the business. Do we have that competency in India by mid of 2027 to come out with an Indian brand to compete with the best in the world?
My view is this is a very strategic way ministry has made this plan, and we're at the right time actually. If we had attempted this, let's say 3 or 5 years ago, I would say no chance. Now, what we have to look at is basically there are multiple, based on today's announcement, detailing have been provided for this mobile phone manufacturing scheme. But I want to relate to answer your question. We have to look at multiple schemes those government have announced recently. MPMS, then ECMS, electronic components, 40,000 crore, plus the semiconductor related scheme, Semicon 2.0. So to me, these three things, when we look in tandem, together, what we are looking at is a positive spiral of a free will, in which now not only the champions have to be created, but they would need an ecosystem, they would need additional components in India, which they can use in a design. So the ECMS schemes will provide camera module, multi-layer PCBs, mechanics, cells, capital goods, etc., including tooling. While the MPMS scheme, the mobile phone would provide the high volume assembly related and global value chain related incentives, plus the Semicon India program, which is also focusing on to the ATMPs, OSATs, that will help to provide the semiconductor components. Those are required into the mobile phone, which are imported today. Plus also the design link incentive, which is part of Semicon 2.0, would help to create some kind of a chip designs. So overall, once you look at all these things together, we are in a much
clearly something that is the government's focus right now. We've seen the notification for the MPMS. We are awaiting the notification for ISM 2.0 as well. But coming back to mobile manufacturing, Mr. Chandak, I just want to get some insight. We have the electronic component scheme running in parallel. We now have the mobile phone manufacturing scheme. What is the quantum of value addition that India can target by the end of this 5-year period? Currently, it's at 23%. What is the value addition that India should be targeting?
India should be targeting all schemes put together 35 to 40% of the domestic value addition. And the beauty of these schemes, based on also the incentives those have been defined, are encouraging those local value additions, including the local design elements over here.
One final question to you, Mr. Chandak, that in terms of the targets that the government has set, 39 lakh crore rupees, that's the target for total production, aggregate production. Just a two-part question, running out of time. One, do you see that coming from exports? And two, can those targets be met easily by the momentum that the industry has generated?
My view is it is feasible. We have seen the very unprecedented growth in a mobile sector particularly. And we are also doing exports. Obviously, we see the numbers already. My view is the numbers would be met provided we continue to focus on both the domestic demand, which is already healthy, plus the export potential of not only two brands which are doing right now, but maybe more brands to come over here in India. And there are already news items that some of the companies are looking at beyond China model actually.
Right.
So my view is it is not difficult. It is definitely doable, and it is also going to get into more competitive based on the schemes which we talked about.
Right, Mr. Chandak. So the government saying that, look, we've done our bit. We've given you the incentive program, now over to the private sector. I'd like to thank both of our guests for joining us, Mr. Mahindra as well as Mr. Chandak. Thank you so much for being a part of this conversation. But that, unfortunately, is all the time that we have. Stay tuned to CNBC TV 18. The news and updates will continue right here.
Revealed that
Hello and welcome to this edition of Editor's Playbook. I'm Shireen Bhanas. Gen Z would say no cap. From healthcare to aviation to insurance, several sectors are staring at sweeping regulatory changes. Their entire business model could be threatened with just a stroke of a pen. Now, a parliamentary panel wants to impose limits on healthcare costs, including room rents and surgical procedures. While the move may be well-intentioned, is the price cap the right remedy? Will it scare away investors in a country that desperately needs more hospital beds and better infrastructure? Now, top hospital operators believe price caps will not solve the affordability problem and may in fact make it worse by hampering expansion plans. This view is prevalent across sectors. The government is also drafting rules to potentially impose limits on airfares. In fact, in a sealed cover, something has been proposed to the Supreme Court. Now, the promoter of India's largest airline argues that the cost of a ticket is not determined by airlines alone. There are many other factors at play. Rahul Bhatia of Indigo told me recently that the responsibility of the current cost structure lies with the ecosystem, which includes airport charges by the airport operator, user development fee, landing charges, and much more. Take a look.
The industry always gets, again, I use a word and you'll hang on to it, hammered for airfares. And this, again, something that I think we have not done a good job in educating the world at large. UDF charges at airports have gone up to 95%. Landing charges at airports have gone up to 34%. And the reason I make this point is this is not being critical, but I think if we truly want India to become a major global aviation market, I think the whole ecosystem has a responsibility to make sure that we have a cost structure that will allow us to compete.
Well, that's Indigo's Rahul Bhatia there saying that by focusing merely on the airline's responsibility when it comes to pricing, we're addressing the wrong question. The issue of price cap is not limited to just healthcare or aviation. Several sectors are grappling with the possibility of regulatory action that could significantly alter their models. To discuss all of this and more, we're joined by Prashant, Nimesh, Ekta and Sriram. Guys, it's great to be here, sitting with all of you after a long time.
No cap, Shri.
No cap. No cap is right. No cap is right. But, you know, Ekta and Prashant, you, of course, just put together that stellar starcast of all the hospital operators to discuss this issue of price caps. And it's not just hospitals or healthcare. As we pointed out, it's a whole bunch of sectors that are dealing with the possibility of the stroke of pen risk today. Prashant.
Absolutely, Shireen. And first of all, great that you're here. I think we should fly down every editor's playbook, I think.
We will then definitely need a price cap. We'll definitely need a price cap then.
But I'll tell you, just to give an example, Shireen, I think this was last week, right? There was CNBC TV 18 has been conducting this risk awards with, ICICI Lombard, and I was at that event, and there was a Q&A, and these were all the risk leaders across, all listed companies, large companies, some 200, 250 people in that room.
Across sectors.
Across sectors, right? And there was this sort of, there was a screen, and they were asking questions about, just a Q&A. And one question was, what is the one biggest risk that you worry about? And there was regulatory risk, there was geopolitical risk, and there was a bunch of other options. And I thought it would be because of Trump and whatnot, that perhaps people will say geopolitical risk is a big one. Regulatory risk was by far the one which kind of sort of, won out, right? And I think that kind of speaks to what we are talking about here, which is the fact that, as you I think put it very well, which is stroke of a pen. The risk of just changing regulations on a stroke of a pen. I think businesses are quite worried about. I'm going to list out across the board maybe which are the sectors most impacted. But just a caveat before I do that, which is that the case here is not that regulation once set is set in stone, right? You set up an industry and the government wants private capital to come in, and that's the philosophical argument behind. I think if you're a regulator, you'd say, well, it's not as if we want private capital to come in. We want the industry to grow. We want players to come in. But at some point, we have to ask who is actually benefiting, and I think that's how the regulators look at it. So it's not the case that, well, these are the rules of the game, and they should never be changed. I don't think that is the point. But in any case, I think we'll get into some of this stuff in greater detail. But just to list out some of the top ones, right? Hospitals, I think Ekta will talk about in much greater detail. It comes up every now and then. I think this is the fourth or fifth instance, but this is in a parliamentary panel report, which is, cap room tariffs. There's, of course, procedure costs, etc. A whole bunch. I think Ekta has been talking about 300 plus pages as she's gone through all of them.
Probably the only person in the country who's gone through all 300 pages.
and that's a big one, right? And I think we heard from CEOs, etc., which perhaps we play some sound bites out of as well. Airport operators, I think we just heard from Mr. Bhatia, which is, and of course we can discuss and debate and what's the global experience, etc., the pros, cons, how this happens, and is it a strict no? Is it this is allowed? So we can go into it. Insurance, right? And some of on the distribution side, there is a fair bit of thing which comes up. We're waiting for the distribution reform paper from the IRDAI. It's a little delayed. Dark patterns is something which I think the regulator has been talking about. But again,
some action also.
Not action yet. It's still in the deliberation stage, but we will see if something does come through there. Power exchanges, right? I think exchanges are supposed to be a dominant monopoly business and they're supposed to be money spinners. They are money spinners. IEX is the clear leader, but we've seen what happened. Coupling is essentially, so the nature of how price is discovered is proposed to be changed with the coupling norms. Again, something which we can go into. F&O norms, I mean, again, this is in the interest of public shareholder, the interest of retail investors. I think this week we will get the F526 report on what SEBI's own report about their assessment of retail loses money, not loses money, that famous 90% lose money kind of report. So, I mean, some of this stuff is, of course, intended to protect retail investors and, I mean, consumers in that sense. But again, I mean, this has an impact on businesses, which is the exchanges, the brokers, etc. Many of them which are listed. Most of them, the bigger ones, are all listed. The one positive thing, which I think is interesting, is this MDR and UPI, which I think perhaps goes the other way, which perhaps will open up a new revenue stream, which was not there till now. And again, I mean, I think we've seen what's happened with share prices of Paytm. So it works the other way as well sometimes. But of course, I mean, it's more negative than positive when some of these regulatory changes take place. Quick commerce, gig workers. Again, it's an evolving issue. There are lots of consultations which are going on. It's not kind of, set in stone. But I think, there are pros and cons. Convenience, perhaps it costs more if you kind of go in for some of the stuff which is being proposed, versus, of course, protecting worker rights, rider rights, etc. So I think whole host. Autos is another area, right? I mean, I think which is, there's the CAFE norms, there's the mixing of ethanol. And, and of course, I mean, there is a pushback against consumers themselves in this particular case, right? So yeah, I mean, so this seems to be, this seems to bear out that poll that I started by saying, which is regulatory risk across sectors, perhaps the number one.
No, absolutely. Regulatory risk is real, and we've seen that play out, as far as the online gaming sector is concerned. I mean, with one stroke of a pen, that was the end as far as online money gaming is concerned. And, you want to talk about Delta Corp, Nimish, and what's happened there?
As what Prashant pointed out, not only Delta Corp. So Delta Corp was one stock, even IEX for that matter. So Delta Corp, I was just looking at the share price from a high of 350, it's quoting at 60 now. And that's across the board, look at IEX, it was quoting at 300, now back to 125. Across even the insurance companies that he's talking about, from the recent peaks, all the insurance stocks in the last 3 years are down 35-40%. And this in the context that the markets have gone up and these stocks have underperformed. So clearly, wherever there is a risk of regulatory overhang, it actually, shakens the investors as well, and people have lost money. Investors have lost big amount of money in all those names.
Yeah, and again, as Prashant rightly pointed out, we're not saying that no regulation, or we're not saying that there should be regulation, cannot change or it cannot be dynamic. I think the question that requires an answer is to do a cost-benefit analysis based on data, because very often what may seem like well-intentioned moves or well-intentioned regulation may in fact end up having unintended consequences, which are then hard to reverse. And that's, I think, the argument that the hospital operators are making, Ekta, that look, don't go by anecdotal evidence, go by what the data is telling you.
Yes, absolutely. But, you have to ask that fundamental question that why exactly does the government want to regulate the healthcare space? That's because private healthcare is basically, bearing bulk of the burden right now. That's around 60% of healthcare is private at this point in time. And the prices are 7 times what you get in public hospitals. So that is the key reason. 70 to 80% of what you spend in terms of cancer care is out of pocket. Your average expenditure is 7.5 lakh rupees. So now patients have weak bargaining power because if it's an emergency, you're not going to check which hospital you're going to. Neither do they have any kind of pricing transparency. It's all opaque. You go into a suite, it's a different pricing. You go to a double occupancy, it's a different pricing. So what the government is saying is that there should be transparency. There should be some standardization. It shouldn't cost you so much to get a PET a PET or a PET CT or an MRI if you have cancer, because that is all out of pocket at the end of the day. That brings you to the question about insurance, because there is this missing middle, 40 crore people, 30% of the population, which are not covered by either government or private insurance. So if you have some kind of cover for them, maybe that would be helpful. And that's what they're proposing, 4,000 to 6,000 rupees in terms of a bracket. Now, the other thing is the key contention point is there's too much foreign capital which is coming into the entire hospital space, 51%. They're looking at some kind of maybe capping. They're okay with other sectors such as medtech getting, a lot more capital, but they are worried about hospitals getting so much capital. So that is the key reason. Now we do need them. That's a simple debate that, the bed count is much lower than what the WHO has said.
Exactly. What is the bed count to start with? I mean, the kind of infrastructure build-out that is required to service the needs of the country, I mean, we're significantly lower in comparison to all the global averages, right?
Yes, absolutely. So we are currently 15 beds for 10,000 people. The WHO recommendation is 30 beds for 10,000 people. So who's providing those beds? The private space. By FY30, they're saying 20,000 beds will probably come about. After FY30, there will be more beds which the private space is providing. So they are doing the heavy lifting. What the public or the government probably wants is some kind of guardrails that yes, you do the heavy lifting in terms of capex, but there should be some guardrails to provide an essential service at a subsidized rate.
Yeah, but I think that begs the question, right? I mean, yes, hospitals, education, an essential service, how do you price it? Can you leave it completely to the market? Or do you need some safeguards in place? But to the point about, how much foreign capital is coming in, the color of money, given the fact that you require all of this infrastructure build out, can we actually take that position of this is how much foreign capital we want in this sector, or this is whether there should be a cap on private equity ownership, which is again something that is being discussed at this point in time.
At some level, capital, I mean, it's not to make this or that, right? I mean, it's not as if private capital, local private capital is very different from foreign private capital. Capital is looking for a return.
They look for profits.
It's looking for returns. The point
is... It's not more benevolent or less benevolent. Yes, they're all looking for returns.
Absolutely. And I think as Ekta pointed out, which is the big issue is this insurance, which is that if you're paying everything out of pocket, then it kind of pinches more. And this, look, healthcare is also, because inflation has been such a big issue for the middle class. You started by Ekta saying that I think compared to government beds, I mean, public hospitals, insurance costs, hospital costs, private hospital costs, some 7 times higher. But the quality of the care or the experience or whatever, right? I mean, you want to call it at the end of the day, which is, I mean, it's just instructive to look at, and I was saying this on the program as well when we had all the hospital CEOs. So we got so much feedback on that parliamentary panel when, I mean, we put out details of what the recommendations were. Our audience, people perhaps who would be watching this, they're all saying, I mean, the feedback was, don't, this is working. This is costly, this is expensive, but this is working. This is all we have. So don't make this not work. Don't break what is not broken. You may fix it and the solutions. And I think all the hospital CEOs made that point, Ekta, which is that, maybe something is required to be done, but is this the way to do it?
Is price cap the way to do it is the question. Nobody is saying that, look, you should be able to charge whatever prices you want. But I think that comes back to the supply-demand issue as well, Ekta. If supply were to outstrip demand, the commercials, the economics would be very, very different. Today, the fact that hospitals are being able to charge a premium, private hospitals are being able to charge a premium, is because you have such a significant supply-demand mismatch, right?
So there are certain pockets where there is a strong amount of demand coming through. So there's Delhi, there's Mumbai, there are a couple of these smaller pockets. But if you look at it, Abhay Soy mentioned that the median age currently is 29. So you will eventually those people will become 40 plus. Those are the people who will need those hospital beds. And at that point, that supply will even out. So as of now, you might face a little bit of overcapacity, but that might even out eventually. We do have doctor shortages. We have, nurse shortages. All of that needs to be sorted in the next couple of years for us to have that kind of accessibility, affordability, and that kind of capping in terms of rates because of the demand-supply situation.
I've always, education and health, right? I mean, it's not about this government or that government. But the point is, these are, if you're going to end up spending, look at the uproar every now and then on social media we face on the cost of education, right? Schooling, which has gone through the roof. We can do a whole program on that. But I think it is something similar, which is the fact that if you don't have the state offering quality education and healthcare at a certain...
And the state cannot abdicate these spaces. The state cannot shirk its responsibility. We've been talking about this healthcare budget going to 2.5% of GDP for every budget for the last 20 years. And we're nowhere close to that number. Similarly for education, we did that story the other day where the government's own data is telling you that in government schools, the dropout rate at higher, secondary education is significantly higher than what we're we're seeing in the private sector. So the government, part of fixing this problem is also to fix government infrastructure, whether it's education or healthcare. But, that apart, let's talk about aviation. And we're 2.5 airlines virtually at this point in time. And as Rahul Bhatia was saying that, you're only looking at what the airline is charging. You're not looking at ATF, you're not looking at UDF, you're not looking at landing charges, which is not what the airline is making at all. So sometimes we're addressing only part of the problem and trying to fix responsibility on one player, whereas it's an ecosystem and a holistic sort of assessment that you need to do.
I mean, I think I'm not the aviation expert, but I think the aviation fare issue pops up
only when there is
like a crisis, or there's a crunch.
And you've also had checks and balances coming in as far as surge pricing is concerned. The government has stepped in and then it's stepped back as well. So there is a way of dealing with it, and we've seen that that play itself out, as opposed to having a sort of blanket, let's come in and have a sledgehammer approach there.
I think there is I think we're all in agreement here, no cap.
Yeah.
But the point that the government has to...
Does it mean the same thing, by the way? In Gen Z, does no cap mean the same thing or not?
For no cap for real, I guess. But the point, like you said, I think each case has to be looked at it very differently. Hospitals, I think what is happening is that there is an acknowledgement. I see what the parliamentary panel report has said, and the government's approach towards this is an acknowledgement of a problem that exists.
Yeah.
So I think to that extent, it's welcome. What do you do about it is, like you said, increase supply. And increase supply how? I think it has to come. And I think oil and gas gives us a very good sort of example of an essential sector where you can't let the pricing control go completely haywire. The government has to remain a significant stakeholder in the space and make sure that, it can control prices by being a player, by providing that supply at a reasonable price.
That's what we're saying.
Yes, exactly.
So look, oil marketing companies. They're government companies.
Correct.
We are talking about...
So every time there is an election, they can cap the prices the way they want to.
That's for the government
company. That's for the government.
This is for the private companies.
Those are 51% plus owned by government.
Correct. So similar model needs to come into healthcare and education, both, is what I'm saying.
I have a slightly different view on healthcare. What people are missing out, infrastructure is getting built by the government in some states for sure. Even for that matter, Ekta, you can say more about it. Look at the scheme that the government has put out on generic medicines. Okay, today I can see there are at least 2 or 3 private players who've become really big in the generic market.
Yeah.
And they're actually providing drugs at 80%, 90% lower than the branded price.
Yeah.
Nothing changes. Only the brand, is on the cover and the prices changes, right? So even like for a state like Gujarat, I can tell you with my experiences, places like Baroda, places like Surat, Ahmedabad, the public, the government infrastructure and medical is very, very strong.
Same is true for
and very good.
and Kerala also.
But again, the problem is because of the perception, a lot of people don't want to go to government hospitals.
Yeah.
Though they are good, though they are well equipped.
This is a very interesting
So
example.
again, this is a problem as well. There are some good infrastructure created, but people don't want to use it. And they still want to go to the private place because they feel...
There is a perception problem as well.
There are operational issues also.
So what I'm saying is we should not lose the sight on the fact that the government is serious and they're actually providing a lot of supply.
No, and I think you
bring
up a valid point there that, look, the government needs to intervene to create an enabling environment, to facilitate more investment, to facilitate more players to come in. And that is where the government should actually focus its bandwidth and its resources as well as its, stroke of pen possibilities.
In fact, I believe if the government, run organization which is into generic medicines, if they get listed, they'll get a huge market cap for that company.
But Nimesh, the generic medicines, you're absolutely right? I mean, they cost 1/10 of the cost of the whatever branded one, etc. But the point is that where is the delivery of the generic medicine happening? It is still happening through private hospitals. It's happening through public hospitals also. But I'm saying that we don't have enough of those in size,
and there is shortage of supply as well. So I'm not saying that there is enough supply as well, but I'm saying that one leap of faith that government has taken, private is also pulled in. Couple of players have come in and they're actually expanding big time into the generic markets as well. So
I don't think it's going to be a problem at all.
No, I know it's not a problem.
India
but I'm saying
has a problem in terms of the cost of medicines. There might be some medicines which cost a lot, but normally all medicines are very cheap in India.
Compared to global markets, of course, it's cheap.
Yeah. So
but generic is
we've had price caps.
Even there we were discussing about price caps.
For medicines now for years now, for many years. Yeah. Stents came in about 10 years ago.
2017. So it's stents, cardiac stents, knee implants, all of them have been price capped, but then, the procedure costs go up if the cardiac stent prices go lower. So that's basically what the government wants to rectify. That if a person has a cardiac issue, needs a stent, if it's costing 25,000, you can't make up the cost in other ways. You should allow the cost to be low and allow him to have the stent, which is 25,000 rupees, and the entire procedure should be a reasonable cost.
One interesting question I have. So we are obviously, we don't agree with price caps imposed by the government. But if you have an insurance policy, you know that your insurance provider puts a price cap on a lot of things, right?
In most of the things.
So when in such situations, how do we, why should that cap, that's a market determined cap. Why can't this become a benchmark and something government builds along those lines? Why is that not acceptable? I'm just thinking out loud here.
This is an important conversation to have. We're keeping it going here on CNBC TV 18. We just had the CNBC TV 18 Market Forum take this up with all the top players in the healthcare sector in the country. We are going to continue to have these conversations. So if you have feedback, if you have suggestions, if you have recommendations on what you believe the government, the private healthcare sector, the private education sector, insurance sector should do instead of price caps, or do you believe that price caps are the answer? Write to us, tell us. We'd like to hear from you and keep the conversation going. But I hope that we don't have to go to a hospital anytime soon or avail of insurance. But on that note, it is time for us to wrap up this episode of the Editor's Playbook. Thanks very much for joining us. Do send us your feedback. We would love to hear from you.
Poulters.